Hello CA and CMA inter students. I hope you enjoyed Marathon Part 1. Today I am coming up with CA CMA inter DT Marathon Part 2. This marathon is applicable for December 25 and January 26 attempt, and it is completely in 100% English. The length of the marathon is around 7.5 to 8 hours, and in Marathon Part 2 I am going to cover extremely important chapters: PGBP, capital gains. Like small chapters, other sources, clubbing, 10AA, A.M.T and marginal relief, these chapters are also covered. So in Marathon Part 1, I already uploaded house property, salaries, residential status, deductions, return of income. So I hope you had best revision of all those chapters. In Marathon Part 2 also, I have explained all the important provisions of PGBP and capital gains are covered very clearly. So make best use of this marathon. I wish you all the very best. Don't lose your focus. Aim for the examination. If you are CMA student, you should definitely clear December 25 examination. If you are CA student, you should definitely clear January 26 examination. Don't lose your focus. I wish you all the very best. Thank you. Let's start the marathon. Good. Yes, CA inter students, I welcome you all for live revision of CA inter PGBP. Now, what are the sections covered under PGBP? Section 28 to 44, these are the sections covered. Charging section is section 28. Next, what is the method of accounting? Method of accounting is either cash basis or accrual basis, as may be followed by the. So under PGBP, SSC can follow accrual basis, or SSC also can follow cash basis. Except these sections, section 32, 35D, 35DDA, 43. For these four sections, cash basis is only applicable. Next, charging section, you all know, like income from business or profession is taxable under PGBP. Profession includes vocation also. So whatever the income that is received from either business or profession, including vocation, such income is taxable under PGBP. Charging section, like there are 10 points in charging section. Charging section you can study on your own. Like charging section, in most of the times it is not being asked in the examination. So but some important points are there. Keyman insurance policy compensation, if it is received by employee, taxable under salaries. If it is received by employer, taxable under PGBP. If it is received by family members of employee, then it is taxable under income from other source. Okay. Non-compete fees, that is also important. If any non-compete fees is received, that is taxable under PGBP. Similarly, on conversion of stock in trade into capital asset. Whenever you convert stock in trade into capital asset, on date of conversion, whatever the fair market value is there, that fair market value will be considered as sales under the head PGBP. Are you able to understand? So, for example, let's say I am doing AC business. My main business is buying and selling of ACs. What I have done, whatever the AC that is there in my stock in trade, that AC I installed in my office. So whenever I install AC in my office, I am converting stock in trade into capital asset. On the date of conversion, whatever the fair market value is there, that will be considered as sales amount under the head PGBP. Are you able to understand? So these are important points. Remaining points you can study on your own. Next, section 30 to 37. These expenses are very important, which I will discuss with you right now. PGBP head is very vast. So easily, definitely one question will come in the examination. Easily you can expect 10 marks or more than 10 marks from PGBP. So as PGBP head is very vast, I will discuss PGBP in two parts. Today I will discuss, tomorrow also I will discuss PGBP. So in two parts I will finish PGBP. First, section 30, building expenses. Very simple. I am owner of this building. I am using this building for my business. What are all the expenses that I can claim as deduction? As a owner, I can claim depreciation on the building. Next, whatever the repairs that are done to the building are there, revenue repairs. If I have done capital repairs, it is not allowed as expenditure. That will be added to the cost of the asset. So whatever the revenue repairs that are done to the building are there, that are allowed as deduction. Similarly, I paid municipal taxes, property taxes, that is also allowed as deduction under PGBP. I paid fire insurance premium, that is also expenditure allowed as deduction under PGBP head. So as a owner, I can claim depreciation, I can claim revenue repairs, I can claim property taxes, I can claim fire insurance premium. All these expenses are which are of revenue in nature allowed as deduction under PGBP as per section 28. Are you able to understand? Next, if I am the tenant of the building, what are all the expenses that I can claim? Let's say I took one flat on rent. In that flat, I am doing my practice. I am doing my CA practice. Now, with regard to that flat, I will pay rent. Rent is a expenditure, business expenditure, that is allowed as deduction. Next, with regard to that flat, if I incur any revenue repairs, that is also allowed as deduction. Now, with regard to that flat, if I pay property taxes, that is also allowed as deduction to the tenant. If I pay any fire insurance premium, that is also allowed as deduction. The only difference is in case of owner, he will claim depreciation. In case of tenant, he will pay rent. He will claim rent as deduction. Are you able to understand? That is the difference. Students always remember depreciation, rent. Both expenses are not allowed as deduction. Either depreciation is allowed or rent expenditure is allowed. Out of two expenses, any one of the expenses is only allowed as deduction. Are you able to understand? Sir, for example, I took one flat on rent. I am using that flat partly for like I am a bachelor. In one flat, one room I am staying. In another room I am doing recording. That means half of the flat is used for personal purpose, half of the flat is used for business purpose. Then whatever the portion of the flat that is used for business purpose is there, only for that portion, whatever the expenditure is there, only that expenditure is treated as business expenditure and it is allowed as deduction. Are you able to understand? Same expenses of plant and machinery and furniture. If I am, let's say, I purchased a power generator. With regard to power generator, I can claim depreciation. Are you able to understand? Next, with regard to power generator, if I incur any repairs and maintenance, if it is revenue in nature, I can claim as deduction. If I pay any fire insurance premium, that is also allowed as deduction. So, with regard to plant and machinery or furniture, owner can claim depreciation, he can claim revenue repairs, he can claim fire insurance premium. Tenant can claim rent as deduction. Let's say I took power generator on rent. Every day I need to pay rent. Whatever the rent paid for hiring power generator, that is allowed as deduction. Next, as a tenant, if I incur any revenue repairs, that is also allowed as deduction. If I pay any fire insurance premium, that is also allowed as deduction. Section 32, depreciation, I will discuss with you. Depreciation is also very important. I hope you are all having booster material with you. Are you having booster material? If you are not having booster material, you can go to my website www.phoenixbyuma.com. In that website, there is one tab, free resources. Under free resources tab, I have provided booster material at free of cost for you. You can download booster material and you can listen to my lecture. Okay. Now, shall we discuss the concept of depreciation? Yes. See, as per accounts, depreciation is calculated for each asset individually, but as per income tax, depreciation is calculated for a group of assets, which is also called as block. So under income tax, we will calculate depreciation on block wise. We do not calculate depreciation for each asset individually. Under accounts, there are various methods to calculate depreciation: SLM, WDV, machine hours method. But under income tax, there is only one method to calculate depreciation, which is written down value method, except in case of power sector undertaking. Power sector undertakings, they have an option. Either they can follow SLM or they can follow WDV. Okay. To claim depreciation on any asset, two conditions are required to be satisfied. Assessee shall be the owner of the asset, and assessee shall use the asset for his business purpose. He shall use the asset for the purpose of business. Okay. So assessee should be the owner. Only owner of the asset can claim depreciation. Of the asset cannot claim depreciation. Second condition, let's say I purchased one car. I am using car for my personal purpose. If I use car for my personal purpose, how can it be allowed as business expenditure? No. Car also should be used for business purpose. Only if car is used for business purpose, then only depreciation is allowed as business expenditure under section 32. So two conditions, like assessee should be the owner of the asset, assessee shall use the asset for his business purpose. Only if these two conditions are satisfied, then only depreciation is allowed as expenditure. Otherwise, depreciation is not allowed as expenditure. Condition 1 is there na, assessee should be the owner of the asset. For this condition, whatever this condition is there, owner of the asset. For this condition, there are 4 exceptions. What are those 4 exceptions? First, in case of hire purchase. See, generally in case of hire purchase, ownership will be transferred after payment of last installment. Now, even though ownership is transferred after payment of last installment, still assessee can start claiming depreciation from first year onwards. Are you able to understand? So, that is the exception. Second exception, leased asset. On leased asset, if you incur any capital expenditure, even though you are not the owner of the leased asset, still whatever the capital expenditure that you have incurred, on that capital expenditure you can start claiming depreciation. I took one room on rent. Okay, rent is 15,000 rupees per month. I modified the room. I am recording now, so I have done the studio setup. For studio setup, I have spent 1,40,000 rupees. Now 1,40,000 setup done for this room, it is capital expenditure. But whether I incurred capital expenditure on my own property? No, I incurred capital expenditure on leased asset. Even though I incur capital expenditure on leased asset, whatever the capital expenditure is there, on that capital expenditure I can claim depreciation even though the flat is rented flat. Are you able to understand? Next, third case, co-ownership. Let's say I am and my friend who is also in practice, we both together we purchased one Innova car. I contributed 20 lakhs, my friend contributed 20 lakhs. Now I am not the single owner of the car. Okay, my friend and me, we are co-owners of the car. Even though I am the co-owner, sufficient, whatever the amount that I have contributed, for that amount I can start claiming depreciation. Are you able to understand? Purchase covered under section 53A of Transfer of Property Act. See, there are 3 conditions. There should be agreement between seller and buyer. Buyer has paid the consideration, or buyer is ready to pay the consideration, or buyer has taken the possession of the property. If all these 3 conditions are satisfied, then buyer, okay, buyer will be considered as deemed owner of the property and buyer can start claiming depreciation. See, even though legally registration is not done, still buyer will be treated as deemed owner of the building. Are you able to understand? So these 4 are the exceptions to the first condition. Assessee should be the owner. Next, there is no depreciation on land. Land is not a depreciable asset, so you cannot calculate depreciation on land. Next point, usage can be either active usage or passive usage. Passive usage means what? You do not use actively, you will keep the asset ready for use. Even the asset is ready for use, sufficient, you can claim depreciation on that asset. Are you able to understand? Reduced depreciation. Generally, for the purpose of calculating depreciation under Income Tax Act, what is relevant is not date of purchase. What is relevant is date of put to use. So depreciation is not calculated from date of purchase. Depreciation is calculated from date of put to use. If asset is put to use for greater than or equal to 180 days, we will calculate full rate of depreciation. If asset is put to use for less than 180 days, then we will calculate half rate of depreciation. Are you able to understand? So we need to See, if asset is not put to use at all, then we are not going to calculate depreciation. So under income tax, we do not calculate depreciation on time basis. Okay, for number of days asset is used, we do not calculate proportionate depreciation. What we will calculate, if asset is put to use for greater than or equal to 180 days, we will calculate full rate of depreciation. If asset is put to use for less than 180 days, we will calculate half rate of depreciation. Okay. In first year, asset is not put to use, but it is put to use in the second year. In second year, even though it is put to use for less than 180 days, still we need to calculate full rate of depreciation. That means half rate of depreciation concept is applicable only in the year of purchase. In the year of purchase, let's say first year, put to use greater than or equal to 180 days, full rate. First year, put to use less than 180 days, then half rate. Second year, put to use greater than or equal to 180 days, full rate. Second year, put to use less than 180 days, then half rate. That means what? In second year, even though asset is put to use for less than 180 days, we will calculate full rate of depreciation. Okay. So from second year onwards, even the asset is put to use for less than 180 days, we will calculate full rate of depreciation. Now, all assets, depreciable assets are classified into 4 categories. Okay. First one is building. Second one is plant and machinery, furniture, intangible assets. Okay. Now, building. What is the rate of depreciation applicable for building? If it is the residential building, rate of depreciation is 5%. Okay, mainly used for residential purpose. Rate of depreciation 5%, except hotels. Hotels, even though customers use for residential purpose, from owner point of view, it is commercial use only. So on hotel buildings, we will apply 10% rate of depreciation. Next, if hotels are used for, like if any building is used for commercial purpose, for doing business or for doing profession, then on that building rate of depreciation applicable is 10%. Okay, purely temporary erections. Purely temporary erections, what? Let's say wooden building is constructed. It is temporary structure. On wooden building, the rate of depreciation applicable is 40%. Very simple. Residential building 10%, commercial building, sorry, residential building 5%, commercial building 10%, hotels 10%, temporary structures 40%. Sir, what about additional depreciation? I will discuss with you. Additional depreciation concept is also there. Okay, have patience. Next, furniture. Rate of depreciation applicable for furniture is 10%. Very simple. Furniture rate of depreciation 10%. Goodwill rate of depreciation, sorry, intangible assets rate of depreciation is 25%. Nowadays, there is no depreciation calculated on goodwill. So if you see land, if you see goodwill, these two, on these two assets, you should not calculate depreciation. Are you able to understand? Furniture rate of depreciation 10%. Intangible assets, trademarks, copyrights, patents, know-how, on all these rate of depreciation is 25%. Next, plant and machinery. Very simple. Aeroplanes, rate of depreciation 40%. Ships, rate of depreciation 20%. Next, motor vehicles. If motor vehicles are used in hire business, then rate of depreciation is 30%. If motor vehicles are used other than in hire business, then rate of depreciation is 15%. Next, molds. You know molds, right? Like using mold, we can create n number of assets. On molds, rate of depreciation applicable is 30%. Next, air pollution control equipment, life-saving medical equipment, rate of depreciation is 40%. Next, books. On books also rate of depreciation is 40%. Next, oil wells rate of depreciation 40%. Windmills, if they are installed before 1st April 2014, rate of depreciation 15%. If they are installed on or after 1st April 2014, rate of depreciation is 40%. Sir, if any plant and machinery is there for which rate of depreciation is not specified, then for all residual plant and machinery, rate of depreciation is 15%. On computer, iPad, and all these things, rate of depreciation is 40%. Next, if you purchase any software, let's say I purchase a Tally software or Winman software, on that also rate of depreciation is 40%. Very, very important. If I purchase motor vehicle which runs by petrol or diesel, rate of depreciation 15%. If I use that vehicle in higher business, rate of depreciation 30%. But if I purchase electric vehicle, na, very, very important. I purchased electric car or electric bike, rate of depreciation is 40%. Are you able to understand? On e-vehicle, rate of depreciation is 40%. So did you understand, Saket? Now, computation of written down value of the block. Normally, how do we calculate? We will take opening written down value. To opening written down value, we will add additions. Additions are classified into two types: put to use greater than or equal to 180 days, put to use less than 180 days. After adding additions, then we will reduce assets sold. Whatever the assets sold are there, we will reduce sale value of the assets. So whatever sale value of assets, very important. Whenever any asset is sold, don't reduce book value, don't reduce written down value. Whenever any asset is sold, then from the block, what you need to reduce is sale value. Whatever the money that you have received on sale of that asset, that needs to be reduced. Sale value of asset, very, very important. Whenever you sell any asset, what you need to reduce is sale value. After reducing sale value, you are going to arrive at written down value for depreciation. Whatever written down value for depreciation is there, on that you are going to calculate depreciation. So whatever the depreciation is that you have reduced is there, then first you will reduce depreciation, then you will also reduce additional depreciation, normal depreciation as well as additional depreciation. After reducing normal depreciation and additional depreciation, you are going to arrive at closing written down value of the block. Normal depreciation, I have already explained to you how to calculate. First year, asset put to use for greater than or equal to 180 days, you will calculate full rate. First year, asset put to use for less than 180 days, you will calculate half rate of depreciation. From second year onwards, if asset is put to use for greater than or equal to 180 days or less than 180 days, you will calculate full rate of depreciation, normal rate of depreciation. Next, additional depreciation. That is important. I will discuss with you additional depreciation. Very simple. Additional depreciation is available only for two entities: those who are engaged in manufacturing business, those who are engaged in those who are power sector undertakings, those who are engaged in the business of, you know, generation, transmission, or distribution of power. They are also called as power sector undertakings. See, I am a CA in practice. I am into service oriented business. Can I claim additional depreciation? I cannot claim additional depreciation. So I am into trading business. Can I claim additional depreciation? No. Only if I am engaged in manufacturing business or if I am engaged in the business of generation, transmission, or distribution of power. Only for these two businesses I can claim additional depreciation. Are you able to understand? Next, see, there are four types of blocks. Building. On building, can I claim additional depreciation? No. On intangible assets, can I claim additional depreciation? No. On furniture, can I claim additional depreciation? No. Only on plant and machinery, I can claim additional depreciation. Sir, I purchased second-hand plant and machinery. Can I claim additional depreciation? No. Only on new plant and machinery, I can claim additional depreciation. Are you able to understand? Now, so I can claim additional depreciation only on new plant and machinery. then only for new plant and machinery additional depreciation is available. Next, sir, I purchased a new plant and machinery, but I am using that new plant and machinery in corporate office. Can I claim additional depreciation? No. If you use new plant and machinery in administrative block, then additional depreciation is not available. Or new plant and machinery is used in residential accommodation. Whether additional depreciation is available? No, additional depreciation is not available. Very in simple terms, only if you purchase new plant and machinery, and if that new plant and machinery is used in manufacturing area, then only you can claim additional depreciation. Are you able to understand? You purchased the trucks, motor vehicles, even though they are plant and machinery, even though they are new plant and machinery, even though you are into manufacturing business, still you cannot claim additional depreciation. Additional depreciation is available only if you purchase new plant and machinery, and such new plant and machinery is used in manufacturing area, then only additional depreciation benefit is available. Are you able to understand? Ah. If you are paying taxes under section 115 BAC default tax regime, additional depreciation benefit is not available. That means additional depreciation benefit is available only if you are paying taxes under optional tax rate. Are you able to understand? How to determine actual cost of the asset? You already know, whenever you purchase any asset, additions are there now. How to calculate value of additions? Whenever you purchase any asset, whatever the purchase cost is there, to purchase cost you will add incidental expenses. I purchased one manufacturing machinery from Mumbai. Okay, so I need to bring that machinery to Hyderabad. So purchase cost is 1 crore rupees. Whatever the transportation expenses are there, whatever the insurance charges are there, whatever the loading and unloading charges are there, whatever the trial run charges are there, all these expenses are to be added to the cost of the machinery till the asset is put to use. Okay, till the asset is put to use, whatever the expenses incurred, all those expenses will be added to the cost of the asset. Are you able to understand? Sir, please give a depreciation calculation example with additional depreciation. Saket, with regard to additional depreciation, I have solved this question. Whatever the revision that I am doing, whatever the class that I am teaching right now, it is revision class. In revision class, I am brushing up the concepts of PGBP. If you need a practical example with regard to calculation of additional depreciation, I have done booster series. Okay, in booster series, I have explained example relating to additional depreciation also. So depreciation 3 hours concept is there. Don't worry, you need not listen to 3 hours. I have given timestamps. Okay, in those timestamps, select additional depreciation. Hardly 15 to 20 minutes concept will be there. Then I have also solved one problem. Listen to those 20 minutes. You will get clarity about additional depreciation problem also. Okay. Next, see, whenever I purchase any asset, purchase cost plus incidental expenses till the time it is put to use. All those incidental expenses will be added to the cost of the asset. Next, if I receive any subsidy from the government or subsidy from third party, subsidy amount is to be reduced while calculating the cost of the asset. Are you able to understand? Similarly, like trial run was done. After doing trial run, I got finished good. I sold that finished good. Whatever the income received from sale of trial run products are there, that income is also to be reduced while calculating the cost of the asset. Are you able to understand? Next, whenever you are purchasing any asset, you should make payment by way of bank transaction. If value of asset is up to 10,000 rupees, you can make payment in cash. If value of asset is more than 10,000 rupees, then per person per day, you should make bank payment for more than 10,000 rupees expenditure. Are you able to understand? So like Mandatorily, you should make payment by way of bank transaction if amount of expenditure is more than 10,000 rupees when you are purchasing the asset or when you are incurring the incidental expenses. Are you able to understand? So there are different cases to take to consider cost of the asset. For example, there was amalgamation. In amalgamation, amalgamated company received the asset from amalgamating company. In books of amalgamated company, cost of asset is equal to written down value in the books of amalgamating company. Next, demerger happen. Assets transferred from demerged company to resulting company. In the books of resulting company, cost of the asset is equal to written down value in the books of demerged company. Are you able to understand? Next. Like there is stock in trade into capital asset. Whenever stock in trade got converted into capital asset, then cost of asset is equal to fair market value on date of conversion. That will be treated as cost of asset. Next, when any asset is acquired by way of gift or inheritance, written down value to the previous owner. For example, let's say I received one asset as a gift from my friend who is also a chartered accountant in practice. So in my books, cost of asset is equal to written down value to the previous owner. So whatever my friend's written down value is there in his books of accounts, that will be treated as cost in my books of accounts. So there are four cases: transfer of asset from holding company to 100% subsidiary company, 100% subsidiary to holding company, transfer of assets from amalgamating to amalgamated company, transfer of assets from demerged company to resulting company. In all these four cases, cost of asset is equal to written down value in books of previous owner. Okay, books of previous owner. Next. If any asset is used for specified business, section 35 AD, then if that asset is transferred to normal business, cost of acquisition is equal to 0, because already in specified business you would have claimed 100% of the deduction. Sir, it is also a provision that transporters can make till 35,000 in cash. Saket, for transporters, you can make payment up to 35,000. That is as per 40A3. Okay. But whenever you are purchasing the asset, even to transporter also, the limit applicable is 10,000 rupees. Because see, cost of asset is determined as per section 43.1. Section 43.1 specifies only one limit, which is 10,000 rupees. Are you able to understand? So whenever you are purchasing the asset, at the time of purchase of asset, if you make any payment to transporter, then 35,000 limit is not applicable. Then also 10,000 rupees limit is only applicable. Are you able to understand? However, for revenue expenses, section 30 to 37, for revenue expenses, section 40A3 is applicable. For revenue expenses, if you are making payment for transporter, up to 35,000 limit is applicable. Very, very important. Many students will make mistake here. Are you able to understand? So I hope you understood this point. So whenever you are purchasing the asset, only one limit, 10,000. Whenever you are incurring revenue expenditure, two limits, 10,000 and 35,000. Okay. Next, asset brought into India by a non-resident. Whenever non-resident brings any asset to India, then cost of acquisition is equal to original purchase cost minus for how many years he has used it for personal purpose. We should assume he used it for business purpose. We should reduce notional depreciation. Balance written down value will be considered as cost of additions. Sundar Pichai purchased one asset in 2023. Okay, in 2024 he started business. For 1 year he used the asset for personal purpose. In 2024 he brought the asset into business. Now in 2024, cost of asset is equal to original cost minus depreciation for 23-24. Are you able to understand? Even though he used it for personal purpose, we will calculate notional depreciation. We will reduce notional depreciation. Whatever the balance written down value is there, that will be considered as cost of addition. Are you able to understand? like whenever you receive subsidy for 2 or more assets, then subsidy amount is to be allocated proportionately to each asset based on its value. Okay, let's say uh, A cost is 10 lakhs, B cost is 30 lakhs. Okay, now I received subsidy. Subsidy amount is 9 lakh rupees. How much is subsidy? 9 lakhs. 9 lakhs I have to apportion proportionately. Are you able to understand? 9 lakh into 1 by 4. How much? 2 lakh 25,000. This is the subsidy. 9 lakh into 3 by 4, 6 lakh 75,000. So whenever you receive subsidy uh, on a composite basis for 2 or more assets together, then whatever the subsidy amount is there, that is to be reduced from each asset on a proportionate basis. Next, capital gains in case of depreciable assets. See, there is written down value of the block now. We will calculate opening written down value. Let's say 10 assets are there. Their value is 8 lakhs. Let's say there are additions, 2 assets, 1 lakh, 9 lakh, total assets 12. Let's say we sold assets, sale value of assets. Let's say we sold 9 assets, we sold them for 8 lakh 50,000 rupees. Now, how many balance assets are there? 3 assets are there, their value is 50,000. The point is, only when there are assets in the block and block is having positive value, when these two conditions are satisfied, then only we will calculate depreciation. Otherwise, depreciation will not be calculated here. So to calculate depreciation, two conditions are there. Condition 1, there should be some assets in the block. Second condition, whatever the block is there, that block shall have positive value. Whenever these two conditions are satisfied, then only we will calculate depreciation. Otherwise, we do not calculate depreciation. Are you able to understand? So simply we can tell assets positive value. If there are assets in the block and block is having positive value, then we will calculate depreciation. If there are no assets in the block, but block is having positive value, then can we calculate depreciation? No, only when both conditions are satisfied, then only we can calculate depreciation. In this case, assets are not there, but block is having positive value. Think logically, if there are no assets in the block, still you calculate depreciation, you are unsound mind, correct? So if there are no assets in the block, in that case, you will not calculate depreciation, you will calculate capital gains. Are you able to understand? If there are assets in the block, but block is not having positive value, then also you will not calculate depreciation, then also you will calculate capital. If there are no assets in the block, and if block is not having positive value, then also you will not calculate depreciation, then also you will calculate. Are you able to understand? So this is the concept. Very simple. Section 32. Section 32 speaks about depreciation. Section 50, it speaks about capital gains in case of depreciable assets. Section 32, Section 50, both are mutually exclusive. If you calculate depreciation, you cannot calculate capital gains. Whenever you do not calculate depreciation, then you are going to calculate capital gains. Are you able to understand? See, these 4 cases along with examples I have discussed already. What is to be taken as sale value? Uh, sale value. What is to be taken as full value of consideration? Full value of consideration is equal to sale value of asset. Then what is to be taken as cost of acquisition? Written down value of block will be taken as cost of acquisition. You will reduce written down value, thereby you will get short-term capital gain or short-term capital loss. That means what? Depreciable assets always treated as short-term capital assets. That's why in case of depreciable assets, short-term capital gain or short-term capital loss will arise. Are you able to understand? Next, apportionment of depreciation. Sir, what do you mean by apportionment of depreciation? I will tell you. Let's say if demerger, amalgamation, conversion of sole proprietorship into company, or conversion of sole proprietorship into partnership firm or LLP, whatever these conversions are there now, if these conversions happen on 1st April of previous year, no problem at all. Entire depreciation will be allotted to successor, new person. But if conversion takes place in the middle of the year, let's say uh, Uma Limited got converted into Uma LLP. This conversion happened on 1st November 2024. So whenever conversion happens in the middle of the year, then we will assume a single entity. We will calculate total depreciation. Whatever total depreciation is there, this total depreciation will be allotted to preceding entity and new entity based on number of days of usage of asset. Based on number of days of usage of asset. Based on that, we are going to calculate depreciation and we will apportion the depreciation among preceding entity and a new entity. Very simple conversions. Like amalgamation, assets transferred from amalgamating to amalgamated, demerger, assets transferred from demerger to resulting, conversion of sole proprietorship into company, conversion of private limited company into LLP. All these conversions, if they happen in the middle of the year, then assume asset is used by single entity, calculate depreciation for whole year. Whatever the depreciation for whole year is there, that is to be apportioned between predecessor and successor based on number of days of put to use of such asset. Are you able to understand? Unabsorbed depreciation. Sir, what do you mean by unabsorbed depreciation? See, in current year, we will calculate profit. For example, in current year, there is net loss. We did not claim depreciation expenditure. So if there is no profit to set off depreciation, or if existing profits are not sufficient to set off depreciation, then whatever the depreciation that could not be set off is there, that depreciation we call as unabsorbed depreciation. Are you able to understand? Now, sir, what is tax treatment for unabsorbed depreciation? Unabsorbed depreciation, we will do intra-head set off. That means if there is any other business income, we will set off against. And unabsorbed depreciation, then we will do inter-head set off. We will set off unabsorbed depreciation against other heads of income other than salary, other than section 115 BB and 115 BBJ, winning from lottery betting. Against that income, you cannot set off unabsorbed depreciation. So simple, unabsorbed depreciation current year you will set off against other business income. After setting off against other business income, still unabsorbed depreciation is there. You will set off against other heads of income other than salaries. You cannot set off against income from salary. You cannot set off against section 115 BB, BBJ income. Are you able to understand? Sir, after doing set off against other heads also, still some unabsorbed depreciation is left balance. Whatever the balance unabsorbed depreciation left is there, that will be carried forward to next year. Okay, and in next year, that balance unabsorbed depreciation will be set off. Next year, will you set off this brought forward unabsorbed depreciation first? No. In next year depreciation will be there now. So against next year profits, first you will set off next year depreciation, next you will set off brought forward losses, then only you will set off brought forward unabsorbed depreciation. That means brought forward unabsorbed depreciation priority is third priority. So next year net profits came. Against those net profits, first you will set off next year depreciation, second you will set off brought forward losses, third you will set off brought forward unabsorbed depreciation. Are you able to understand? I hope Saket you are following. Now, next, if any asset is used partly for business purpose and partly for personal purpose, then what will we do? Whatever the depreciation that is there for business purpose is there, only the depreciation is allowed as deduction. So if any asset is partly used for business and partly for personal purpose, then proportionate usage made for business will only be allowed as depreciation deduction. The depreciation deduction allowed above will only be reduced from depreciable value of the block. See, car is there. I have given example. 30% used for business, 70% used for personal purpose. Then we will calculate depreciation on car. On depreciation of car, 70% is 70% of depreciation disallowed. Only 30% of depreciation is allowed as expenditure in P&L account, and only 30% of depreciation will be reduced from written down value of the block. If any asset is used to earn composite income, you know, right? Rubber, tea, coffee. If any asset is like income from rubber business, 65-35 ratio. Income from tea business, ratio 60-40. Income from coffee business, okay. Four things are there: grown, cured, roasted, grounded. If four activities are performed, ratio is 75-25. Ratio is 60-40. Only two activities, growing and curing, was done. Ratio is 75:25. In that ratio, you will divide the income as agricultural income and business income. Highest percentage is agricultural income, lowest percentage is business income. Correct? Now, whenever any asset is used for earning composite income, then on that asset you will calculate depreciation, and total depreciation is allowed as expenditure, because you will claim total expenditure. Whatever the net profit is there na, ultimate net profit you will divide as 60:40. That's why total depreciation is allowed as deduction. So if asset is used to earn composite income, depreciation shall be computed as if the asset is completely used for business. So total depreciation will be reduced. The depreciation so computed shall be deemed to have been actually allowed to the asset. Next, power sector undertakings. Power sector undertakings, they have two options. If they want to follow SLM, they can follow SLM. If they want to follow written down value method, they can follow written down value method. But if they follow straight line method of depreciation, then they need to calculate depreciation asset wise. But if they follow written down value method of depreciation, they need to calculate depreciation block wise. So in the year in which power sector undertaking or power generating unit was started, in that year decision has to be taken either to follow SLM or written down value. So whatever the decision that they take, the same decision is applicable till the uh, till the business is closed. Are you able to understand? Let's say I started power sector undertaking in 24-25. In 24-25, I will file my income tax return. Now, there will be due date for filing ITR. Before that due date only, I have to take decision. Are you able to understand? Either to follow SLM or written down value method. If I follow SLM, I need to calculate depreciation for each asset individually. If I follow written down value, I need to calculate depreciation for group of assets, which is also called as block. Now, capital gains in case of assets sold by power sector undertaking. Assets sold by power sector undertaking following straight line method of depreciation. Following straight line method of depreciation. Very simple, I will explain. Let's say written down value of asset is 8 lakhs. This asset is sold for 6 lakhs. There is loss na. Loss 2 lakhs is there. This loss 2 lakhs is called as terminal depreciation, and this terminal depreciation will be debited to P&L account. It was sold for 10 lakhs. Let's say cost of asset is 11 lakhs. In current year written down value is 8 lakhs. Okay, it is sold for 10 lakh rupees. Now there is surplus na, because return on value is only 8 lakhs. It was sold for 10 lakhs, or let's say it was sold for 9.5 lakhs. So how much is surplus? 1.5 lakhs. This will be credited to P&L account. Next, it was sold for 11 lakh 70,000. Now is there profit or loss? Book value is, written on value is 8 lakhs. It was sold for 11 lakh 70,000. How much is surplus? 11 lakh 70,000 minus 8 lakh. 3 lakh 70,000 is surplus. Out of 3 lakh 70,000, whatever the depreciation claimed earlier is there. How much is the depreciation claimed earlier? 3 lakhs. So to the extent of 3 lakhs, it will be credited to P&L account. Next, balance 70,000 is there na. This 70,000 will be considered as. Are you able to understand? So this is all about initial concept and depreciation part. Yes, like I welcome you all for PGBP second session. In first session, we discussed about completely about depreciation. Now we are going to discuss section 35. Remaining all concepts, section 35, 36, 37, section 40 series, section 44 series, all of them will be covered in today's revision. Okay, first we will discuss section 35, scientific research expenditure. Like if you incur any expenditure for the purpose of scientific research, then that expenditure is also allowed as deduction under PGBP under section 35. Scientific research expenditure is classified into two types: in-house scientific research expenditure, contributions or donations. That means within your company, if you do scientific research, that will be called as in-house scientific research expenditure. Like if you cannot do scientific research on your own, even if you give any donation to research association, even that is also allowed as deduction. First, I will discuss about in-house scientific research expenditure. In-house scientific research expenditure is allowed only if you do scientific research with regard to your own business. Let's say I am into business of manufacturing of cement. With regard to cement, if I do any scientific research, that scientific research expenditure is allowed as deduction. I am into cement manufacturing business, but I did research on laptops. That scientific research expenditure will not be allowed as deduction. That means whatever the scientific research expenditure that you are incurring, it should be in the same nature of business which you are doing, then only it is allowed as deduction. Now, in-house scientific research expenditure, like whatever the scientific research expenditure that is incurred before commencement of business, even that is also allowed as deduction. And after commencement of business, if you incur scientific research expenditure, that is also allowed as deduction. So sir, how much period? Let's say today you are commencing business. Before 3 years, that means from today, in last 3 years, whatever the scientific research expenditure that you have incurred, that scientific research expenditure will be allowed as deduction. That scientific research expenditure can be revenue expenditure and capital expenditure. So like before commencement of business, revenue expenditure includes salaries, material cost, but like only normal salaries will be considered as revenue expenditure before commencement of business. Whatever the perquisites given to employee are there, they will not be treated as revenue expenditure before commencement of business. Next, before commencement of business, for scientific research purpose, you purchased a building. Even that building is a capital expenditure. Now, that capital expenditure is also allowed as deduction. Except land, other than land, remaining capital expenditure will be allowed as deduction. The point is, before commencement of business, whatever the revenue expenditure and capital expenditure that you have incurred, all of that expenditure will be allowed as deduction in the year in which you commenced the business. Are you able to understand? But maximum 3 years before commencement of business, whatever the revenue expenditure and capital expenditure that you have incurred, that will be allowed as deduction in the year of commencement of business. Once business is commenced, once business is started, after commencement of business, like all revenue expenses and all capital expenses other than land will be allowed as deduction. Are you able to understand? Land it's a capital expenditure, but land is not a depreciable asset. Now, so whatever the capital expenditure on land is there, that is not allowed as deduction under section 35. Not only in-house scientific research expenditure, if you give any donation or if you give any contribution to approved research association or approved university, then whatever the donation, whatever the contribution that you have given to approved research association, either for scientific research or for social research or for statistical research is there, even that expenditure is also allowed as deduction. The point here is only to approved research association, approved college, approved university, if you give donation, then only such donation will be allowed as deduction. Otherwise, such donation will not be allowed as deduction. Are you able to understand? Whatever the donation that you are giving, let's say you are giving donation to one research association, that research association need not be in the nature of your business. Let's say you are doing a business with regard to manufacturing of cement. You gave donation to research association who is doing research in laptops. Still, whatever the donation that you have given, that is allowed as deduction. Are you able to understand? But whatever contribution donation given to approved association, approved university, approved college is there for scientific research, social research, statistical research, that donation is allowed as deduction only under optional tax rates. If SSC is paying taxes under default tax rates, whatever the contribution or donation given to approved association or university is there for scientific research, social research or statistical research, that will not be allowed as. Is it clear? Sale of scientific research asset. See, once you purchase any asset for the purpose of scientific research, then 100% of the expenditure is allowed as deduction under PGBP. For example, in 23-24, like let's say you purchase a laptop for scientific research for rupees 1 lakh rupees. Now what you will do in 23-24 P&L account, total 1 lakh rupees you will claim as deduction in P&L account. Am I correct or not? Now in 24-25 you sold laptop. Okay, you have two options. Option 1, outright sale. Outright sale means what? Directly from scientific research department you will sell the laptop. In that case, whatever the sale proceeds that are received, out of sale proceeds received, to the extent of deduction claimed earlier, it will be credited to P&L account. Balance it will be treated as capital gains. Let's say on outright sale you sold for 1,30,000 rupees. Out of 1,30,000 rupees, what is the deduction claimed earlier? 1 lakh rupees. It will be credited to P&L account. Balance 30,000, it will be treated as capital gains. Are you able to understand? Next, in second case, what you are doing, you are not selling the scientific research asset directly from research department. Okay, scientific research department. What you are doing, you are bringing that asset to normal business, and in normal business you are using it, later on you are selling it. Here laptop is purchased for scientific research. That laptop, it got outdated. So what you have done, laptop you have shifted from scientific research department to accounts department. In accounts department you are using the laptop. Whenever you bring the laptop from scientific research to normal department, in normal department there will be block of assets. Now laptop will be added to plant and machinery 40% block. Okay, only count increases, but it is added at value 0 rupees. Are you able to understand? So whenever it is brought to normal department, in that case it will be added to block of assets, it will be added at 0 rupees. Only count number in the block will increase, and subsequently whenever you sell the laptop, sale value of the laptop will be reduced from written down value of the block. Are you able to understand? That is the time. Stunt present, sir. Stunt, welcome. Good evening, Sinduri. Now, section 35 AD, specified business. There are list of 14 businesses here. If you start these 14 businesses, in those 14 businesses, whatever the revenue expenditure and capital expenditure that you have incurred, total expenditure will be allowed as deduction under section 35 AD. Are you able to understand? Generally, in PGBP, revenue expenditure will be allowed as deduction in P&L account. Capital expenditure will not be allowed. But if you start these 14 businesses, okay, like hotel of 2-star or above category, hospital containing 100 patient beds, warehousing facility for storage of agricultural produce, warehousing facility for storage of sugar. These list of 14 businesses are there. We have discussed in class. So these, if you start these 14 businesses, in these 14 businesses, whatever the expenditure that you have incurred, whether it is revenue expenditure or capital expenditure, 100% of the expenditure will be allowed as deduction under section 35 AD. Are you able to understand? Now, before commencement of this business, let's say I wanted to start a hotel. Before starting the hotel, I incurred certain expenditure for building the hotel. Even before commencement of business also, whatever the expenditure incurred for specified business is there, whether it is revenue expenditure or capital expenditure, 100% of the expenditure is allowed as deduction in the year of commencement of business. I wanted to start 2-star hotel. In 2021-22, I started construction. In 24-25, construction completed. In 24-25, I started the hotel. From 21-22 to 24-25, whatever the hotel construction expenditure that I have incurred, total expenditure will be allowed as deduction in 24-25. Are you able to understand? 3 years time limit is not applicable. In scientific research expenditure, 3 years time limit is there. Na? That time limit is not applicable for specified business. So from 21-22 to 24-25, whatever the capital expenditure that I have incurred, total expenditure will be allowed as deduction in P&L account. Okay, but the only condition is whatever the capital expenditure that I have incurred, all that capital expenditure should be capitalized in the books of accounts. Are you able to understand? After commencement of business, whatever the expenditure incurred, again revenue expenditure, capital expenditure, 100% of the expenditure will be allowed as deduction except these three assets: land, goodwill, financial assets. Land is not a depreciable asset, so even though land expenditure on land is capital expenditure, it is not allowed as deduction. On goodwill, no depreciation will be calculated, so like goodwill expenditure will not be allowed. Financial assets, they are not relating to business now, so that's why expenditure on financial assets, that is also not allowed as deduction in P&L account. Yeah, capital expenditure before commencement. This point we have discussed it. Now, even before commencement of business also, if you incur any capital expenditure, 100% of the capital expenditure will be allowed as deduction in P&L account. Next, deduction under section 35 AD, it is available only under optional tax rates. If SSE is paying taxes under default tax rates, deduction under section 35 AD is not available. Next, specified business loss can be set off only against specified business profits. Specified business loss cannot be set off against non-specified business profits. So let's say hotel is there. In 24-25, I started hotel. So in that hotel, whatever the loss is there, that loss I can set off only against specified business profits. Even though opposite specified business is not eligible for deduction under section 35 AD. Sir, what do you mean by this, sir? In previous year, 2004-5, I started one hotel. In that hotel, there is profit 24-25, profit is 80 lakhs. In 23-24, I started a hotel. There is loss of 45 lakhs. Now, whatever the hotel that I started in 4-5 is there, it is specified business. But is it eligible for deduction under section 35 AD? No. Whatever the hotel I started in 23-24 is there, it is specified business. It is also eligible for deduction under section 35 AD. Now the question is whether this loss can be set off against this profit. Yes, it is possible. That means what? If both are specified businesses, sufficient. Even though later business is not eligible for deduction under section 35 AD, still losses of one specified business can be set off against profits of another specified business. Are you able to understand? Next, when you are incurring revenue expenditure or capital expenditure per person per day, if you are making payment, you should make payment by way of bank transaction. If you make cash payment, then that expenditure will not be allowed as deduction. Okay. Conditions for claiming deduction under section 35 AD. See, if you want to claim deduction under section 35 AD, whatever the business that you are starting, hotel, warehousing facility, cold storage facility, all these should be new businesses. Let's say in 1995, one hotel started. I acquired that hotel by way of amalgamation. So through amalgamation or reconstruction, if you acquire any business, then that business is not eligible for deduction under section 35 AD. Only if you start a new business, then only 35 AD deduction is available. Next, specified business, uh, like whatever the plant and machinery that you purchase for specified business is there, out of total plant and machinery, 20% of the plant and machinery can be second hand plant and machinery. That means 80% of the plant and machinery should be a new plant and machinery, 20% can be second hand plant and machinery. Next, if you import any plant and machinery from outside India, even though it is second hand, it will be treated as first hand plant and machinery, subject to the condition on that plant and machinery no depreciation should be allowed in India previously. Are you able to understand? Then even though it is second hand plant and machinery, it will be treated as first hand plant and machinery. Next, once you claim deduction under section 35 AD, again you cannot claim deduction under section 80 QQB, 80 RRB, 80 JJAA. That benefit is not available. That means what? If you claim deduction under section 35 AD, again for you deduction under section 80 JJAA is not available, because those deductions are deductions in respect of certain incomes. So either you claim deduction under section 35 AD or you claim deduction in respect of certain incomes. Both are not possible. Next, once you claim any deduction under section 35 AD, double deduction is not possible in any other section, of Income Tax Act. Now, see, whenever you, let's say I started hotel business. In hotel business, I purchased 20 air conditioners. Total 20 air conditioners I will claim as deduction in first previous year. Now, I should use those 20 air conditioners in my business. If I sell those assets, whatever the sale proceeds that are received, those are treated as income in the P&L account. Are you able to understand? Now, I am having two businesses, hotel business, education business. I purchased 20 air conditioners in hotel business. Now, out of 20 air conditioners, 6 air conditioners I transferred from hotel business to education business. So, lock-in period is 8 years. When you purchase any capital asset, when you incur any capital expenditure for specified business, then that asset should not be transferred to non-specified business for a period of 8 years. Within 8 years, if you transfer any asset, okay, to non-specified business, then whatever the deduction that you have claimed earlier, that will be reversed and it is taxable as income in P&L account, and the date on which you are transferring it to non-specified business, till that period accumulated depreciation will be allowed as deduction. Okay. Section 35D, amortization of preliminary expenses. See, before starting any business, you will incur pre-incorporation expenditure. It is also called as preliminary expenditure. Whatever the preliminary expenditure that you have incurred, that preliminary expenditure is allowed as deduction under section 35D. But the benefit of preliminary expenditure is available only for Indian companies or resident Indians. For non-residents or foreign company, deduction under section 35D is not available. Are you able to understand? Now, whatever the preliminary expenditure that you have incurred, 100% of the preliminary expenditure is not allowed as deduction. So, what happened? In case of Indian company, in case of resident non-corporate SSC. First, I will explain resident non-corporate SSC. Whatever the preliminary expenditure that you have incurred, actual preliminary expenditure or 5% of cost of project, whichever is lower will be allowed as preliminary expenditure deduction. Whichever is lower is allowed as deduction. Even this is also not allowed as deduction in a single year. This is allowed as deduction over a period of 5 years. Allowed as deduction over 5 years in 5 equal installments. Are you able to understand? So you can see 5% of cost of project or actual preliminary expenditure, whichever is lower will be allowed as deduction. Even that allowed deduction, it is not allowed in a single year. It is allowed as deduction over a period of 5 years in 5 equal installments. In case of Indian company, preliminary expenditure is allowed as deduction in 3 steps. Step 1, 5% of cost of project or 5% of capital employed, whichever is higher you need to take. Step 2, actual preliminary expenditure. Step 3, allowable preliminary expenditure is equal to step 1 or step 2, whichever is lower. Whatever the allowable preliminary expenditure is there, that is allowed as deduction over a period of 5 years in 5 equal installments. Are you able to understand? Section 35 DDA, amortization of VRS expenditure. That means voluntary retirement scheme compensation. So if you incur any VRS expenditure, voluntary retirement scheme expenditure, generally you know, like employees take voluntary retirement, then they will go out of the organization. It is income to employee, expenditure to employer. So whatever the voluntary retirement scheme compensation expenditure is there, that is allowed as deduction over a period of 5 years in 5 equal installments, and VRS compensation expenditure is allowed as deduction purely on cash basis. It is not allowed as deduction on accrual basis. Whenever employer actually pays VRS compensation expenditure, then only VRS compensation expenditure will be allowed as deduction, that too over a period of 5 years in 5 equal installments. Next, deductions under section 36. Now, we will start with deductions under section 36. PGBP is such a big head. Revision itself will take hours. Now, section 36(1). Whatever the insurance premium is there, either for inputs or outputs. Inputs means raw materials, outputs means finished goods. So whatever the stock insurance that you have taken, 100% of the stock insurance is allowed as business expenditure. Similarly, if you incur any insurance for your building, that is allowed as deduction under section 30. If you take any insurance policy for plant and machinery, that is allowed as expenditure under section 31. Stock insurance expenditure, that is allowed as deduction under section 36(1). Next, for employees, employer has taken a medical insurance policy. Whatever the medical insurance premium paid by employer to employee is there, that employer on the name of employee is there, that is business expenditure to employer, and it is allowed as deduction under section 35 AD. Next, Life insurance premium paid by employer to employee, that is not allowed as deduction under section 36(1) but allowed as deduction under section 37. Okay, next, bonus or commission. See, bonus or commission, they are allowed as deduction only on cash basis. We will discuss 43B. In 43B, it is very clear. Bonus expenditure, commission expenditure, either paid to employees or directors, it is allowed as deduction strictly on cash basis. Okay. Interest on borrowed capital. If you borrow any money for the purpose of your business, why the purpose why you have borrowed the money, whether for revenue expenses or whether to purchase any asset, that is irrelevant. Whenever you borrow any money for your business, on borrowed money, if you pay any interest, such interest is allowed as deduction. The only condition is borrowed money should be used for business purpose. It should not be used for personal purpose. If you use borrowed money for personal purpose, then whatever the interest is there now, that is not allowed as business expenditure. Are you able to understand? Next, in case of sole proprietor business, whatever the interest paid on sole proprietor's capital is there, that is not allowed as deduction. Next, next, SSC must have borrowed money. Borrowed money should have been used for business or profession. Interest is paid or payable. That means what? Section 43B is applicable. Whenever you borrow loan from banks, scheduled banks, financial institutions, then you need to pay interest. Then only it is allowed as deduction. It is not allowed as deduction on accrual basis. If you borrow any loan from your relatives, then interest paid to relatives is there. That is also allowed as business expenditure. But whatever the interest that you have paid to relatives is there, on that section 40A2 is applicable. In case of genuine borrowings, let's say like during COVID, you borrowed money, even though rate of interest is high, even though you paid higher interest, that higher interest is also allowed as business expenditure. Okay. For capital asset, if you have taken any loan, then whatever the interest that is there from date of taking loan up to the date asset is put to use, that interest will be capitalized, added to the cost of the asset. After asset is put to use, whatever the interest cost is there, that interest cost will be debited to P&L. Okay. Discount on zero coupon bonds. See, zero coupon bonds are always issued at discount and are redeemed at par. Let's say zero coupon bond face value 100 rupees, but today they are issued for 60 rupees. How much is the discount? 40 rupees. That means seller is selling it at 60 rupees. After 5 years, it will be redeemed at 100 rupees. What is the margin? 40 rupees. It is expenditure to issuer and income to the buyer of zero coupon bonds. Whatever 40 rupees expenditure to issuer is there, that is allowed as deduction on pro rata basis. That means whatever the life of zero coupon bonds is there, over life of zero coupon bonds, 40 rupees is allowed as expenditure. Okay. Employer contribution to recognized provident fund and approved superannuation fund. See, as per provident fund rules, every month employer from his side, he is required to deposit 12% of PF in the name of employee, right? Whatever the employer contribution to recognized provident fund or superannuation fund is there, that is also allowed as business expenditure and it is allowed as next. Employer contribution to NPS, we have discussed deduction under section 80 CCD. So whatever employer contribution to NPS is there, that is also allowed as deduction, but subject to the condition maximum 14% of salary. If employer contribution is up to 14% of salary, allowed as business expenditure. If employer contribution is more than 14%, up to 14% allowed as business expenditure, balance it is not allowed as deduction. Employee contribution. See, what employer will do? Employer will take employee contribution and on behalf of employee, employer will deposit money with recognized provident fund. So whenever employer takes employee money, okay, it is to be credited to P&L account. Whatever the employee money that is deducted is there, this should be deposited to provident fund authorities before 15 of next month. If these are deposited, whenever money is deducted, it is recognized as income. Whenever this is deposited on time, it is allowed as business expenditure. Otherwise, it is not allowed as business expenditure. Are you able to understand? Deduction of animals used in business. See, whenever you purchase any animals which are used as assets in the business, okay. Now, whenever you purchase any animals, in the year of purchase, that animal expenditure is not allowed as deduction. When in the year animal becomes useless or animal dies, or whenever you sell the animal, in that year whatever the sale proceeds are there, from sale proceeds you will reduce cost of animal, whatever the difference is there, that is allowed as deduction in the year in which animal becomes useless or animal dies or animal is sold. So whenever any animals are used for business, let's say mine is event management company. I purchased two horses for the purpose of event management. Okay, so if any new marriage people comes, I will give horse cart to them. For that purpose, I purchased horses. Now horses are asset in my business, but whatever the expenditure on horses is there, that is not allowed as deduction in the year of purchase. It is allowed as deduction in the year in which horse becomes useless or in the year in which horse is sold. Okay. Next, bad debts. Now, see, bad debts are allowed as business expenditure subject to satisfaction of two conditions. First of all, you should have recognized that amount as sales earlier. Let's say I have done credit sales. I recognized income, but debtor did not make payment to me. Then that is allowed as whatever the amount that I could not receive from debtor is there, that is allowed as business expenditure. That means to recognize bad debts as deduction, whatever the bad debt amount is there, that should be recognized as income in earlier years. Are you able to understand? So it should be incidental to business or profession. It should have been taken into account in computing income of the SSC in previous year. Such bad debt is written off in any earlier previous year. Two conditions. First of all, it should be recognized in earlier previous years. Second condition, in accounts, it should have been written off. Then only under income tax also bad debts is allowed as business expenditure. Next, like I took personal, like my friend asked me 10,000 rupees. I gave. My friend did not pay me back. That is not allowed as bad debts. That means personal nature of bad debts are not allowed as deduction. Only business nature of bad debts are allowed. That too, they should have been recognized as income in earlier years. Then only allowed as deduction. Otherwise, not allowed as deduction. Next, provision for bad debts not allowed as deduction. Only actual bad debts are allowed as deduction. Next, bad debts must be revenue in nature. So if there are capital nature of bad debts, they are also not allowed as deduction. Debts of a discontinued business not deductible. Next, like in current year, I claimed bad debts. Later, there is recovery of bad debts. Recovery of bad debts is taxable as deemed profits in the year in which I get back the bad there is recovery of bad debts. Okay. Next, deduction of family planning expense. See, whatever the family planning expenditure is there, even though it is not business expenditure, still it is allowed as deduction under Income Tax Act. If family planning expenditure is of revenue nature, completely allowed as deduction. But if family planning expenditure is of capital nature, it is allowed as deduction over a period of 5 years in 5 equal installments. Another important point, family planning expenditure is allowed as reduction only for company SSCs. If SSC is other than company, family planning expenditure is to be disallowed. Next, if there is any unabsorbed capital expenditure on family planning, then the tax treatment is same as that of unabsorbed depreciation. Next, securities transaction tax, commodities transaction tax. See, if I hold securities as stock in trade, then whatever securities transaction tax that I have paid, it is allowed as business expenditure. If I hold securities as capital asset, then securities transaction tax is not allowed as transfer expenses. Same is the concept with commodities transaction tax. So whatever commodities transaction tax is there, like if I purchase commodities other than agricultural commodities as a capital asset, then commodities transaction tax is not allowed as transfer expenditure. If my main business is buying and selling of commodities, then they will be treated as stock in trade. Whatever the commodities transaction tax is there, then it is allowed as business expenditure. Okay. Sir Sambar from Guntur. Next, section 37, general deduction. See, any expenditure which is not allowed as deduction under section 30 to 36. Remaining all expenses are allowed as deduction under section 37. But some conditions are there. Any expenditure which is not allowed under section 30 to 36, only remaining expenses will be allowed as deduction under section 37. Because if any expenditure is already allowed under earlier sections, then there is no point. They are allowed as deduction as per respective sections only. Next, only revenue expenditure is allowed as deduction under section 37. Capital nature of expenditure is not allowed as deduction under section 37. Next, personal nature of expenditure, revenue expenditure, not allowed as deduction. Only business expenditure will be allowed as deduction under section 37. Expenditure should have been incurred wholly and exclusively for the purpose of business. Next, if you pay any penalty, penalty is not allowed as business expenditure. Explanation 1 to section 37. See, for any offense, if you pay any penalty, that penalty is not allowed as deduction. However, if penalty is in the nature of compensation, then that penalty will be allowed as deduction. Next, CSR expenditure. If you incur any CSR expenditure, that CSR expenditure is also not allowed as deduction under section 37. As per section 135 of Companies Act 2013, you need to incur CSR expenditure. Whatever the CSR expenditure that you have incurred, that CSR expenditure is not allowed as deduction under section 37. Next, expenditure incurred by SSE by an advertisement in any souvenir. See, whatever the advertisement incurred in any political party journal, political party pamphlet or souvenir or political party calendar is there, that advertisement expenditure itself will be treated as donation to political party. It is not allowed as business expenditure under section 37. It is allowed as deduction under section 80 GGB. Okay. So with this, like these are various examples. You can just go through these examples relating to section 37. Next, expenses not deductible under PGBP. Now we will start with section 40 series. First, section 40A1. We have already discussed. As per section 40A1, payer, any person who is required to deduct TDS. Payee should be either non-resident or foreign company. Payer, at the time of making payment to payee, payer is required to satisfy two conditions. Condition 1, payer is required to deduct TDS, and the TDS is required to be deducted on or before 31st March of previous year. Whatever the TDS that is deducted is there, deducted TDS is required to be deposited to government. Deposited to government on or before ITR due date. Only whenever these two conditions are satisfied, then only 100% of the expenditure is allowed as deduction. Otherwise, 100% of the expenditure will not be allowed as deduction. Sir, is it forever disallowed? No, it is not forever disallowed. In future, with regard to this transaction, whenever both the conditions are satisfied, in that year, again they will be allowed as deduction. Are you able to understand? 40A1A is same. As per 40A1A, payer should be payer must be any person who is required to deduct TDS. But as per 40A1A, payee should be non-resident. So, payer at the time of making payment to non-resident, payer is required to deduct TDS. Deducted TDS is required to be deposited to government. Then only it is allowed as expenditure. Otherwise, it is not allowed as expenditure. It is not allowed as. Are you able to understand? Otherwise, 30% of the expenditure will be disallowed. So, anyone who is resident in India at the time of making payment, if they are required to deduct TDS, they should deduct TDS before 31st March of previous year. Deducted TDS should be deposited to government on or before ITR due date. Whenever these two conditions are satisfied, 100% of the expenditure is allowed. Otherwise, 30% of the expenditure will be disallowed. Are you able to understand? 30% of the expenditure is will not be disallowed forever. Again in future, whenever both the conditions are satisfied, in that year again they will be allowed as deduction. Next, this point also I have discussed in regular class. I have also discussed in booster series. Now, let's say audit fees is paid to me, but my client did not deduct TDS. Now, what happens? 30% of the audit fees is to be disallowed to the client. Whatever 30% of audit fees that is to be disallowed is there, that will not be disallowed. It will be allowed as deduction when four conditions are satisfied. My client gave me audit fees. Now, I should disclose audit fees in my ITR. I should pay tax on the ITR. Are you able to understand? So I should pay tax on the audit fees received from client. Are you able to understand? And I should file my income tax return. That means payee should file income tax return. Payee should disclose income received from payer in the income tax return. Payee should pay tax on that income, and these three conditions are satisfied. A chartered accountant should give certificate that these three conditions are satisfied. If all the four conditions are satisfied, even though 30% of the expenditure is to be disallowed, still it will be allowed as deduction. Okay. Next. Section 40B, assessment of partnership form including LLP. What do you mean by this? What this section is all about, we have already discussed. In case of partnership firm, share of profit received by partner from a partnership firm is not taxable in the hands of partner. It is fully exempt in the hands of partner. Similarly, if any interest remuneration received by partner from partnership firm is there, such interest and remuneration is taxable under the head PGBP to the partner. Now, interest and remuneration is income to partner. It is expenditure to partnership firm. Now, such expenditure is allowed as deduction subject to satisfaction of some conditions. Sir, what are those conditions? First, I will explain conditions with regard to. Now, whatever interest on partner's capital, remuneration to partner's capital is there, these two are allowed as deduction only as per partnership deed. Only if partnership deed authorizes, then only as per partnership deed, interest on partner's capital and remuneration on partners, whatever is there, that is allowed as business expenditure. Otherwise, it is not allowed. Next, interest on partner's capital, remuneration to partners allowed as deduction only on prospective basis. That means the date on which amendment is made in partnership deed. From that date, whatever the interest and remuneration is there, only that interest and remuneration will be allowed as deduction. Third condition. Total interest is not allowed as deduction. Maximum interest allowed is 12% simple interest. Let's say 18% interest is paid to partners. Out of 18% interest, only 12% interest is allowed as expenditure in income tax P&L account. Balance 6% interest is to be disallowed. Okay. Next, if any interest is paid to, like interest paid to both working partners and sleeping partners is allowed as deduction, but whatever the remuneration paid to sleeping partner is there, that is not allowed as deduction. Whatever the remuneration is there, total remuneration is not allowed as deduction. Actual remuneration paid to working partners or remuneration based on book profits, whichever is lower will be allowed as deduction. So remuneration allowed is equal to actual remuneration paid to working partners or remuneration based on book profits, whichever is lower will be allowed as. Now the point is how to calculate remuneration based on book profits. Calculation was given. First you will calculate book profits. If there are no book profits, maximum remuneration allowed for all working partners is 3 lakhs. If there are book profits, if book profits are up to 6 lakh rupees, then maximum remuneration allowed is equal to 90% of book profits or 3 lakhs, whichever is higher. If book profits are greater than 6 lakhs, up to 6 lakhs, 90% of book profits or 3 lakhs, whichever is higher. On balance book profits, 60% of book profits will be allowed as remuneration to partners. How to calculate book profits? Very simple. You will take net profit as per accounts and you will add back remuneration. After adding back remuneration, you will do PGBP adjustments. Thereby you will arrive at net profit before remuneration and after PGBP adjustments. That is called as book profits. From book profits, if you reduce actual remuneration allowed, you are going to arrive at net profit as per income tax. Okay. Next, 40A2. These days I am taking continuous classes. That's why I need to keep myself hydrated. Next, section 48. What 48 says? If any excess payment or unreasonable payment made to relative or close associate is there, then that excess payment is not allowed as deduction. Excess payment is to be disallowed. Section 48 is applicable only in respect of expenditure. If you get any extra income from related person, that extra income is not required to be disallowed. Section 48 is applicable only in respect of expenditure. When you pay that expenditure to relative or close associate, then total expenditure is not to be disallowed. Whatever the excess expenditure is there, that is to be disallowed. Are you able to understand? So three conditions. First condition, yeah, condition number one, only in respect of expenses. That too, you should pay expenditure to relative or close associate. Third condition, total expenditure is not to be disallowed. Excess expenditure is to be. Sir, who is called a specified person? Because whatever the excess, like relative and close associate together we call as specified person. Whatever the excess payment made to specified person is there, that is to be disallowed. In case of individual, specified person means relative. Relative. Sir, who is called as relative? Here, 5 persons: spouse, brother, sister, lineal ascendant, lineal descendant. These 5 are considered as relative for the purpose of 40A2. So, whenever you make excess payment to these 5 persons, that is to be disallowed. Not only payment made to relative, if any payment is made to any person who, like any business in which either SSC or his relative is having substantial interest, for that business also, if any excess payment is made, that is not to be allowed as deduction, that is to be disallowed. Excess payment is to be disallowed. Next, in case of partnership firm, who is called as specified person? In case of partnership firm, partners are to be considered as specified persons. Any excess payment to partners, disallowed. Not only partners, relative of partners, if any excess payment is made to relative of partners, that is also to be disallowed. Not only relative of partners, any other business or profession, in which partnership firm, partner or relative of partner is having substantial interest. Relative of partner having substantial interest. Even they are also considered as specified person. For them, even if any excess expenditure is paid, that is to be disallowed. Next, in case of company, who are treated as specified persons? In case of company, first, directors are to be treated as specified persons. If any excess payment is made to directors, that is not to be allowed as deduction, that is to be disallowed. If any excess payment is made to relative of director, that is also to be disallowed. Not only director, not only relative of director, if there is any other business or profession in which either company or director or relative of director, if they are having substantial interest in that business, then for that business also, if any excess expenditure is paid, that is not allowed as deduction, that is to be allowed. Okay. Next, 40A3, this you already know. Per person per day, you should not make cash payment of more than 10,000 rupees. Per person per day, if you make cash payment of more than 10,000 rupees, then not a total expenditure. 100% of the expenditure is to be disallowed. Are you able to understand? So, per person per day, if you are making payment of more than 10,000 rupees, 100% of the expenditure is to be disallowed. Give me 1 second. Today, income tax bill was passed in Parliament. Amendment bill. Daily confusion is there, no certainty. So, as per 40A3, per person per day, if you make cash payment of more than 10,000 rupees, it is to be disallowed. 100% of the expenditure is to be disallowed. Now, you claimed any expenditure on accrual basis in 22-23, but in 23-24, you have made payment in cash, but you already claimed deduction in 22-23 now. So, if you claim any expenditure on accrual basis, Later on, when making payment, if you make payment in cash more than 10,000 rupees per person per day, then whatever the expenditure that you have claimed in earlier years is there, that will be reversed and it is taxable as income. Are you able to understand? So bearer check, crossed check. These two, if any payment is made by bearer check or crossed check, it will also be considered as cash payment. Okay. Next, 40A3 is applicable for each expenditure separately. Let's say today morning I paid rent to Mr. Srinivas 8,000 in cash. Today only I paid interest to Srinivas 6,000 in cash. Total payment made in cash is 14,000 rupees, but for two different expenses. For each expenditure, 10,000 limit is applicable separately. Are you able to understand? Next, there are exceptions to 40A3. These are not that much important. You can study on your own. 43B, very, very, very important. So there are 6 expenses. Amount payable to government, bonus or commission to employees or directors. Next, leave encashment expenditure to the employer. Next, employer contribution to provident fund, employer contribution to welfare contributions, any expenditure payable to Indian Railways. Similarly, if you take loan from any public financial institution, state financial corporation, industrial investment corporation, scheduled bank, cooperative bank, NBFC, then whatever the loan that is taken from these people is there now, on that loan you are required to pay interest. That interest is allowed as deduction as per section 43B. So there are 6 payments. For these 6 payments, if you make payment in current year, allowed as deduction in current year. If you make payment in next financial year, in next financial year before ITR due date, if you make payment, then it is allowed as deduction in current previous year. If you make payment in next financial year, that too after ITR due date, then it is allowed as deduction on cash basis. So to claim these 6 expenses, what are 6 expenses? Like leave encashment expenditure, any amount payable to government, taxes, duties and all. Next, employer contribution to welfare contributions, amount payable to Indian Railways, bonus or commission to employees or directors, interest on loan taken from financial institutions, scheduled bank, cooperative bank, NBFC. All these are allowed as deduction only if you pay in current previous year or if you pay in the next financial year but before ITR due date, then they are allowed as deduction in current previous year. Otherwise, they are allowed as deduction only on cash basis. Next, section 43BH. This is applicable to micro, small, medium enterprises. So whenever goods are sold on credit basis, we have to check whether there is agreement between supplier and buyer. If there is agreement between supplier and buyer, then like maximum credit period allowed is equal to agreement between supplier and buyer or 45 days, whichever is earlier. So credit period agreed or 45 days, whichever is earlier, that is the credit period allowed. So whatever the allowed credit period is there, within that allowed credit period, payment should be made. Then only that payment is allowed as deduction on accrual basis. Otherwise, such payment is not allowed as deduction on accrual basis. It is allowed on cash basis. Sir, if there is no agreement between buyer and seller, if there is no agreement between buyer and seller, then in that case, if there is no agreement, in that case, maximum credit period allowed is equal to 15 days from date of acceptance. That means today I did credit sale. Excluding today, in next 15 days, buyer should make payment to me. Only if buyer makes me payment, it is allowed as deduction to buyer. If buyer makes payment after 15 days, then it is not allowed as deduction to buyer. Are you able to understand? It is not allowed as deduction on accrual basis, but it is allowed as deduction on cash basis. Next, see, last some sections are there, 44AA, 44 AB, 44 AD, ADA and 44 AE. You can search my channel CA Umasankar Maganti. So I have done one series called Booster series. In this Booster series, you can see list. PGBP part 2 is there. So there are timestamps. Like if you want detailed explanation, you can go through these booster videos also. Okay. At any point of time, you got doubt about any particular section, you wanted more explanation about that particular section, then you can come to my channel. There is a playlist booster series. In those booster series, you can whatever the video that you wanted, you can pick it and you can watch. Now we will discuss 44 AA, 44 AB. 44 AA, maintenance of books of accounts. This section answers three questions. What are the books of accounts that are required to be maintained? Place where books of accounts are required to be maintained. Period for which books of accounts are to be maintained. First, last question. Sir, how much period books of accounts are required to be maintained? They are required to be maintained for 6 years from end of relevant assessment year. 6 years from end of assessment year. If you calculate from end of previous year, it is 7 years. Next, second question. Sir, place where books of accounts are required to be maintained. Generally, books of accounts are maintained at place of business or place of profession. If there are multiple places, then books of accounts will be maintained at principal place of business or profession. If there are also branch offices, then books of accounts relating to branch offices can be maintained at respective branch offices. Okay. Coming to the question, what are the books of accounts that are required to be maintained? For this, like person is classified into three categories: notified professionals, business SSCs, and non-notified professionals. Those who are paying taxes under 44 AD, 44 ADA, 44 AE. Okay. Now, notified professionals means what? Like chartered accountant, advocate, lawyer, and doctor, interior decorator, film artist, company secretary. All these will come under notified professionals. So first I will explain about business SSCs and non-notified professionals. So those who are engaged in business and those who are engaged in profession other than notified profession. Okay. They have two criteria: income criteria, turnover criteria. Conjunction is or. That means what? Out of income criteria, turnover criteria, if any criteria is satisfied, they are required to maintain minimum books of accounts. If income criteria is not satisfied, turnover criteria is also not satisfied, then they are not required to maintain any books of accounts. Sir, what is income criteria? So in case of like exclude current previous year, take last 3 previous years. In last 3 previous years, for any one of the previous year, if total income in case of individual or HUF, if it is more than 2,50,000, in case of other persons, if it is more than 1,20,000, then they are required to maintain minimum books of accounts. Okay. Minimum books of accounts means ledger and cash book. For example, in last 3 previous years, for any one of the previous year, like for all 3 previous years, total income is less than 2,50,000, or in case of other persons, total income is less than 1,20,000. Then income criteria is not satisfied. Then we will check turnover criteria. As per turnover criteria, exclude current previous year. Take last 3 previous years. In last 3 previous years, for any one of the previous year, you have to consider for any one of the previous year, if turnover is more than 25 lakhs. Okay. In case of individual or HUF, In case of any other person, if turnover is more than 10 lakhs, then they are required to maintain minimum books of accounts. Here it is not 2.5 lakhs, it is 25 lakhs. Okay. Otherwise, they are not required to maintain any books of accounts. Next, in case of notified professionals, ignore current year. Take last 3 years. In last 3 years, for each year, if gross receipts are more than 1,50,000, then they are required to maintain books of accounts as per Rule 6B. So, in last 3 years, for any one of the previous year, if gross receipts are less than 1,50,000, then they are required to maintain minimum books of accounts. Are you able to understand? Sir, what are books of accounts as per Rule 6F? I am sorry, it's not Rule 6B, it is Rule 6F. So, as per Rule 6F, they need to maintain cash book, ledger, journal, carbon copies of bills. That means if they make any payment for expenditure, if the value of payment is more than 25 rupees, they need to maintain a bill. And if they receive any amount, if value of amount received is more than 50 rupees, then they need to maintain receipt. And vouchers and bills, carbon copies, all these are required to be maintained. In case notified professional is doctor, then he is required to maintain opening and closing stock of inventories. See, with the doctor also there are medicines available now. So what is the opening stock and closing stock of each medicine? Those details are required to be maintained, and at the same time case register. So like whenever any patient comes to the doctor, case register will be written. That case register is also required to be maintained by medical professional. Next, 44AB tax audit. Very simple. A client came to you, then you will ask him, in your business, whatever the, first of all, turnover, if business turnover is less than 1 crore, tax audit is not required. If business turnover is more than 1 crore, then you will ask the client question, whatever the cash receipts in your business are there, if cash receipts are less than or equal to 5% of total receipts, and whatever the cash payments are there, if they are less than or equal to 5% of total payments, if both these conditions are satisfied, then up to 10 crore rupees tax audit is not required. Otherwise, tax audit is required to be done. Let's say a businessman came to you. His turnover less than 1 crore. No tax audit. Okay. Businessman came to you. His turnover is more than 1 crore. Then you need to ask a question. If cash receipts are less than or equal to 5% of total receipts, and if cash payments are less than or equal to 5% of total payments, if both these conditions are satisfied, then if both these conditions are satisfied, yes, then up to 10 crores, no tax audit. Otherwise, up to 1 crore only, there is no tax audit. Simple, turnover less than 1 crore, no tax audit is required. Turnover more than 1 crore, then you have to ask him, in your business, if cash receipts are less than or equal to 5% of total receipts. In your business, if cash payments are less than or equal to 5% of total payments. Both conditions satisfied, then up to 10 crores tax audit is not required. If any one of the conditions are not satisfied, if both conditions are not satisfied, then tax audit limit is only 1 crore. Up to 1 crore, no tax audit. If turnover crosses 1 crore, they are required to get. Okay. In case of profession, we will consider gross receipts. If gross receipts are up to 50 lakhs, no tax audit. If gross receipts are more than 50 lakhs, tax audit is required. under section 44A. Next 44AD, 44ADA, 44AE. See, 44 AD, 44 ADA, 44 AE, these three sections, you can listen here. Like 15 minutes explanation was given. Please listen in booster series because I am done for today. 44 AD, 44 ADA, 44 AE, they are simple only. Like till here, I have revised those three sections. Please listen in the booster series. Okay. Thank you very much. So yes, we will start. Today's topic is capital gains. Very, very important chapter from examination point of. You can expect one question from capital gains, which is for 7 marks. And in case study, in MCQs, case study based MCQs also a question can be interlinked with capital gains concept. So minimum you can expect 7 marks from. You cannot skip. This chapter will also continue in your CA final. So this is the chapter which is something how to learn. Okay. We will start. See what are the sections covered under the head capital gains. Section 45 to 55. These are the sections that are covered. What is the charging section? Charging section is section 45. Actually, charging section is section 45(1). Okay. What is the method of accounting followed under the head capital gains? Method of accounting followed is accrual basis. That means generally capital gains head gets attracted whenever you sell any capital asset. So the year in which you are selling the asset or the year in which you are transferring the asset, in that year you are required to calculate. Are you able to understand? See, for example, in 24-25, I sold my house, but buyer paid me consideration in 25-26. When I got money in 25-26, but capital gains are not applicable in 25-26. Capital gains are applicable in 24-25. So the year in which capital asset is transferred on accrual basis, capital gains are applicable. Are you able to understand? Method of accounting followed is accrual tax rate. Tax rates applicable are normal tax rates as well as special tax rates. You know, right? In capital gains, special tax rates are applicable. Long-term capital gain 112, 112A, short-term capital gain section 1A. For these sections, special tax rates are applicable, and there is also amendment in Finance Act number 2 of 2020. So before 23rd July, one tax rate is there. After 23rd July, another tax rate is there. Tax rates are changed. So with regard to that amendment, question is asked in May 2025 examination. I am super expecting question will also be asked in September 2025 examination. Lecture duration, it will be till 12 p.m. or 12 or 12:50. 2 hours. So accrual basis except section 45(1)(a), 45(2), 45(5) that we will discuss little later. 45(1)(a) means uh, loss or damage or destruction of capital asset. 45(2) is conversion of capital asset into stock in trade. 45(5) is compulsory acquisition of capital asset. In all those cases, accrual basis is applicable. The year in which you get money, that year capital gains are taxable. Next. See, there is charging section, section 45(1). Charging section 45(1) prescribes two conditions. Condition 1, asset must be a capital asset. Condition 2, transaction must be a transfer. The conjunction is and. Only if these two conditions are satisfied, then only capital gains will get attracted, otherwise capital gains will not get attracted. Let's say I'm having watch with me. I sold watch. If watch is capital asset, then capital gains tax is applicable. If watch is not a capital asset, watch is a personal effect, on sale of watch I am not required to calculate capital gain. So charging section clearly says two conditions: asset should be a capital asset, and whatever the transaction is there, transaction should be a transfer. Only if these two conditions are satisfied, then only capital gains are required to be calculated, otherwise capital gains are not required to be calculated. So like most of our discussion will be with regard to capital asset. Asset must be a capital asset, transaction must be a transfer. What do you mean by capital asset? Capital asset definition have some inclusions as well as some exclusions. What is important is exclusions to definition of capital asset. See, capital asset includes all assets, whether asset is movable asset or immovable asset, tangible asset or intangible asset, whether asset is used for business or whether asset is used for personal purpose. Very simple. Every asset is capital asset except those assets which are excluded from definition of capital asset. Are you able to understand? So every asset we will treat as capital asset other than those which are excluded from definition of capital asset. So very clear, every asset is a capital asset. What are exclusions? Exclusions to definition of capital asset. Stock in trade is excluded from definition of capital asset. Why? Stock in trade is already taxable under PGBP. If stock in trade is not excluded, then stock in trade will also get taxed under capital gains. So stock in trade will get taxed under PGBP. It will also get taxed under capital gains. It will lead to double taxation. To avoid double taxation, whatever stock in trade is there, it is excluded from definition of capital asset. So on sale of stock in trade, only PGBP head gets attracted, capital gains head will not get attracted, and it is taxed only once. Are you able to understand? Personal effects. Sir, what do you mean by personal effects? To call any asset as personal effect, three conditions are required to be satisfied. Condition 1, it must be a movable asset other than security. Movable asset other than security. Second, it should be used for personal purpose. Personal purpose by SSC or his family members. Third condition, excludes, personal effect excludes jewelry, drawing, painting, sculpture, archaeological collection, any other work of art. These three are excluded from definition of personal effect. So let's say I am having my own building. So building is owned by me. So I am the owner of the building. Even though I am using building for my residential purpose, still I cannot call building as personal effect, because to call any asset as personal effect, it should be a movable property. So immovable property, even though used for personal purpose, it is not personal effect, it is a capital asset. Similarly, I purchased Reliance company shares. Whenever I purchase Reliance company shares, shares are movable asset only. Okay, so but after like personal effect definition, what it says, personal effect means any movable asset other than securities. So whatever shares and securities are there, even though you purchased them for personal purpose, they are not personal effect, they will be treated as capital assets. Are you able to understand? So to call an asset as personal effect, first it should be a movable asset, it should not be a security. Second, it should be used for personal purposes of SSC or his family members. Third, whatever the movable asset is there, okay, that movable asset should not be a jewelry, should not be a drawing, should not be a painting, should not be a sculpture, archaeological collection, work of art. That means what? All these things, even though purchased for personal purpose, still they are not personal effect, they will be treated as capital asset. Are you able to understand? So what personal effect means? Three conditions. To call any asset as personal effect, first of all, it should be a movable asset, it should not be a security. That means immovable asset is always personal effect. I sold my land which I am using for my personal purpose. Still, it is a capital asset. On sale of land, I am required to calculate capital gains. I sold shares and securities. Even though they are movable asset, they are not personal effect. You are required to calculate capital gain. Let's say I sold my shoes. Shoes are like use movable asset. Shoes are used for personal purpose. Shoes are not a jewelry, drawing, painting, sculpture, archaeological collection. So whenever I sell shoe, if I make any profit on that profit, I am not required to pay any tax. Are you able to understand? Because shoe is a personal effect. So to call asset, if asset is personal effect, then capital gains will not arise. If asset is not a personal effect, then it will be treated as capital asset. Once it is treated as capital asset, capital gains will arise. So to call any asset as personal effect, first of all, that asset should be a movable asset. It should not be a security. It should not be a immovable asset. Next, that movable asset should be used for personal purposes of SSC, and movable asset should not be jewelry, drawing, painting, sculpture, archaeological collection, work of art. Are you able to understand? So that we call as personal effect. Any asset, if it is personal effect, then no capital gains will arise. On transfer of personal effect, no capital gains will arise. If asset is not a personal effect, then it will be treated as capital asset. On transfer of such capital asset, capital gains will be able to understand. Next, rural agricultural land is also excluded from definition of capitalism. So, like on sale of agricultural land, you have to determine whether this agricultural land is urban agricultural land or rural agricultural land. If agricultural land sold is urban agricultural land, then it is capital asset, capital gains will arise. Okay. If if rural agricultural land is sold, then it is not a capital asset, capital gains will not. So very simple thing, whatever the agricultural land that you are selling, on sale of such agricultural land, generally capital gains are required to be paid. Okay, tax is required to be paid on capital gains. But you need to check whatever the agricultural land that you have sold, whether it is urban agricultural land or rural agricultural land. Whatever the agricultural land that you are selling, if it is urban agricultural land, it is a capital asset. On sale of such agricultural land, you are required to calculate capital gains and you are required to pay tax on capital gains. Second case, whatever the agricultural land that you are selling, if it is rural agricultural land, on sale of rural agricultural land, you are not required to calculate capital gains because rural agriculture is a capital asset. Are you able to understand? Now, sir, how to tell whether agricultural land is urban agricultural land or rural agricultural land? So, criteria is there. If population in a place, if population in town, village or city, if it is less than or equal to 10,000, in that area, in that village, if you have any agricultural land, then it is considered as rural agricultural land only. Are you able to understand? If population in place is more than 10,000 and up to 1 lakh, then whatever that area, municipal area is there, along with that municipal area, 2 kilometers from local limits of municipality will be treated as uh, you know urban area. Outside that, if there is any agriculture land, that we call as rural agriculture land. I will tell one example. Let's say here population is more than 10,000 up to 1 lakh. Now 2 kilometers, 2 kilometers, that means what? Whatever the population is there, see, this is specified area. If agricultural land is there within specified area, then we call it as urban agricultural land. If agricultural land is there outside specified area, then we call it as rural agricultural land. Are you able to understand? So very simple. If population in a place is less than 10,000, in that village, whatever the agricultural land that you are having, it is rural agricultural land. If population in a place is more than 10,000 and up to 1 lakh, in that case, whatever that municipality is there, that municipality is urban area. Along with that municipality, 2 kilometers from the end of the municipality is also treated as urban area. Within that urban area, if you have agricultural land, that is urban agricultural land. Outside that, that means after 2 kilometers from end of municipality, if you have any agricultural land, that agricultural land we call as rural agricultural land. Are you able to understand? Next, case 2. Now I am changing little bit of details. If population in a place is more than 1 lakh up to 10 lakh, then this is specified area. Along with this, whatever 6 kilometers from the end of the municipality is there, 6 kilometers from the end of the municipality, even this area is also considered as specified area or urban area. Are you able to understand? Vijayawada is there. In Vijayawada, population is, let's say, 8 lakh population. Actually, it is more than 10 lakhs only, but let us assume in Vijayawada population is 8 lakhs. Now entire Vijayawada is urban area. Along with Vijayawada jurisdiction, from end of Vijayawada jurisdiction, see, municipality will end at certain point, right? So from end of municipality, next 6 kilometers aerial distance, whatever the area is there, that area is also considered as urban area. So within urban area, if you have agricultural land, it is urban agricultural land. Outside urban area, if you have agricultural land, it is considered as rural agricultural land. Are you able to understand? Now, case 3. What case 3 says? Like if population is more than 10 lakhs, 8 kilometers from the end of the municipality, that will be treated as urban area. What do you mean by this? Hyderabad is there. Hyderabad population is 1 crore. That means Hyderabad population is more than 10 lakhs. So entire Hyderabad is urban area. From ending of Hyderabad, next 8 kilometers, whatever the municipality is, like whatever the 8 kilometers from end of municipality is there, even that is also considered as urban area. Within urban area, if you have agricultural land, that is urban agricultural land. Outside 8 kilometers, if you have any agricultural land, that will be considered as rural agricultural land. Are you able to understand? So very simple. Agricultural land located in urban area, urban agricultural land, it is a capital asset, you need to calculate capital gain. Agricultural land located outside urban area, outside urban area means rural area. So in rural area, if you have agricultural land, it is rural agricultural land. On sale of rural agricultural land, you are not required to calculate capital gains. Able to understand? So population in place less than or equal to 10,000, it is rural area. Population in a place more than 10,000 up to 1 lakh, that area is municipal area, urban area. Along with that area, 2 kilometers from the end of the municipality is also considered as urban area. Population in a place more than 1 lakh up to 10 lakh, that area is urban area. Along with that area, next 6 kilometers from end of municipality, it is also considered as urban area. Population in a place more than 10 lakhs, that area is urban area. Along with that, next 8 kilometers is also considered as urban area. Within urban area, if you have agriculture land, it is urban agriculture land. Outside, it is rural agriculture. Is it clear? Next, 6.5 gold bonds issued in 1977, 7% gold bonds issued in 1980, national defense bonds. See, these are all issued in 1977, 1980. These are not in existence. So from this, no question will come. This type of securities are not there in existence right now. Actually, these are to be removed from definition of capital asset. But as our act is very old, it was not removed. I hope in upcoming income tax bill, Income Tax Act 2026, they are going to remove these points. Next, deposit certificates issued under gold monetization scheme. See, whenever you subscribe to gold monetization scheme, what you will do, you will deposit your gold. After depositing your gold, you will get deposit certificate. See, just like when we deposit our money in fixed deposit, he will give fixed deposit certificate. Now, in the same way, when we deposit gold in gold monetization scheme, he will give that certificate, gold monetization certificate. So whatever the deposit certificate issued under gold monetization scheme, there, if I sell this deposit certificate, I am not required to calculate capital gains because deposit certificate is not a capital asset. Are you able to understand? Next, we will see the definition of transfer. So, did you understand the definition of capital asset? Comment. Sir, in capital asset definition, please ask. You did not. So, shall I proceed further with the definition of transfer? Everybody. Yeah, any securities held by foreign institutional investors. One small thing, my main business is buying and selling of shares. For me, whether shares are capital asset, no, shares are considered as stock in trade, correct? But in case of foreign institutional investor, even though his main business is buying and selling of shares, but if he purchases shares of Indian company, let's say Tesla Limited is there, it is also into stock market. Now, what Tesla Limited is doing, it is purchasing shares of Indian companies, it is selling shares of Indian companies, it is making money. Okay, now Tesla Limited, it is foreign institutional investor, it is buying and selling shares of Indian company. Its main business is buying and selling of shares. So, Indian company shares are, as per accounts, they will be treated as stock in trade. But as per income tax, even though their main business is buying and selling of shares, still, whatever the Indian company shares and securities that are purchased by foreign institutional investor are there, they are not treated as shares, they will be treated as capitalists. Are you able to understand? So foreign institutional investor, if he buys shares and securities of Indian companies as part of their business, even though it's their regular trading, still they are not treated as stock in trade, they will be treated as capitalists. Okay. Next, we will discuss definition of transfer. Only if transaction is covered under the definition of transfer, then only capital gains will be calculated. Otherwise, capital gains will not be calculated. What do you mean by this? Let's say I gifted gold bracelet to my brother. On gift of gold bracelet, okay, gift transaction is excluded from definition of transfer. So in case of gift, I am not required to calculate capital gains. So if any transaction is covered under the definition of transfer, then only you are required to calculate capital gains, then only you are required to pay tax on capital gains. So if any transaction is not covered under the definition of transfer, then you will not calculate capital gains. Capital gain tax is not required to be paid. Are you able to understand? Now, we will see transfer definition have some inclusions, transfer definition also have some exclusions. So if any transaction is included in definition of transfer, we will calculate capital gains. Otherwise, we do not calculate. Are you able to understand? Transfer includes that transaction transfer includes sale. That means if you sell any capital asset, you are required to calculate capital gains. Not only selling, if you exchange your capital asset, even on exchange of capital asset, you are required to calculate capital gains. Let's say I transferred my building to Charan. Building transferred 60 lakhs worth of shares to me. That means I am exchanging my building with shares of Charan. Even this exchange transaction is also considered as transfer, and capital gains are required to be calculated. So exchange of capital asset. On exchange of capital asset, we are required to calculate capital gains. Next, relinquishment of rights in a capital asset. I took one building on lease for 10 years. Every year lease is every month lease is 50,000 rupees, and this 50,000 rupees will increase by 10% year on year. So next year lease rent is 50,000 plus 10%, 55,000. Second year lease rent is 55,000 plus 10%. In that way, lease rent will increase by 10% year on year. Are you able to understand? Now, I took one property on lease. Lease rent is 50,000 rupees. Immediately, Jagadish came to me. Jagadish came to me and told, "Sir, I want that premises. I will pay rent of 50,000 rupees. You took it on lease for 10 years. Now, I will pay 6 lakh rupees to you. Transfer those lease rights to me." So, what I have done, like I am lessee, I transferred lessee rights to Jagadish. So from tomorrow onwards, Jagadish is the lessee. Every month he will pay rent of 50,000 rupees. I will never, I will enjoy the benefit. I will take 6 lakhs. I will come out of the lease. So here what is happening? Whatever the lease rights that I am holding, that lease rights I am losing to Jagadish. So relinquishment means what? Giving up of right. So if I give up my lease rights to Jagadish and if I make profit of 6 lakh rupees, then in that case also I am required to calculate capital gains, because even relinquishment of capital asset is also treated as transfer. Relinquishment of right in capital asset is also treated as transfer. Next, extinguishment of capital asset. Extinguishment means what? Complete cancellation of capital asset. So destruction of capital asset. For example, like debentures were redeemed. There is redemption of debentures. I purchased debentures. 5 years duration is there. After 5 years, company redeemed the debentures. What do you mean by redemption? Like I gave back my debenture certificate, company gave me money. So once I give back my debenture certificate, that debenture certificate will be torn off. It will be cancelled. Even cancellation of capital asset, even destruction of capital asset, even extinguishment of capital asset is also considered as transfer. That's why extinguishment of capital asset. So if building gets collapsed, if we get insurance compensation, then also we are required to calculate capital gains, because even destruction of capital asset is also considered as transfer. Are you able to understand? So even extinguishment. Sir, what is difference between extinguishment and relinquishment? In case of relinquishment, asset will continue to exist. However, in case of extinguishment, asset will not continue to exist. Asset will be collapsed, or asset will be destructed, or asset will be cancelled. That is the difference between relinquishment and extinguishment. Even both relinquishment and extinguishment are treated as transfer, and capital gains are required to be calculated. Compulsory acquisition of capital asset by government. Whenever government do compulsory acquisition, that is also treated as transfer. We are required to calculate capital gains. Conversion of capital asset into stock in trade. What do you mean by this? Let's say I am having with me 50 kgs of gold. Please don't believe it as true. Okay, don't call income tax department. 50 kgs of gold is not there with me. Okay, it is just an example. Okay, so 50 kgs of gold is there with me. I thought I can start gold shop. I started gold shop. So whenever 50 kgs of gold is there in my house, it is like it is capital asset. But whenever that gold is moved into gold shop, it will be treated as stock in trade. Even conversion of capital asset into stock in trade is treated as transfer, and capital gains are required to be calculated. Are you able to understand? Redemption of zero coupon bonds. You know zero coupon bonds, right? They are always issued at a discount and are redeemed at par, redeemed at face value. So even redemption of zero coupon bonds is treated as transfer, and capital gains are required to be calculated. Transfer by way of part performance of contract. Section 53A of Transfer of Property Act. Yesterday in house property lecture, I have discussed with you deemed ownership concept. In that case, I told this case as well. Like there should be agreement between seller and buyer. Buyer has paid the consideration, or buyer is ready to pay the consideration. Buyer has taken the possession of the property. Buyer has taken the control of the property. If these three conditions are satisfied, even though on registration documents seller is the owner, still buyer will be considered as deemed owner of the house property. Do you remember that provision? So same, that provision, deemed ownership concept, is from buyer point of view. Under capital gains, we will think from seller point of view. So what seller point of view? If there is agreement between seller and buyer, if buyer has paid the consideration or buyer is ready to pay the consideration, and if buyer has taken the possession of the property, if all these three conditions are satisfied, even though on registration documents seller is the owner, still it will be deemed as seller has sold the house property or seller has sold the capital asset, and seller is required to calculate capital gains. That means what? You need not wait till actual registration. The moment these three conditions are satisfied, it will be deemed as transferred and capital gains are required to be calculated. Are you able to understand? So these are all inclusions to definition of transfer. Now, shall I explain exclusions to definition of transfer? Everybody, exclusions to definition of transfer. So I hope students are following. Please give comments as much as possible, so I feel it as lively. I can feel that I'm speaking with you. Next, exclusions to definition of transfer. If any transaction is excluded from definition of transfer, on such exclusion, you are not required to calculate capital gains. For example, gift, will, inheritance. I got a building from my father. Transfer of building from father to son upon death of the father. Even there is transfer of property from one person to another person, transfer of property from father to son. Even though there is transfer of property, it is by way of inheritance. So by way of inheritance, if any property is transferred, capital gains are not required to be calculated. Why? Because inheritance is excluded from of transfer. So gift transaction, bill transaction, inheritance transaction. By these three ways, if you transfer any capital asset, capital gains are not required to be calculated because these three transactions are excluded from definition of transfer. Is it clear? Transfer of capital asset on total or partial partition of HUF. See, Hindu undivided family will get divided, right? Ambani family is there. In Ambani family, there are three children, Akash, Anant and Isha. So at some point of time, Ambani family will get separated. Whenever Hindu undivided family gets divided into small families, there will be transfer of capital assets from Hindu undivided family to small family. Such a transfer of capital assets is not treated as transfer and no capital gains are required to be calculated. Are you able to understand? Uh, Transfer of capital assets from holding company to subsidiary company. Let's say Reliance Limited is there, Jio Limited is there. Both are Indian companies. Reliance is Indian company, Jio is also Indian company, and Reliance Limited is having 100% shareholding in Jio Limited. Now, whatever the capital assets transferred from holding company to subsidiary company are there, or whatever the capital assets transferred from subsidiary company to holding company is there, this transfer of capital asset is not a transfer and no capital gains are required to be calculated. Are you able to understand? No capital. So very simple, transfer of capital asset from holding company to subsidiary company or subsidiary company to holding company. Not treated as transfer. No capital gains are required to be calculated subject to satisfaction of two conditions. What are those two conditions? Condition number one, holding company shall have 100% stake in subsidiary company. That means whatever subsidiary company is there, it is wholly owned subsidiary company. That is condition 1. Condition 2 is uh, condition 2 is recipient company should be an Indian company. Recipient company an If these two conditions are satisfied, transfer of capital assets from holding to subsidiary or subsidiary to holding, the transfer of capital assets is not treated as transfer and no capital gains are required to be calculated. Is it clear? Subject to satisfaction of two conditions. Holding company shall hold 100% stake in subsidiary company, and subsidiary company must be, like recipient company must be an Indian company. If these two conditions are satisfied, transfer of assets from holding to subsidiary or subsidiary to holding is not treated as transfer. Yeah. Vodafone Idea merged together. They formed a new company, VI. Now, there will be, at the time of amalgamation, there will be transfer of capital assets from amalgamating company to amalgamated company. This transfer of capital assets is not a transfer and no capital gains are required to be calculated, subject to the condition amalgamated company must be an Indian company. Is it clear? So you all know amalgamation. When during the course of amalgamation, capital assets will be transferred from amalgamating company to amalgamated company. That is not treated as transfer, subject to the condition amalgamated company must be an Indian company. Is it clear? Now, shareholders of amalgamating company will get shares of amalgamated company. Am I correct? Let's say I am shareholder of Vodafone Limited. At the time of amalgamation, what will I do? I will submit Vodafone shares and I will take VI shares. So there is exchange of two capital assets. Am I correct or not? I am exchanging my Vodafone share with VI share. Even this exchange of Vodafone share with VI share is not a transfer and no capital gains are required to be calculated. So exchange of amalgamating company shares to get amalgamated company shares, that is also not treated as transfer and no capital gains are required to be calculated. Is it clear? Demerger. See, let's say there are Tata Limited is there. Tata Limited got demerged into Tata Limited and Tanishq Limited. Now, at the time of demerger, there is transfer of capital assets from demerged company to resulting company. Here, demerged company is Tata Limited, resulting company is Tanishq Limited. So, at the time of demerger, what is happening? Capital assets are transferred from demerged company to resulting company. This transfer of capital assets is not a transfer and no capital gains are required to be calculated. Are you able to understand? And subject to the condition, resulting company must be an Indian company. Then only this provision is applicable. It will not be treated as transfer. Very simple. During demerger, transfer of capital assets from demerged company to resulting company, not a transfer. No capital gains are required to be calculated. Subject to the condition, resulting company must be an Indian company. Is it clear? Now, let's say Tata Limited is transferring 400 crores of assets from Tata Limited to Tanishq Limited. Now, what Tanishq Limited will do? It will allot shares to shareholders of Tata Limited. Now, what Tata Limited shareholders? Tata Limited shareholders are losing 400 crore worth of value in their shares and they are sacrificing 400 crore worth of shares for Tanishq Limited. Now, Tanishq Limited is allocating new shares to the shareholders of Tata Limited in Tanishq Limited. Now, what's happening? Like, I am shareholder of Tata Limited. I am losing 400 crore worth of value in my shares and I am transferring those assets to Tanishq Limited. So I will get shares in Tanishq Limited. So this is a relinquishment. I am giving away 400 crore worth of assets. For that, I am getting shares in Tanishq Limited. So allocation of shares in resulting company to the shareholders of demerged company is also not treated as transfer and no capital gains are required to be calculated. Is it clear? Transfer of government security rupee denominated bond outside India by a non-resident to another non-resident. See, there are two non-residents, Steve Smith and Ricky Ponting. Both are non-residents, na? So what they have done, they have, like, Steve Smith transferred capital asset. Steve Smith transferred capital asset to Ricky Ponting. Now, what is that capital asset? That capital asset is rupee denominated bond or government security. Where they are transferring outside India. They are transferring this capital asset in Australia. So if there is a transfer of either rupee denominated bond or government security outside India, okay, then in between, whose the transaction is happening in between one non-resident and another non-resident. Where the transaction is happening, the transaction is happening outside India. So even though capital asset is transferred, this is not a transfer and no capital gains are required to be calculated. Are you able to understand? So three conditions: transaction should take place in between one non-resident to another non-resident. Capital asset required to be transferred is rupee denominated bond or government security. Condition 3, that the transaction should happen outside India. If all these three conditions are satisfied, then the transfer of rupee denominated bond or government security is not a transfer and no capital gains are required to be calculated. Is it clear? Redemption of sovereign gold bonds by an individual. See, like RBI will issue sovereign gold bonds. I will purchase sovereign gold bonds. At one point of time, government, like RBI, will do redemption of sovereign gold bonds. At the time of redemption of sovereign gold bonds, if I get any money, on that money I am not required to calculate capital gains. Is it clear? Conversion of gold into electronic gold or vice versa. See, there are certain cases: conversion of preference shares into equity shares, conversion of debentures, bonds, deposit certificates into shares or securities. Next, conversion of gold into electronic gold or conversion of electronic gold into physical gold. All these transactions are not a transfer. No capital gains are required to be calculated. Are you able to understand? I will tell one example. I am having preference shares. I am submitting preference shares and I am taking equity shares. So there is conversion of preference shares into equity shares. I surrendered preference shares and I took equity shares. Even this conversion of preference shares into equity shares is not a transfer and no capital gains are required to be calculated. There is exchange of two capital assets. Na? I exchanged preference share with equity share. Generally, if there is exchange, it is a transfer, but exception is exchange of preference share with equity share, not a transfer. No capital gains are required to be calculated. Is it clear? Next, see, jewelry, drawing, archaeological collection, painting, work of art. Generally, if you sell these, we have discussed in exclusion to definition of personal effect. Whenever we sell this, we are required to calculate capital gains. But if you sell these assets, jewelry, drawing, painting, sculpture, archaeological collection, work of art, if you sell this to government or government notified institutions or government notified universities, in that case, you are not required to calculate capital gains because the transaction is excluded from definition of transfer. Okay. Next, transfer of capital asset under reverse mortgage. You know reverse mortgage, right? Let's say old couple are there who are resident in India. They do not have any money. They cannot do employment now. They are already above 70 years of age. Now what can they do? If they have any house property, they will mortgage this house property. Bank will give monthly income or bank will give lump sum income. With that amount, they can pay for their medical expense. Now, whenever house property is mortgaged with bank, capital gains are required to be calculated. But in case of reverse mortgage, the transaction is excluded from definition and capital gains are not required to be calculated. Is it clear? Are you able to understand? So this is the completion of definition of transfer. So till here, are you clear? Do you have any doubt? Please ask me. Yes. Shall I explain further? Next, nature of capital asset. Please listen carefully because there is amendment in this provision in Finance Act number 2 of 24. See, generally, when I taught you capital gains in classroom, I told there are three classifications. Okay. So on which basis we will tell whether capital asset is long-term capital asset or short-term capital asset? Three criteria is there. Category 1, category 2, category 3. So based on these three criteria, we are going to determine whether it is long-term capital asset or short-term capital asset. But on or after 23rd July 2024, there are only two categories, category 1 and category 2. Okay. So whenever capital gains question come, high chances you will commit mistake. Why will you commit mistake? The reason that you will commit mistake is you do not check the date. First, you have to check the date whether transfer happened before 23rd July or after 23rd July. If transfer happened before 23rd July, three criteria are there. If transfer happened on or after 23rd July, only two criteria are there. Are you able to understand? I hope I am teaching moderately, not too fast or not too slow, because this is revision class. I cannot explain slowly provision by provision. That will only happen in regular class. So we have less time to do revision. I hope it is moderate. Are you able to follow the speed at which I am going? Okay, good. So before 23rd July, before 23rd July 2024, to tell a capital asset as long-term capital asset or short-term capital asset, how many categories are there? Three categories are there. Now you will get another doubt. Sir, why we need to tell whether it is long-term capital asset or short-term capital asset? Because if it is long-term capital asset, we will calculate long-term capital gain or long-term capital loss. If it is short-term capital asset, we will calculate short-term capital gain or short-term capital loss. Sir, what is the difference? For long-term capital gain, tax rates are different. For short-term capital gain, tax rates are different. So it is very crucial to determine whether a capital asset is long-term capital asset or short-term capital asset. Are you able to understand now? Before 23rd July, okay, listed shares other than securities. Next, zero coupon bonds, units of UTI, units of equity oriented mutual fund. You can see here listed shares, listed securities other than units. I am sorry, not other than securities, other than units. Listed shares, listed securities other than units, zero coupon bonds, units of UTI, units of equity oriented mutual fund. If these capital assets are transferred, then criteria is 12 months. If they are held for more than 12 months, they are classified as long-term capital assets. If they are held for either 12 months or less than 12 months, they are classified as short-term capital assets. Are you able to understand? Category 2, immovable property. Immovable property means either land or building or both land and building. Next, second one is unlisted shares. Unlisted shares can be either equity shares or preference shares. So when you transfer immovable property or unlisted shares, they will fall under category 2. Under category 2, criteria is 24 months. If they are held for less than or equal to 24 months, short-term capital asset. If they are held for more than 24 months, long-term capital asset. Remaining capital assets, those capital assets which are not covered under category 1, category 2, remaining all capital assets will fall under category 3. For category 3, criteria is 36 months. If they are held for less than or equal to 36 months, short-term capital asset. If they are held for more than 36 months, they are classified as long-term capital asset. Are you able to understand? This is the criteria before 23rd July. Okay, don't get confused. Whenever you see capital gains problem, always first you need to check is date of transfer. If date of transfer is before 23rd July, tax rates are different. Criteria for classification, long term or short term, that criteria is also different. On or after 23rd July, another criteria will apply. So for your attempt, especially, this is amendment. I say will ask a question. It also asked in May 25. It will also ask in September 25. Whenever you read capital gains question, what is the first thing that you need to check? Date of transfer. If date of transfer is before 23rd July, separate tax rates, separate classification. If date of transfer is after 23rd July, separate tax rates, separate classification. Are you able to understand? Now, sir, date of transfer on or after 23rd July 2020, or after 23rd July 2024, then there are only two criteria: category 1, category listed shares or listed securities including units. This is the amendment. See, before 23rd July, units, listed units are excluded from category 1. But on or after 23rd July, listed units are also included in category 1. That is the major difference, major amendment. Before 23rd July, listed units are excluded from category 1. They will fall under category 3. But on or after 23rd July 2024, listed units are also falls under category 1. For listed units also, criteria is 12 months. Are you able to understand? So listed shares or securities including units, zero coupon bonds, units of UTI, units of equity oriented mutual fund. All these are considered, like for all these the criteria is 12 months. If they are held for less than 12 months, short term capital asset. If period of holding is more than or equal to 12 months, sorry, if period of holding is more than 12 months, long term capital asset. If period of holding is exactly equal to 12 months, then also short term capital asset. Is it clear? Remaining all capital assets. Okay, so you need to remember only four: listed shares, listed securities including units, zero coupon bonds, units of UTI, units of equity oriented mutual fund. For all these four capital assets, okay, criteria is 12 months on or after 23rd July. For remaining capital assets, immovable property, gold, jewelry, painting, sculpture, any other capital asset, there is only one criteria: 24 months. There are only two categories: category 1, category 2. So after 23rd July, either 12 months or 24 months, 36 months wala concept that is no more applicable. Are you able to understand? Next, see, you know depreciable capital assets, right? Depreciable capital assets, depreciable capital assets and capital assets under section 50AA. These two capital assets these two are always treated as short-term capital assets. That means on transfer of these capital assets, short-term capital gain or short-term capital will arise. Able to understand? Next, period of holding. You know period of holding, right? Period of holding will be calculated from date of purchase up to the date prior to the date of transfer. That means date of transfer is excluded from definition of period of. I will tell one small example. Date of purchase, date of transfer. Now, let's say I purchased on 10th June 2021. I sold on 5th May 2024. In this case, period of holding will be calculated from 10th June 2021 to 4th May 2024. Very, very important. Whatever the date of transfer is there, that should not be included in calculation of transfer. Are you able to understand? Date of transfer is to be excluded. Period of holding will be calculated from date of purchase up to the date prior to the date of transfer. Is it clear? Are you able to understand? Whatever the date of transfer is there, that is to be excluded. So there are 6 cases: conversion of preference shares into equity shares, conversion of debentures, bonds, debenture stock or deposit certificate. Next, conversion of gold into electronic gold or electronic gold into physical gold, exchange of amalgamating company shares to get amalgamated company shares, exchange of Vodafone shares to get VI shares. Okay, next, like allocation of shares, resulting company shares to shareholders of demerged company, transfer of shares of resulting Indian company in scheme of demerger to demerged company shareholders. In all these 6 cases, period of holding is equal to period of holding of current capital asset plus period of holding of previous capital asset. Are you able to understand? Let's say, like, initially I purchased a preference. Later on, at the time of redemption, I did not take cash. I converted my preference shares into equity shares. Now, period of holding of equity shares is equal to period of holding of equity shares plus period of holding of preference shares. Are you able to understand? Shares acquired from primary market, bonus shares, sweat equity shares, right shares. For all these shares, period of holding is equal to for all these shares, period of holding is equal to date of allotment. See, when you purchase shares from primary market, you will make application, then company will allot. So there is no date of purchase. There are only two dates: date of application, date of allotment. On date of application, you do not know whether company will allot to you or not, but on date of allotment, it is certain you got shares from company. So in case of shares purchased in primary market or bonus shares or right shares, sweat equity shares, date of purchase is not available. That's why we will calculate period of holding from date of allotment of these shares. Are you able to understand? Rights renouncement. In case of right renouncement, period of holding will be calculated from date of offer of such shares by company up to the date of renouncement. What do you mean by this? You know right shares, right? Actually, I am shareholder of Infosys. Infosys wants to allot extra shares to me. I am thinking to sell existing shares. Why will I purchase new shares? I don't want to purchase new shares. So Sinduri is there. Sinduri came to me and asked, sir, anyhow you are not purchasing Infosys shares, so please renounce those shares to me. I will purchase those right shares at concessional rate. I accepted. Okay. So actually I have to pay 100 rupees to purchase right shares. I don't want to buy. So I renounced those shares to Sinduri for 5 rupees each. Now I am making profit by way of renouncement, right? 5 rupees. So in this case also capital gains are required to be calculated. Period of holding is equal to the date on which I got rights offer from the date up to the date of renouncement. That period will be considered as period of holding. Okay. Property acquired in any mode given under section 49(1). See, there are 49(1) means 5 cases. Like at the time of partition of HUF, capital assets will be transferred from Hindu undivided family to small family. Gift, will, or inheritance, like that is excluded from definition of transfer. Transfer of capital assets from holding company to subsidiary company or subsidiary company to holding company, subject to two conditions: 100% subsidiary, recipient company must be an Indian company. Next, conversion of capital asset into transfer of capital assets from amalgamating company to amalgamated company, transfer of capital assets from demerged company to resulting company. In all these cases, what is happening? Capital asset is transferred from one person to another person, but transfer of capital asset is not a transfer and no capital gains are required to be calculated. Correct? Now, let's say from Hindu undivided family to small family, capital asset is transferred. Is it a transfer? Not a transfer. Whether are you required to calculate capital gains? No capital gains are required to be calculated. Now, tomorrow, small family sold asset. Now they are required to calculate period of holding, right? So at that time, period of holding means period of holding of Hindu undivided family and period of holding of small family. Okay, period of holding of Hindu undivided family plus period of holding of small family. So in these five cases, okay, period of holding is equal to period of holding of current owner. Here, who is current owner? Small family plus period of holding of previous owner. Previous owner means Hindu undivided family. So in these five cases, whenever capital asset is transferred, while calculating period of holding, you also required to consider period of holding of the previous owner. Is it clear? Are you able to understand? Format for computation of capital gain. See, depreciable asset I will discuss separately. In case of depreciable asset, they are always treated as short-term capital asset. But in case of non-depreciable asset, there are two things: long-term capital asset, short-term capital asset. The only difference is in case of long-term capital asset, you will claim indexed cost of acquisition or indexed cost of improvement. In case of short-term capital asset, you will claim only cost of acquisition and cost of improvement. That is the only difference. In case of long-term capital asset, you will claim indexed cost of acquisition, indexed cost of improvement. This indexed cost of acquisition, cost of improvement, that is also available up to 23rd July 24. After 23rd July 24, there is no concept of indexation except in one situation. Okay, now you know the format, right? First, you will take full value of consideration. It is also called as sale consideration. From that, you will reduce transfer expenses. Thereby, you will arrive at net consideration. From net consideration, you will reduce cost of acquisition or cost of improvement. Thereby, you are going to arrive at capital gain. Am I correct? In this way, we are going to calculate capital gains. The first thing is full value of consideration. So initially I planned revision for 2 hours, but considering this, it might increase. We may have class till 12:30 or 12:40 like that. I think it is fine for you now. At a time, revision will be completed for capital gain. And this video will be uploaded in YouTube also. If you want, you can prove that. Because I don't want to rush. There is no point if I rush and explain everything in 2 hours. You will not understand. Now, full value of consideration. Sir, what do you mean by full value of consideration? On transfer of capital asset, you will get consideration. Consideration can be either monetary or non-monetary. If consideration is monetary, no problem at all. Whatever the amount that you received in cash or whatever the amount that you received in bank, that will be treated as full value of consideration. However, you received consideration in non-monetary terms, like you sold building, in return you received shares. Now, how to calculate full value of consideration? So generally, if consideration is non-monetary, fair market value of non-monetary consideration received will be taken as full value of consideration. Is it clear? Are you able to understand? Second point, if consideration, whatever the non-monetary consideration that is not ascertainable, in that case, whatever the capital asset that you have transferred capital asset fair market value will be taken as full value of consideration. Is it clear? Transfer expense. What do you mean by transfer expenses? With regard to transfer of capital asset, if you incur any expenditure, that expenditure you will call as transfer expense. Okay, let's say I wanted to sell the building. For sale of building, I need to give commission to the dealer or agent. That is expenditure incurred with regard to transfer of capital asset. So wholly and exclusively for purpose of transfer, if you incur any expense, expenditure. That expenditure will be called as transfer expenditure. Transfer expenditure you can reduce while calculating capital gains, except securities transaction tax. See, whenever you buy and sell listed shares or securities, you are required to pay securities transaction tax. Whatever the securities transaction tax that you have paid, that is transfer expenditure only, but that is not allowed as deduction while calculating capital gain. Is it clear? Cost of acquisition. You know cost of acquisition, right? Generally, cost of acquisition is equal to purchase cost plus incidental. Okay. Incidental expenses means what? To purchase that capital asset. If you have paid stamp duty or if you have incurred any registration expense, all those will be added to the cost of the asset. So generally, cost of acquisition is equal to actual cost plus incidental expense. But there are some certain cases where cost of acquisition is different. In case of bonus shares, if bonus shares are allotted before 1st April, see, to get bonus shares, will you pay anything to the company? You will not pay anything to the company. In fact, you are getting bonus shares at free of cost. That's why cost of acquisition of bonus shares is zero. But if bonus shares are allotted before 1st April 2001, then cost of acquisition is equal to fair market value as on 1st April 2001. Because if any capital asset is purchased before 1st April 2001, you can take the benefit of fair market value, right? So that is why if bonus shares are allotted before 1st April 2001, cost of acquisition is equal to fair market value as on 1st April 2001. Is it clear? Next, intangible assets. If intangible assets are self-generated, goodwill. See, like let's say I built one brand, Phoenix by Uma. Goodwill was generated. I sold this brand. Then whatever the amount that I received, on total amount I am required to pay capital gains, because on sale of self-generated goodwill, the value of goodwill, cost of acquisition is always treated as zero. If goodwill is purchased, then cost of acquisition is equal to actual purchase cost. Is it clear? Sweat equity shares are specified securities. Cost of acquisition is equal to fair market value of shares considered in calculation of perquisite under salaries. Sir, what do you mean by this? Sweat equity shares are specified securities. Let's say I am working in Infosys. Infosys recognized my efforts. Infosys gave some shares to me in Infosys only. So I will get motivated. I will work even better for the company. So when company performs well, company will pay me more dividend. Okay. So keeping that in mind, I will work more. So what company will do? All companies, to motivate employees, they will allocate sweat equity shares. So in case of allocation of sweat equity shares, cost of acquisition is equal to whatever the fair market value on the date of allocation is there for sweat equity shares on the date of exercising the option. Okay, that fair market value will be considered as cost of acquisition. If you remember salaries, see, why Infosys give sweat equity shares to me either at free of cost or at concessional rate? Because I am working with Infosys. So if I get any benefit because of sweat equity shares, that benefit is taxable to me under the head salaries. We will calculate perquisite, fair market value of sweat equity share minus amount paid by shareholder. Balance amount is perquisite, that is taxable under salaries. So for calculation of perquisite under salaries, whatever the fair market value that I have considered, that fair market will be considered, value will be considered as cost of equity of sweat equity shares. Is it clear? Right renouncement. See, in previous example, I renounced my right to Sinduri. Okay. Now, in case of right renouncement, like I am not incurring any cost. Company allotted me right shares. I don't want to buy. I renounce it to Sinduri for 5 rupees. Total 5 rupees is my profit only. I did not incur any cost. So in case of right renouncement, in the hands of transferor, cost of acquisition is, but in the hands of transferee, cost of acquisition is equal to amount paid to company plus amount paid to renouncer. Let's say Sinduri paid 5 rupees to me and Sinduri paid 100 rupees to company to purchase the right share. So in the hands of Sinduri, cost is equal to 105. Are you able to understand? So whenever right renouncement is done, cost in the hands of transferor is 0. Cost in the hands of transferee is equal to amount paid to company plus amount paid to renouncer. Is it clear? We have discussed the conversions na, conversion of preference shares to equity shares, conversion of debentures, bonds, debenture stock, deposit certificates into shares or debentures. So in case of all these conversions, cost of acquisition is equal to cost of previous capital. Is it clear? Conversion of stock in trade into capital asset. See, I purchased a watch. This watch, whether watch is a capital asset? No. Watch is mobile asset. I am using this watch for my personal purpose. This watch does not have any gold. So this watch is not a jewelry, drawing, painting. So watch is a personal effect. But I started watch shop. So I converted personal effect into stock in trade. On conversion of personal effect into stock in trade, am I required to calculate capital gains? I am not required to calculate capital gains. I will tell another example. I am dealer of ACs. Whenever I am dealer of air conditioners, what air conditioner is to me, air conditioner will be treated as stock in trade. Am I correct? But in my showroom, one AC got damaged. What I will do? Will I go and purchase another AC? I am the dealer of ACs. Na? So from my stock, I will take one AC. I will install that AC. Am I correct? So whenever I install that AC in my showroom, I am making it as capital asset. So on conversion of stock in trade into capital asset, so what is the cost of capital asset? Cost of capital asset is equal to fair market value on date of conversion. Clear? Are you able to understand? This is the concept. Next, assets acquired by any mode. We have discussed transfer of capital assets from holding to subsidiary or subsidiary to holding, transfer of capital assets from amalgamating to amalgamated, transfer of capital assets from demerged to resulting. Next, transfer of capital assets at the time of division of HUF, gift, will, or inheritance. In all these cases, cost of acquisition in the hands of new owner is equal to cost of acquisition in the hands of previous owner. From Vodafone to VI, one land was transferred. In the books of VI, cost of land is equal to cost of land in the books of Vodafone. Are you able to understand? Is it clear? Next, gift. If gift is not taxable, let's say I gifted 40,000 worth of gold to Charan, value of gift is less than 50,000, it is not taxable to Charan. In that case, in the hands of Charan, cost of acquisition is equal to 40,000 rupees. Whatever cost in the hands of previous owner is there, same is the cost in the hands of new owner also. However, if gift is taxable, then cost of acquisition is equal to fair market value or stamp duty value that is considered in calculation of gift, considered in valuation of gift under other source. Is it clear? Shall I explain further? Capital gains is so vast, is such a chapter. How much you tell, still something will be there. PGBP is BAP of capital gains. Okay, that is also lengthy, but we have no other alternative other than studying. I have no other alternative other than teaching. Okay, at least in this way, revision is happening to you quickly. If you sit for revision, lot of deviations will come. Okay, someone will call, or someone some deviation will be there, or you will not have a right mood. But in this way, we are having one-on-one communication, right? It's like you are not preparing on your own. You are listening to my class. You already listened to my regular class. This is like revision. So fatafat at one stretch, revision of capital gains will get complete. practice is there for you, na sir. I did not understand. Yeah, CA practice is there. Clients are calling me, but they are IT written clients. I can answer them in the afternoon. If any important client calls, I have no option. During live session also, I will halt. I will address him because that is giving me money. If I ignore it, it will affect my financials. Next, fair market value as on 1st April 2001. Shall I explain? See, before 1st April 2001, if you purchase any capital asset, you can take benefit of fair market value as on 1st April 2001. If you purchase movable asset before 1st April 2001, then cost of acquisition is equal to either fair market value as on 1st April 2001 or actual cost, whichever is higher. If you purchase capital asset, immovable property, if you purchase immovable property before 1st April 2001, then cost of acquisition will be calculated in 3 steps. Step 1, stamp duty value as on 1st April 2001 or fair market value as on 1st April 2001, whichever is lower. Step 2 is actual cost. Step 3, cost of acquisition is equal to step 1 or step 2, whichever is higher. What do you mean by this? Let's say I will quickly take one example. In 1995, I purchased one land. Actual cost is 10 lakhs. As on 2001, stamp duty value is 15 lakhs. Fair market value is 16 lakhs. Now, how much is my cost of acquisition? Step 1. Stamp 15 lakhs or 16 lakhs, whichever is lower. That means 15 lakhs. Step 2, actual cost 10 lakhs. Step 3, cost of acquisition is equal to step 1 or step 2, 15 lakhs or 10 lakhs, whichever is higher. That means 15 lakhs will be considered as cost of acquisition. Is it clear? Did you understand? So, if you purchase any tangible capital asset, very important, you purchased patents before 1st April 2001, you will not get fair market value benefit as on 1st April 2001. Are you able to understand? So only for tangible capital asset, if date of purchase is before 1st April 2001, cost of acquisition is equal to actual cost or fair market value, whichever is higher. In case of immovable asset, 3 steps. Step 1, stamp duty value or fair market value, whichever is lower. Step 2, actual cost. Step 3, cost of acquisition is equal to step 1 or step 2, whichever is higher. Cost of improvement. You know improvement, right? Very important. You purchased one capital asset. On that capital asset, you are paying revenue expenses. Revenue expenses are not cost of improvement. On capital asset purchase, if you incur any capital expenditure, that will be considered as cost of improvement. I purchased one ring. Ring is capital expenditure. Okay, ring is a capital asset. On this ring, for polishing, I paid polishing charges. I get my ring polished. It is revenue expenditure. In this ring, I have shown one diamond. Okay, whatever the diamond is there, it enhances my ring value. So diamond is capital expenditure, so it will be treated, whatever the expenditure of diamond is there, that will be considered as cost of improvement. Are you able to understand? So on any capital asset, if you incur capital expenditure after purchase of capital asset, that capital expenditure we call as cost of improvement. Is it clear? Are you able to understand? So like there are three conditions. Cost of improvement is available for tangible as well as for intangible assets, but cost of improvement should be incurred on or after 1st April 2001. The reason is, if you incur cost of improvement before 1st April 2001, it is already included in fair market value as on 1st April 2001. That is the reason, if cost of improvement is incurred before 1st April 2001, it will be ignored. It will not be considered. Is it clear? So cost of improvement is allowed as deduction subject to satisfaction of three conditions. You can incur cost of improvement either on tangible assets or intangible assets, but you should incur cost of improvement on or after 1st April 2001, and cost of improvement should be incurred either by SSC or previous owner. Are you able to understand? If these three conditions are satisfied, then cost of improvement will be allowed as deduction. That means what? Either I can incur cost of improvement if I gift it to my brother. Whatever the cost of improvement incurred by me allowed as deduction, incurred my brother also allowed as deduction. But in case of goodwill, right to manufacture, right to carry on business, in these three cases, cost of improvement will be taken as. Are you able to understand? Indexation. This is also very important because in indexation also there is one which is there in Finance Act 20. Shall I explain indexation, everybody? Indexation. Indexation means what? In case of long-term capital asset, apart from cost of acquisition, higher cost of acquisition is allowed as deduction. That higher cost of acquisition we call as indexed cost of acquisition. Indexation means what? Higher cost of acquisition or higher cost of input. Let's say in 2007-8, I purchased one asset. Cost of that asset is 11 lakhs. In 2024-25, I am selling that asset. In 24-25 also, will the cost be same? Can I purchase it only at 11 lakhs? Not possible, na? So that's why indexed cost of acquisition will be allowed as deduction. For calculation of indexation, we will take index numbers. Let's say index numbers are given here. For 11-12, index number 184. For 24-25, index number 363. So 7-8, na? Index number for 7-8 is 129. So 7-8, index number 129, 24-25, index number 363. In 7-8, cost is 11 lakhs. In 24-25, how much is the cost? Do cross calculate. How much? 11 lakhs divided by 129 into 360. 30 lakh 95,340 will be considered as indexed cost of. That means in case of long-term capital asset, not cost of acquisition, indexed cost of acquisition, higher cost of acquisition allowed as here. So here what is the formula? 11 lakhs into 129 by 363. We can convert this into formula. Indexed cost of acquisition is equal to cost of acquisition to cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. See, sometimes you can purchase asset before 1st April 2001. If you purchase asset before 1st April 2001, then you will consider index number of 2001. So cost inflation index in the year of purchase or cost inflation index of 2001 to whichever is later. Able to understand? Is it clear? Why, sir? Already we are taking fair market value benefit as on 1st April 2001. So we have fair market value. On that fair market value, we will apply indexation from 1st April 2001 on. That's why Indexed cost of acquisition is equal to cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase, or cost inflation index for 2001 to whichever is later. Same is the case with indexed cost of improvement. Indexed cost of improvement is equal to cost of improvement into cost inflation index in the year of transfer divided by cost inflation index in the year of improvement. Sir, or 2001 too, don't take that. I already told you, for cost of improvement, if any improvement is made before 2001 too, it needs to be ignored. So there is no concept of a cost inflation index for 2001 too. Okay, so cost of improvement is allowed as deduction only if it is incurred after 1st April 2001. That is why while calculating indexed cost of improvement, formula is cost of improvement into cost inflation index in the year of transfer divided by cost inflation index in the year of. Is it clear? Now, see, in case of bonds or debentures, indexation benefit is not available. You cannot, even though bonds and debentures are long-term capital asset, you cannot claim indexation benefit. Next, capital indexed bonds by government. So generally, on bonds, indexation benefit is not available even though they are long-term capital asset. But in case if bonds are issued by government, then on those bonds indexation benefit is available. Next, sovereign gold bonds issued by RBI or sovereign gold bonds issued under gold bond scheme. In case of sovereign gold bonds, you can claim indexation benefit only if they are long-term capital asset. Depreciable capital assets, section 50C, we already discussed. In case of depreciable capital assets, they are always treated as short-term capital asset. As they are always treated as short-term capital asset, indexation benefit is not available. Are you able to understand? Unit of specified mutual fund acquired on or after 1st April 2023, market linked debentures. These are new amendment 50AA. So if any capital asset is covered under 50AA, always treated as short term capital asset. So market linked debenture, unit of specified mutual fund acquired on or after 1st April 23, these two, for these two capital assets, as they are always short term, you cannot claim indexation benefit. Next, section 112A. Those capital assets which are covered under section 112A, under section 112A indexation benefit is not available. Next, virtual digital asset, cryptocurrencies. You bought Bitcoin, you sold Bitcoin, you bought Bitcoin 5 years ago, now you are selling it. Can you claim indexed cost of acquisition? No. In case of virtual digital asset, indexation benefit is not available. With regard to other long-term capital assets, indexation benefit is available, that too before 23rd July 2024. Okay, so on or after 23rd July 2024, there is no concept of indexation except in one situation. Are you able to understand? So generally before 23rd July 24, indexation benefit is available, but on or after 23rd July 24, indexation benefit is not available except only in one situation. What is that situation? I will explain at the end when I am explaining tax rates. Are you able to understand? So till here, are you clear, everybody? Lot of stuff we are discussing today. So shall I continue or do you need any small break? Continue. Okay, fine. Next we will discuss exceptions to method of accounting. Generally method of accounting under the head capital gains is accrual basis. But there are three cases. In these three cases, we do not calculate capital gains on accrual basis. but we will calculate capital gains on cash basis. First example, damage or destruction of capital asset. See, building got collapsed. You got insurance compensation. Whatever the insurance compensation that you have received, that will be taken as full value of consideration. So whenever there is damage of capital asset, in that case, year of transfer is not year of destruction. Year of transfer is year in which you are receiving the compensation. So in case of damage or destruction of capital asset, capital gains are taxable not in the year of transfer, not in the year of damage or destruction, but capital gains are taxable in the year in which the compensation is received from insurance company. Are you able to understand? Next, whatever the insurance compensation received, that will be taken as full value of consideration. Period of holding, generally period of holding will be calculated from date of purchase up to the date prior to the date of transfer. So even in this case also, period of holding will be calculated from date of purchase up to the date prior to the date of damage or destruction. Is it clear? Indexation benefit is available, but indexation benefit is available from date of purchase up to the date prior to the date of damage or destruction. Is it clear? That means what? Indexation benefit, period of holding, you should not calculate till the date of receipt of compensation. You have to calculate only up to the date of damage or destruction. Is it clear? Now you will get one doubt. Sir, if we get insurance compensation in cash, whatever the cash compensation that we have received, that will be taken as full value of consideration. But if you receive a compensation in non-monetary terms, let's say I received insurance compensation in the form of immovable property. My building got collapsed. Insurance company constructed new building. Insurance company gave me new building. Now I am getting consideration in the form of immovable property. Then whatever the fair market value of immovable property received is there, that will be taken as full value of consideration. Able to understand? Fair market value. Charan, you are correct. Okay. Next, you will get one doubt. Sir, stock in trade got destroyed. If stock in trade gets destroyed, PGBP head gets attracted, it will not be covered by provisions of section 45 1A. Capital gains head will not get attracted. Are you able to understand? See, here there is one interesting thing. What is the interesting thing? My building got collapsed. I did not get insurance compensation. Can I claim cost as deduction? Can I show it as capital loss? I cannot show. When building is collapsed and if I get insurance compensation, then only capital gains are required to be calculated. That means what department is saying, whenever there is destruction of capital asset, if you get income, then calculate capital gains. If you do not get income, don't calculate capital gains. That means in case of section 45 1A, if you want to calculate capital gains, first there should be destruction of capital asset. Second condition, you should receive compensation. Conjunction is and. Both the conditions are required to be satisfied, then only capital gains will be calculated, otherwise capital gains will not be calculated. That means there should be destruction and insurance compensation also should be received. If you do not get insurance compensation, 45 1A will not get attracted. Whatever your loss of destruction is there, that loss is a dead loss. That loss you cannot set off in income tax calculation. Is it clear? Only when you get insurance compensation, then you will calculate capital gains. Is it clear? Section 45(2), conversion of capital asset into stock in trade. I told morning one example na, 50 kgs of gold in my home that I converted in, like that I brought into business. Please don't think 50 kgs is there. If 50 kgs is there, I will not take this much of struggle explaining all these things. Okay, I will get so much of income. Okay. There is conversion of capital asset into stock in trade. See, and tomorrow I will sell stock in trade. On conversion of capital asset into stock in trade, is it treated as transfer? It is not a transfer. Capital gains are not required to be calculated. But sale of stock in trade, the year in which I sold the stock in trade, in that year I am required to calculate capital. So, upon conversion of capital asset into stock in trade, capital gain is not taxable in the year of transfer. Capital gain is not taxable in the year of conversion, but capital gain is taxable in the year in which stock in trade is sold, in the year in which you are selling the stock in trade. That is the exception. That is the exception to method of. On conversion of capital asset into stock in trade, whatever the fair market value is there, that fair market value will be taken as full value of. Next, period of holding. In this case, you do not calculate period of holding till the date of sale. That is not correct. You will calculate period of holding from date of purchase of capital asset up to date of conversion. Are you able to understand? So period of holding will be calculated from date of purchase up to date prior to the date of conversion. Are you able to understand? Up to date prior to date of. Next, indexation benefit also same. Indexation benefit will be calculated from year of purchase up to the year of conversion. Is it clear? So that is the concept relating to conversion of capital asset into stock in trade. But one exception is there. I converted my personal effect into stock in trade. Will it be trapped by provisions of 45(2)? No, it will not be trapped by provisions of 45(2). That means if I convert my personal effect into stock in trade, 45(2) will not get attracted. 45(2) gets attracted only if I convert my capital asset into stock in trade. Then only 45(2) gets attracted. Otherwise, 45(2) will not get attracted. Is it clear? Now, in the year in which stock in trade is sold, in that year, you will calculate capital gains. You will also calculate PGBP income. Two incomes you will calculate because in the year in which stock in trade is sold, money is available with SSE. So, on that money, capital gains will be calculated, PGBP income will also be calculated. For this period, like capital gains will be calculated. After conversion for this period, PGBP income will be calculated. Whatever the fair market value on the date of conversion is there, this will be taken as purchase cost in calculation of PGBP income. Okay. If personal effect got converted into stock in trade, it is not at all taxable. It is not taxable under other sources also. It is loop. Okay. When you convert personal effect into stock in trade, it is not at all taxable. Not taxable under other sources also. Okay. Next, section 45(5). Compulsory acquisition of capital asset. Now, section 45(5). Whenever capital asset is compulsorily acquired by government, government will pay compensation. So, whenever compulsory acquisition is done, that is also considered as transfer and capital gains are required to be calculated. Are you able to understand? Now, one thing, whenever compulsory acquisition was done, in that year already SSE is crying. Now, if income tax department comes and asks him to pay tax, SSC will start beating department. Correct? So that's why whenever there is compulsory acquisition, capital gains are required to be calculated, but they will not be calculated in the year of compulsory acquisition. They will be calculated in the year in which compensation is paid by government. Are you able to understand? So whenever compulsory acquisition is done, year of transfer is year of compulsory acquisition. But in year of compulsory acquisition, capital gains are not taxable. They are taxable in the year in which compensation is received from government. Sir, what is to be taken as full value of consideration? Whatever the compensation received from government is there, that will be taken as full value of consideration. Is it clear? Are you able to understand? Compensation received from government will be taken as full value of. Period of holding will be calculated from date of purchase up to the date prior to the date of compulsory acquisition. Even in case of compulsory acquisition also, indexation benefit is available. Indexation benefit is available from year of purchase up to the year of compulsory acquisition. Is it clear? Sir, if compensation is received in installments, even though compensation is received in installments, entire compensation is taxable in the year in which first installment is received. Are you able to understand? So there is like you are getting compensation from government in parts, some amount in this year, some amount in next year, like that. Even though you receive in parts, even though you receive in installments, entire compensation is taxable in the year in which first installment is. Now, whatever the compensation that is received, SSC is not happy with that compensation. Now, what SSC can do? SSC can file case in court or appellate authority for enhanced compensation. Whenever SSC files case in court, if court is satisfied, then court will grant enhanced compensation. Enhanced compensation is also taxable under the head capital gains. See, already while calculating original capital gains, you will claim cost of acquisition, you will claim cost of improvement. So whenever you get enhanced compensation, from enhanced compensation, you cannot claim cost of acquisition and cost of improvement. Enhanced compensation is fully taxable, but only deduction allowed from enhanced compensation is legal expenses. Are you able to understand? Sir, whether enhanced compensation, whether it is long-term capital gain or short-term capital gain, when you calculate original capital gains, whatever the nature is there, original capital gains are long-term. So enhanced compensation is also long-term. Original capital gains are short term. So enhanced compensation is also short term. Are you able to understand? Along with enhanced compensation, you received interest on enhanced compensation. Interest on enhanced compensation is taxable under the head income from other sources. But interest on enhanced compensation is not fully taxable. 50% deduction is allowed and only balance 50% is taxable under the head income from other sources. Is it clear? So that is the concept. Now, revision. For example, let's say I got 80 lakhs compensation. I'm not happy with 80 lakhs. I filed a case for getting extra 30 lakhs enhanced compensation. Court gave judgment 80 lakhs compensation is very high. Give only 50 lakh rupees compensation. Now court reduced the compensation. Now, whenever compensation is reduced by court, you need to recompute the capital gains. And after recomputing capital gains, whatever the extra capital gain tax that you have paid in earlier years is there, that you can claim as refund from income tax department. Are you able to understand? So students, uh, let's do one thing. Already 1 hour 45 minutes is over. I'm feeling hungry because I'm talking continuously. So shall we take some uh, half an hour 45 minutes break and shall we connect at the rate 12:30 like that, or 1 o'clock? Shall we connect at 1 o'clock? 1 to 2 we will discuss further. Remaining section 50 series. See, three topics are pending. Four topics. Section 50 series, exemptions, 112A, 111A, tax rates. I need to explain these four topics. Once I revise these four topics, revision of capital gains is over. So shall we take some break? Because these four topics will take another 1 hour. Okay. So one, is it possible, Charan? All people who are there, please reply. 1 o'clock, okay? Meanwhile, you also have lunch. 1 o'clock, 1 to 2, or if it is tough for you, you may also have lunch at 1 o'clock. Let's meet at 1:30, okay? 1:30 to 2:30, or maximum 3. Second revision, balance revision, 1:30 to 2:30, or maximum 3. We will finish the revision. Okay, let's meet at 1:30. I will send you, like, I will come live. You will get the notification if you subscribe my channel. Please join. We can clear balance revision at 1:30. And one more request, if you want any problems to be taught by me in 1:30 revision, please, whatever the problems that you wanted, please upload in our Telegram group. I will explain those problems also, not at all. Okay. Thank you. Bye. Bye for now. We will again meet at 1:30. So shall we start with section 50 series? Everybody, seems some people are yet to join. First, I will start with section 50B, slum sale. Now, whenever business as a whole is sold for lump sum consideration, then we call that concept as slump sale. Let's say, like, I am having one business, real estate business. I have an option. Either I can sell asset by asset, or I can sell business as a whole. So if business as a whole is sold for lump sum consideration, okay, then that concept we call as slump sale. That means we are not ascertaining individual assets and liabilities. What is value of this asset? Value of what is the value of this asset? How much is this liability? How much is that liability? We are not differentiate. Okay, so what we are doing, like, instead of valuing individual assets, we are valuing business as a whole, and we are selling business as a whole for lump sum. We call that concept as, okay. So in case of slump sale, how to calculate capital gains? Because if we transfer individual asset, it is easy to calculate capital gains. But here we are not selling individual asset, we are selling business as a whole. So in this case, full value of consideration is equal to fair market value of capital assets transferred, or lump sum consideration, whichever is higher. That higher amount will be considered as full value of consideration. Are you able to understand? So whatever the capital assets that we transfer during the slump sale, their fair market value or lump sum consideration that we are receiving, whichever is higher, is to be taken as full value of consideration. Well and good, sir. What is to be taken as cost? In case of slump sale, cost is equal to net worth. Sir, what do you mean by net worth? Net worth means total value of total assets minus total value of total liability. Total value of total assets minus total value of total liability. Sir, how to calculate total value of total asset? If it is depreciable asset, then we will consider book value. If it is non-depreciable asset, then we are going to consider written down value. Next, if it is section 35 AD asset, section 35 AD means, you know, right, specified business. In case of specified business, 100% of the expenditure is allowed as deduction, both revenue expenditure and capital expenditure. So for section 35 AD asset, you will consider value as, last one is self-generated asset. For self-generated asset, also you will consider value as, are you able to understand? So very simple. In case of slum sale, you are not selling individual assets, you are selling business as a whole. So we will calculate capital gains for business as a whole. Full value of consideration is equal to fair market value of capital assets transferred or lump sum consideration, whichever is higher. Next, cost of acquisition is equal to net worth. Net worth means total value of total assets minus total value of total liability. How to calculate total assets? If it is depreciable asset, consider book value. If it is not, sorry, if it is depreciable asset, consider written down value. If it is non-depreciable asset, consider book value. If it is self-generated asset or 35 AD asset, you will consider value as 0. Similarly, for non-depreciable, I am sorry, I have written wrong here. You guys are there, but you are not responding. For depreciable asset, written down value na. For non-depreciable asset, book value. In a flow, I told something wrong. You are not pointing it out. Now, see, in case of non-depreciable asset, if any revaluation is done, we should ignore revaluation. Revaluation amount is to be ignored. Okay, you should not consider revaluation amount. That needs to be. Sir, how to calculate period of holding? Here, we are not transferring individual asset, we are transferring business as a whole. So, we will calculate period of holding for business. Are you able to understand? That means from date of commencement up to date prior to date of transfer. That period we call as period of holding. So if business is in existence before 23rd July for more than 36 months, it is long-term capitalist. If business is in existence for less than or equal to 36 months, then it is short-term capitalist. On or after 23rd July, there are only two categories. So that's why on or after 23rd July 24, criteria is 24 months. If business is in existence for more than 24 months, classified as long-term capital asset. If business is in existence for less than or equal to 24 months, classified as short-term capital asset. Are you able to understand? That is the next. Indexation benefit is not available in case of sale. See, we cannot calculate indexation because we are not transferring individual asset, we are transferring business as a whole. So indexation benefit is not available while calculating capital gains in case of. This is the concept relating to slum sale. No need to determine period of holding na sir, since indexation is not available. Even though indexation is not available, we need to classify whether it is long-term capital gain or short, because tax rates will change. For classification of long-term capital asset or short-term capital asset, we need to calculate period of holding. Okay. Section 50C, favorite section, ICA's favorite section. You should listen. See, if stamp duty value is greater than 110% of actual consideration, in that case, like full value of consideration is equal to stamp duty value. If stamp duty value is less than or equal to 110% of actual consideration, in that case, actual consideration will be taken as full value of consideration. Are you able to understand? See, how can stamp duty value actual consideration exactly it will match? That's not possible now. So up to 10% deviation is allowed. That means if difference between stamp duty value and actual consideration is up to 10%, then actual consideration will only be taken as full value of consideration. If difference is more than 10%, then in that case, stamp duty value will be taken as full value of consideration. Now, next, see, sometimes what SSC feels that stamp duty value is greater than fair market value. So before that concept, see, stamp duty value is there. On which date we need to consider stamp duty value? Generally, we will consider stamp duty value on date of transfer. But sometimes what happens, date of agreement, date of registration, both are on two different dates, and in between two dates, stamp duty value will change. On date of agreement, stamp duty value is 20 lakhs, 200 lakhs. On date of registration, stamp duty value is 240 lakhs. Now, which stamp duty value we need to take? Three conditions are there. If all three conditions are satisfied, we will consider stamp duty value on the date of agreement. If any one of the conditions are not satisfied, then we will consider stamp duty value on the date of registration. Sir, what are those three conditions? Full or part of the consideration must be received. It must be received on or before the date of agreement. It must be received by bank transaction, by any mode other than cash. If all these three conditions are satisfied, we will consider stamp duty value on the date of agreement. If any one of the conditions are not satisfied, then we will consider stamp duty value on the date of registration. Are you able to understand? So that's what. So you are finding tax very difficult in exam. The only solution is you need to practice multiple times. You need to solve as many problems as. Now, sometimes SSC feels stamp duty value is greater than fair market value. In that case, SSC is having two options, two remedies. Remedy 1, he can file case in court or appellate authority. If he files case in court or appellate authority, whatever the stamp duty value determined by court or appellate authority is there, that is final. Is final. Option 2, request income tax officer to refer case to valuation officer. Then valuation officer will do valuation. After valuation officer has done the valuation, then if valuation officer increases the amount, then full value of consideration is equal to original stamp duty value. If valuation officer decreases the value, then full value of consideration is equal to value determined as per valuation officer. That means in second case, whichever is beneficial to the SSC will be considered. If valuation officer increases the stamp duty value, then original stamp duty will be taken as full value of consideration. If valuation officer decreases the value, then whatever the decreased value by valuation officer, that will be taken as full value of consideration. Is it clear? Now, sorry, I'm getting client call. Section 50 CA. Section 50 CA means it is applicable in case of transfer of unlisted shares or unquoted shares. So whenever unlisted shares are transferred or unquoted shares are transferred, if actual price is less than fair market value, in that case, full value of consideration is equal to fair market value. Let's say Umasankar Private Limited, one company is there. I wanted to sell the shares. Actual price I sold is 80 rupees, but fair market value is 140 rupees. Intentionally I am selling at low price so that I can avoid payment of capital gain tax. So in this case, 140 rupees will be taken as full value of consideration. Is it clear? There is one more section which I need to discuss. Section 50B. Capital gains in case of transfer of capital assets by power sector undertaking following straight line method of depreciation. So generally power sector undertakings, they have two options. Either they can follow straight line method or they can follow written down value method. If they follow straight line method, they need to calculate depreciation on straight line basis. But see, if they follow straight line method, they will calculate depreciation for each asset independently. But if they follow written down value, they need to calculate depreciation for group of assets, which is also called as block. Okay, I will take one example. Let's say asset cost 30 lakhs, useful life 10 years. So how much is written down value after 2 years? We can calculate. Depreciation method is SLM. How much will be the depreciation? Cost is equal to 30 lakhs less depreciation. How much? 30 lakhs divided by 10 into 2 years, 6 lakhs. Written down value will be 24 lakhs. Am I correct? Now whatever the written down value 24 lakhs is there, from such written down value, three options are there. Option 1, option 2, option 3. Option 1, sold. Asset is sold for 20 lakhs. Then there is a surplus or shortfall. There is shortfall. How much is shortfall? 4 lakh rupees. This will be considered as terminal depreciation and it will be debited to P&L account. Case 2, it was sold for 27 lakhs. So is there shortfall or surplus? Surplus. How much is surplus? 3 lakhs. This surplus will be considered as PGBP. Terminal depreciation, it will be debited to P&L account. Option 3, it was sold for 32 lakhs. How much is surplus? Surplus is 8 lakhs. Na? So out of 8 lakhs, whatever the depreciation that we have claimed earlier, how much is the depreciation that we claimed earlier? 6 lakhs. So out of 8 lakhs, 6 lakhs will be considered as PGBP income. Balance 2 lakhs, it will be considered as capital gains. Think logically, asset is purchased for 30 lakhs. It was sold for 32 lakhs. So in the year of purchase only, if it is sold, we would have got 2 lakh rupees extra income. Na? So that's why it is earmarked as capital gains. Is it clear? So this is about section 50A. Then we will discuss exemptions. Exemptions 112A, 111A, tax rates. These three concepts are pending. So shall we start discussing exemptions? People are getting sleep, had full lunch and came to live class. Hi Sai Kiran, tell. Section 50 CA we discussed na 50 CA. In case of unquoted shares, we have discussed. I am good Sai Kiran, hope you are also fine. Next we will discuss exemptions. First we will discuss about section 54. What is the combination under section 54? combination under section 54 is residential house property to residential house property. Section 46, I think it's buyback, na? So you want me to discuss buyback as well, Charan? Actually, there is some time gap between you and me because of internet. Okay, at last, if I have time, I will discuss buyback also. Yes, section 54. What is the combination residential house property to residential house property? That means when you sell residential house property, you will get capital gains. Now, those capital gains, if you make reinvestment in new residential house property, you can claim it as exemption under section 54. Are you able to understand? Now, see, if you want to claim exemption under section 54, this benefit is available only for individual or HUF. Company sold building. Can company claim exemption? No. Partnership firm sold building. Can partnership firm claim exemption under section 54? No. So who can claim exemption under section 54? Only individual or HUF. What is the combination residential house property to residential house property? Next, whatever the residential house property that you are selling, it must be a long-term capital asset. Then only exemption under section 54 is available. If capital asset transferred is short-term capital asset, exemption under section 54 is not available. Are you able to understand? So only in case of long-term capital asset, exemption under section 54 is available. For short-term capital asset, exemption is not available. So you sold residential house property, you are making reinvestment. You are making reinvestment in new residential house property. Now this new residential house property can be either purchased or it can be constructed. New house property can be purchased or new house property can be constructed. What is the time limit? The time limit available for purchase or construction of new residential house property is, see, date of transfer is there now. From date of transfer, within 2 years you can purchase new house property, or from date of transfer within 3 years you can do construction of new house property. Next, sir, can we do construction before also? Yes, you can start construction before commencement, but construction should be completed within 3 years from date of transfer. Similarly, like you can enter into agreement, you can have all the transactions, but purchase should be completed within 2 years from the date of transfer. That is time limit for reinvestment. Next, amount required to be reinvested. So what is the amount that you need to reinvest? Amount required to be reinvested is gross capital gain. Are you able to understand? Next, sir, how much exemption is allowed under section 54? Exemption under section 54 is equal to gross capital gain or 10 crore rupees, whichever is lower. That lower amount will be allowed as exemption under section 54. So amount required to be reinvested, gross capital gain, reinvestment should be made, residential house property, time limit we have discussed. For purchase, like within 2 years from date of transfer. For construction, within 3 years. Construction may start before also, but construction should be completed within 3 years. Similarly, purchase, you can purchase house property within 1 year before the date of transfer also. That means during this period, you should make purchase of house property, then it is eligible for exemption. Is it clear? Capital gains account scheme. Yes, first I will explain capital gains account scheme little later. Exemption is gross capital gain or reinvestment or 10 crores, whichever is lower. So that means what? Whatever the gross capital gain amount or whatever the amount that you have reinvested, gross capital gain or reinvestment or 10 crores, whichever is lower, is allowed as exemption under section 54. Holding period of new capital asset. This is also called as lock-in period. Let's say on 10th May 2025, 2024, I sold asset. I sold residential house property. On 6th April 2025, I purchased a new house property. Purchased new residential house property. So when I made reinvestment on 6th April. From this date, for next 3 years, I should not sell. I should not sell the reinvested house property. Are you able to understand? That concept we call as lock-in period. That means whatever the amount that you invested in new house property, that will be locked. New house property cannot be transferred within 3 years from date of purchase. Are you able to understand? Now you will get doubt. Sir, what if new residential house property is transferred within 3 years? If new residential house property is transferred within 3 years, then whatever the exemption claimed earlier will be reduced from cost of acquisition on transfer of new capital asset. For example, I sold asset worth 100 lakh rupees. I made reinvestment 80 lakh rupees. Now, what will happen? Or I made reinvestment 120 lakh rupees. Now, I will claim exemption. Now, how much is exemption under section 54? Like gross capital gain 100 lakhs or reinvestment. Let's say capital gain is 100 lakhs. Reinvestment 120 lakhs or maximum allowed 10 crores, whichever is lower. Total capital gain is exempt. Now, what is the thing? Whatever the new house property that I purchased with 120 lakhs is there, this should not be transferred within a period of 3 years. Sir, what if I transfer within a period of 3 years? Let's say like after 1 year I sold for 150 lakhs. Now I need to calculate capital gains. Now full value of consideration 150 lakhs. Cost of acquisition 120 lakhs is not allowed. From 120 lakhs, whatever the exemption that you have claimed earlier, that will be reduced, and only 20 lakhs is allowed as cost of acquisition and 130 lakhs is taxable as. Are you able to understand? So lock-in period. Once you do reinvestment, from date of reinvestment for next 3 years, you should not transfer the capital asset. What if you transfer? If you transfer, then consequences on transfer of new residential house property, you are required to calculate capital gains. In such calculation of capital gains, total cost is not allowed as deduction. From total cost, whatever the exemption that you have claimed earlier, that will be knocked off, that will be reduced, and balance will be allowed as deduction. Is it clear? Capital gains account scheme. See, let's say I sold one house on 28th February 2025. I sold residential house. Now, I'm having I have option. If I want to purchase, I have 2 years time limit. If I want to construct, I have 3 years time. Am I correct or not? But in between, income tax return due date is there. 31st July 2025 has come. Now, before ITR due date, I should take decision whether I have to claim exemption or not. Because if I claim exemption, my income decreases, I need to pay lower tax. If I do not claim exemption, my income increases, I am required to pay more tax. Now, department, it gave time to me 2 years, 3 years for doing purchase or construction, but department is saying before ITR due date, I should take decision whether to claim exemption or not. So two things are spoken by department. One side department is saying I will give 2 years time for purchase, 3 years time for construction. Another side department is saying before ITR due date only you have to take decision whether to claim exemption or not. So this is final due date. Whatever the ITR due date is there, this is final due date. So before ITR due date only, you have to take decision. What is the decision that you have to take before ITR due date? Either do purchase or do construction. You don't want to do purchase, you don't want to do construction. You wanted to take extra time limit of 2 years or 3 years. Then deposit money in capital gains account scheme. Right now, whatever the amount deposited in capital gains account scheme is there, the deposited amount is eligible for exemption under section 54. Are you able to understand? That means what? See, before ITR due date only, SSC has to take decision. Either he can purchase new house or he can construct new house. Department promised it will give 2 years for purchase, 3 years for construction. Still, department is also giving time for you, 2 years for purchase or 3 years for construction. But how can departments trust you? That's why department is asking you to deposit money in capital gains account scheme before ITR due date. Whatever the amount deposited in capital gains account scheme is there, that you use it now to claim exemption under section 54. But whatever, like you are depositing money in capital gains account scheme, you are claiming exemption under section 54. Tomorrow, within 2 years, within 3 years, you should mandatorily withdraw that money and you should use that money for purchase or construction of new residential house property. Are you able to understand? So generally time limit for reinvestment, for purchase 2 years, for construction 3 years. But actual due date is ITR due date only. Before ITR due date only, you have to take decision either purchase or construction. If you want enhanced limit 2 years or 3 years, right now invest money in capital gains account scheme, and using these three options, this year itself claim exemption under section 54. Now what I did, I deposited 60 lakhs in capital gains account scheme and 60 lakhs I claimed as exemption under section 54. Well and good. Now I need to use this 60 lakhs within next 2 years for purchase or within next 3 years for construction. But I did not utilize that money. There is unutilized money. So whatever the unutilized money in capital gains account scheme is there, after expiry of 2 years or 3 years, whatever the unutilized money is there, such unutilized money is taxable in the hands of SC. Are you able to understand? That is the concept relating to section 54. You can see unutilized amount in capital gains deposit scheme. Capital gain relating to unutilized amount shall be taxable after expiry of time limit. Is it clear? Now I will tell one case. I sold one residential house property in Vijayawada. Capital gain is 140 lakhs. Now I purchased two houses. One in Hyderabad, another one in Chennai. Hyderabad house is 90 lakhs, Chennai house is 70 lakhs. Now, question here is 90 plus 70, 160 lakhs. Now, both houses, can I claim as exemption? Can I claim both these houses as exemption under section 54? Yes. That means what? 1:2 ratio. 1:2 ratio means you are selling one house, you are making reinvestment in two houses. Reinvestment in two houses is possible. 1:2 ratio is allowed, but subject to satisfaction of two conditions. Condition 1, if long-term capital gain is less than or equal to 2 crores, then this benefit is allowed. Here, capital gain is 140 lakhs, which is less than 2 crores. So, you can make reinvestment in two house properties as exemption under section 54, but condition 2, only once in a lifetime. Okay, this option is available only once in a. So, these are the two conditions. Is it clear now? So what is the combination? Residential house property to residential house property. That means you sold one residential house property, you made reinvestment in another residential house property. Whatever the reinvestment made is there, new residential house property, that new residential house property should be in India, then only exemption is available, otherwise exemption is not available. Able to understand? So reinvestment should be made in new residential house property in India. I sold my house in Vijayawada. I purchased a new house in Dubai. Whether cost of new house in Dubai, can I claim it as exemption here? Not possible. Able to understand? So this is all about section 54. We discussed very clearly. Now, shall I explain next one, 54B? Just now I came to know our past president T.N. Manoharan sir. He also got Padma Shri award and he worked as president of ICAI. He is visionary. Today morning he passed away at Mumbai. So deep condolences to our past president T.N. Manoharan sir. He is pride of our nation. He was awarded Padma Shri also by Government of India. Let's pray his soul should rest in peace. Section 54. Abba. Sir, what is the combination under 54B? Agricultural land, urban agricultural land to agricultural land. That means whenever you sell urban agricultural land, on sale of urban agricultural land, capital gains will arise. Now, if those capital gains are reinvested, you can make reinvestment in whatever the capital gains are there. Those capital gains are to be reinvested either in rural agricultural land or in urban agricultural land. So whatever the capital gain amount is there, if it is reinvested either in rural agricultural land or urban agricultural land, whatever the amount reinvested, that is eligible for exemption under section 54B. Are you able to understand? Now, who can claim exemption under 54B? Only individual or HCF can claim exemption. Now, individual or HCF can claim exemption under section 54B. Under 54, only if capital asset transferred is long-term capital asset, then only exemption is available. Under section 54B, exemption is available whether it is long-term capital asset or short-term capital asset. That means whatever the urban agricultural land that is transferred is there, it can be either long-term capital asset or short-term capital asset. So capital asset transferred can be either long-term capital asset or short-term capital asset, and it is eligible for exemption under section on transfer of that urban agricultural land. If you make reinvestment amount you can claim as exemption under section 54B. Okay. Capital asset required to be transferred urban agricultural land, reinvestment should be made in agricultural land. But there is one condition. Whatever the urban agricultural land that SSE transfers is there, SSE should use that urban agricultural land for a minimum period of 2 years before the date of transfer for agricultural purpose. Then only exemption is available, otherwise exemption is not available. So today urban agricultural land transferred. From today in last 2 years, that urban agricultural land should be used for agricultural purposes. Then only exemption is available, otherwise exemption is not available. Next, amount required to be reinvested is gross capital gain. Where reinvestment should be made? Reinvestment should be made in agricultural land. It can be urban agricultural land or rural agricultural land. Next, amount of exemption, gross capital gain or reinvestment, whichever is lower. Sir, what is time limit available for reinvestment? Under section 54, you need to make reinvestment in house. If you want to purchase house, 2 years. If you want to construct house, 3 years. Sir, here I wanted to make reinvestment in agricultural land. What is the time limit available? 2 years. So within 2 years from date of transfer, you need to make the reinvestment. Now, I purchased a new agricultural land. Na? So for this new agricultural land, there is lock-in period. How much is lock-in period? Lock-in period is 3 years. That means what? Within next 3 years, I should not transfer the new agricultural land. Sir, what if I transfer new agricultural land within 3 years? In that case, whatever the exemption claimed earlier is there, that will be reduced from cost of acquisition on transfer of new agricultural land. Is it clear? What? Sai Kiran, what did you message? I did not understand. Now, Whether capital gains account scheme is available? Yes, capital gains account scheme is available. Why? Department gave time limit to reinvest 2 years. How can we reinvest in 2 years? And department only saying before ITR due date you should claim exemption. Not possible na. So before ITR due date, either purchase new agriculture land or deposit money in capital gains account scheme. Whatever the amount deposited in capital gains account scheme is there, that is available for exemption now. But amount deposited in capital gains account scheme should be used for purchase of new agriculture land within 2 years. If there is any unutilized capital gains deposit scheme amount, that is taxable after expiry of 2 years. Degree batch. What degree batch? Shall I explain section 54D? Everybody. 54D combination is land or building of industrial undertaking to land or building of industrial undertaking. But this 54D exemption is available only in case of compulsory acquisition. What do you mean by this? Let's say land or building of industrial undertaking is compulsorily acquired by government. Now government will give compensation. Now with that compensation, SSC purchased new land or building of industrial undertaking outside the city area. Now whatever the amount reinvested in new residential like new industrial undertaking is there, that amount he can claim as exemption under section 54D. Another important point, 54, 54B. Under these two sections, exemption is available only for individual or HUF. But under 54D, exemption is available for any SSC. So, like company, partnership firm, LLP, they also can claim exemption under section 54D. And whatever the land or building of industrial undertaking is there, it can be either long-term capital asset or short-term capital asset. Sir, if we are not reinvesting full amount, then unutilized amount is taxable under capital gains. Whatever the unutilized amount in capital gains deposit scheme is there, after expiry of 2 years or 3 years, it is taxable under capital gains only, not PGBP or IFOS. Now, but there is one condition. Whatever the industrial undertaking that is compulsorily acquired by government is there, that industrial undertaking is required to be used for industrial purposes for a minimum period of 2 years before the date of transfer. Are you able to understand? So it should be used for industrial undertakings for 2 years immediately preceding the date of transfer. Very, very important. Mode of transfer, compulsory acquisition. I sold land of industrial undertaking. Can I claim exemption under 54D? No. Only land or building of industrial undertaking is compulsorily acquired by government. Then only exemption under 54D is available, otherwise not available. Next, time limit for reinvestment. See, this exemption is available only in case of compulsory acquisition. Now, morning class we have discussed. Whenever compulsory acquisition is done by government, then capital gains are not taxable in the year of compulsory acquisition. They are taxable in the year in which compensation is received. So, like the date on which compensation is received, from the date within next 3 years, you should make reinvestment. Then exemption is available under section 54D. How much is the amount of exemption? Gross capital gain or reinvestment, whichever is lower. Sir, is there any lock-in period? Yes, 3 years. Whatever the new land or building that you are purchasing, you should not transfer within 3 years. If you transfer, earlier exemption claimed will be reversed and taxable as capital gain. Next, whether capital gains deposit scheme is available? Yes, because time limit for reinvestment is 3 years. Now, before only ITR due date comes. That's why a capital gains account scheme was given But whatever the amount deposited in capital gains account scheme is there, it should be used within 3 years. If there is any unutilized amount after 3 years, that is taxable after the expiry of time limit under the head capital gain. Okay. This is the concept relating to 54D. So 54, 54B, 54D, if you understand, comment yes sir, would be understood. Will you do revision series for CMA final December 25? Yes. I will start revision series for CMA final in the month of September. I will release the schedule because in August month I am doing revision for CA inter and CA final, because in September CA exams are there. In the month of September, for December, CMA inter and CMA final revision series I will start. Okay. I think Charan is sleeping there somewhere. He is not replying. Next we will discuss. Charan is also saying yes sir. So you are admitting you are sleeping. Now 54 EC. What is the combination under 54 EC? Immovable property to NHAI bonds or RECL bonds, Power Finance Corporation bonds, Indian Railway Finance Corporation bonds. Whenever, okay Charan, you are listening with more attention, I understood. I jokingly said, now, immovable property means either land or building or both. Whenever land, building or both, whenever immovable property is transferred, you will get capital gains. Now, if those capital gains are reinvested either in NHAI bonds, you know NHAI, right? National Highways Authority of India, RECL, Rural Electrification Corporation Limited, Power Finance Corporation bonds, Indian Railway Finance Corporation bonds. So whenever you do reinvestment in these bonds, whatever the amount reinvested, that is eligible for exemption. So, but maximum exemption allowed is 50 lakh rupees under section 54 EC. So that's why exemption under 54 EC is equal to gross capital gain or reinvestment or 50 lakhs, whichever is lower, that will be allowed as exemption under section 54 EC. Is it clear? Another important point. See, till now time limit for reinvestment is 2 years or 3 years, but under 54 EC time limit for reinvestment is only 6 months. Time limit for reinvestment is 6 months from date of transfer. Are you able to understand? See, time limit for reinvestment is very low now, 6 months from date of transfer. That is the reason capital gains account scheme is not available. See, within 6 months you need to make reinvestment. You are not given time limit of 2 years or 3 years. That's why under 54 EC, capital gains account scheme is not available. Are you able to understand? So, but who can claim exemption under 54 EC? Any SSE can claim exemption under 54 EC. Capital asset required to be transferred is long-term capital asset and it should be immovable property. Reinvestment should be made NHAI bonds, RECL bonds, Power Finance Corporation bonds, Indian Railway Finance Corporation bonds, amendment as per Finance Act number 2 of 24. So remember that amendment. Okay. Next. Time limit for reinvestment within 6 months, as it is, as time limit for reinvestment is very low, only 6 months. Capital gains account scheme is not available. Exemption, capital gain or reinvestment or 50 lakhs, whichever is lower. Holding period, lock in period is 5 years. See, generally under 54, 54b, 54d, time limit for reinvestment is only 3 lakh, sorry, lock-in period is only 3 years, but under 54 EC lock-in period is 5 years. Okay, my grandfather is there, he did this only. Okay, he sold one house property, he got capital gains, he invested that money in, uh, he did not sell house property, he sold land. Land is immovable property. So he made reinvestment in NHAI bonds. For next 5 years, he should not sell those NHAI bonds. If he sells, whatever the exemption that is claimed earlier, that will be reversed and taxable as capital gains. Are you able to understand? Did you observe under 54, 54B, 54D, what happened if you transfer within lock-in period? What is the tax treatment? Earlier exemption claimed will be reduced from cost of acquisition, but under section 54 EC, transferred within lock-in period, transferred within lock-in period. Then if it is transferred within lock-in period, whatever the exemption is there, exemption will not be reduced from cost. Okay, this concept is not applicable. Whatever the earlier exemption is there, that is taxable now as capital gain. So are you able to understand? So that is the difference. Under earlier three sections, if new asset is transferred within lock-in period, earlier exemption claimed, it will be reduced from cost of acquisition on transfer of new asset. But for 54 EC and 54F, if you transfer within lock-in period, earlier exemption claimed, it will be reversed and taxable as capital gain in current previous year, in the year of violation. So that is the concept relating to 54 EC. So till 54 EC, did you understand? Next 54F, very very important. Preparation tips, strategies, everything will be discussed at the end of the class. Now we are in the middle of the class. If you have any generic questions, ask at the end of the class. Okay. After 54F, solve one problem relating to this, sir, please. See, with regard to 54F, I gave one problem in booster material. Let us solve this problem. Then you will get clarity. Is it fine, Charan? You can see in page number 5.14, I gave one problem relating to exemption of section 54F. That we will solve. Fine. Okay, shall I start section 54F? Very, very, very important. See, section 54F is almost similar to section 54. Okay, so whatever we discussed in section 54 is there, more or less section 54F is also like that. So what section 54F says? Combination. What is combination under 54? Residential house property to residential house property. Combination under 54F is any capital asset other than residential house property to residential house property. That is the combination under section 54F. Okay. Now, who can claim exemption under 54? Individual or HUF. Even under 54F also, exemption is available only for individual or HUF. Next. Whatever the capital asset that you are transferring, it should be a long-term capital asset. Then only 54F exemption is available. Otherwise, 54 exemption is not available. Where you need to make reinvestment, you need to make reinvestment in new residential house property. That new residential house property can be either purchased or it can be constructed. Sir, what is the time limit available for reinvestment? Time limit available for reinvestment is same time limit as we discussed in section 54. As per section 54, new house is required to be purchased within 2 years, new house is required to be constructed within 3 years. Same time limits. Whenever, let's say, I sold gold, I got capital gains, I invested this money in new house property. Okay, I can claim exemption under section 54F. Within how much time I need to make reinvestment? I should purchase house within 2 years, I should construct house within 3 years, or I can purchase house within 1 year before the date of transfer also. Are you able to understand? Same time limit. Here, change is there. Amount required to be reinvested. As per section 54, 54B, 54D, 54EC, amount required to be reinvested is gross capital gains. As per section 54F, amount required to be reinvested is net consideration. So what you need to reinvest is net consideration. Are you able to understand? So here the exemption will change. Exemption under section 54F. Exemption will be calculated in 2 steps. Step 1, amount reinvested or 10 crores, whichever is lower. Step 2, exemption under section 54F is equal to gross capital gain into step 1 divided by net consideration. This is the formula for claiming exemption under section 54F. Now, shall we do one problem with regard to calculation of exemption under section 54F? I appreciate Charan and Sinduri. You are constant from morning onwards listening to the class. Thanks for being in the live class. Otherwise, it would have been tough. I would be telling class to this air conditioner, camera, lighting. Shall we do problem? So, open page number 5.14. Now, case 1. Net consideration is 15 crores. Long-term capital gain is 7.5 crores. Reinvestment is 12 crores. What is the formula? Always don't panic. Exemption under 54F is calculated in 2 steps. Sir, can we claim exemption for 2 houses under 54F? Not possible. That benefit is available only under section 54. Okay. Actually, I have to tell this point. I will tell at the last. Meanwhile, you asked me that. So help me. Step 1, reinvestment or 10 crores, whichever is lower. How much is reinvestment in case 1? Reinvestment is 12 crores na. Reinvestment is 12 crores. So 12 crores or 10 crores, whichever is lower means 10 crores. Step 2, exemption under section 54F. It is equal to gross capital gain into reinvestment divided by net consideration. How much is gross capital gain? Gross capital gain is 7.5 crores. So 7.5 crores into reinvestment means nothing but step 1. Step 1 is 10 crores divided by how much is net consideration? 15 crores. So how much is exemption? 7.5 into 10 by 15. 5 crores is exemption under section 54F. Are you able to understand? Now, shall we do for second case? In second case, step 1, reinvestment or 10 crores, whichever is lower. How much is reinvestment? Reinvestment 15 crores. So 15 crores or 10 crores, whichever is lower means 10 crores. Step 2, exemption under section 54F is equal to gross capital gain into step 1 divided by net consideration. How much is gross capital gain? 12 crores. 12 crores into how much is step 1? 10 crores divided by how much is net consideration? Net consideration is 20 crores. So 6 crores is exemption under section 54F. Shall we do third case? Again, step 1, reinvestment or 10 crores, whichever is lower. How much is reinvestment? 8 crores. 8 crores or 10 crores, whichever is lower means 8 crores. Step 2, exemption under section 54F is equal to gross capital gain into step 1 divided by net consideration. Gross capital gain 8 crores. Sorry. Gross capital gain 12 crores. 12 crores into 8 crores divided by 16 crores. 6 crores is exemption under section 54F. Case 4 and 5. Will you do as homework? Will you do on your own? Case 4 and 5 will you do on your own? Good. Ushasri Ainala. So are you also there from the morning? Okay, good Ushasri. Sir, is there any lock-in period? Yes, there is lock-in period. Lock-in period is 3 years. That means I sold gold, I got money, I invested in house property, whatever the amount that I invested in house property. Okay, I purchased a new house. Now, new house should not be transferred within 3 years. Sir, what if I transfer new house within 3 years? If I transfer new house, on transfer of new house, I am required to calculate capital gains, capital gain 1, and whatever the exemption that I have claimed earlier using this new house, that exemption will be reversed and again capital gain is taxable. So in the year of violation, two capital gains are taxable. First capital gain on sale of house, second capital gain, whatever the exemption that I have claimed earlier, that is reversed and taxable as capital gains. So these two capital gains are taxable in the year of violation. Sir, whether capital gains account scheme is available? Yes. He gave 2 years time for purchase, 3 years time for construction. Due date is within 4 months from end of previous year. So obviously capital gains account scheme is available. You can deposit money in capital gains account scheme and you can claim exemption under section 54F. Are you able to understand? But whatever the unutilized amount is there, that is taxable after the expiry of time. So this is the concept. Next, shall we discuss section 112A or 111A? Sir, please display 54F. You can look in booster material, page number 5.14. Answer is also available here. Okay. Shall we discuss 112A or 111A? Now, there are three capital assets: listed equity shares, units of equity oriented mutual fund, units of business trust. Only if these capital assets are transferred, 112A or 111A gets attracted. If you transfer other capital asset, on transfer of other capital asset, like section 112 or 111 gets attracted. So you can remember one thing: only if there are three capital assets, then only 112A or 111A gets attracted. What are those three capital assets? Listed equity shares, units of equity oriented mutual fund, units of business trust. Any one of the capital assets are transferred, then only 112A or 111A gets attracted. On transfer of listed equity shares, or on transfer of units of equity oriented mutual fund, or on transfer of units of business trust, two conditions are required to be satisfied. They must be transferred through stock exchange, okay, and STT is required to be paid. So two conditions: first, they must be transferred through stock exchange, and STT is required to be paid. So three capital assets, two conditions. So if any one of the three capital assets are transferred, and if both the conditions are satisfied, then only section 112A or 111A gets attracted. What are both the conditions? This capital asset is required to be transferred. That means listed equity share, unit of equity oriented mutual fund, unit of business trust. That should be transferred by stock exchange, and STT is required to be paid. Then only exemption is available. Otherwise, exemption is not available. Are you able to understand? Next, see, listed equity share, unit of equity oriented mutual fund, business trust. For these three capital assets, you will determine nature, whether it is long term or short term. If the nature is long term capital asset, then section 112A gets attracted. If it is short term capital asset, then section 111A gets attracted. Sir, what is the nature? Morning class we have discussed. Before 23rd July, three categories are there. On or after 23rd July, only two categories are there. So before 23rd July, for listed equity share, unit of equity oriented mutual fund, criteria is 12 months. For units of business trust, criteria is 36 months. Okay. So on or after 23rd July 24, for all three capital assets, criteria is 12 months. If they are held for less than or equal to 12 months, short term capital asset, 111A. If they are held for more than 12 months, long-term capital asset 112A gets attracted. Are you able to understand? Special cost of acquisition. This is important part. What happened on 1st February 2018? Finance Minister brought section 112A or 111A. This is with effect from 1st April 2018. That means what? Before 1st April 2018, if you sell listed equity shares or if you sell units of equity oriented mutual fund, you are not required to pay capital gain tax. But capital gain tax was brought from 1st April 2018. So, relaxation was given. What is relaxation? Those who purchased before 1st February 2018 and transferred on or after 1st April 2018. Are you able to understand? They purchased before 1st February 2018 and transferred listed equity shares on or after 1st April 2018. They are innocent buyers, na? See, after 1st February 2018, I know tax is there on sale of listed equity shares. But before 1st February 2018, I do not have knowledge that there is tax on sale of listed equity shares. So the thing is, those who purchased listed equity shares before 1st February 2018, they are innocent buyers. So those who are purchasing before 1st February 2018 and are transferring on or after 1st April 2018, for them relaxation was given. What is that relaxation? Special cost of acquisition is allowed as deduction. Special cost of acquisition allowed. It will be calculated in 2 steps. Step 1, full value of consideration or fair market value as on 31st January 2018, whichever is lower. Step 2, cost of acquisition is equal to step 1 or actual cost, whichever is higher, that is allowed as deduction. Is it clear? Indexation benefit is not available. That means even though capital asset is long-term capital asset, even though capital gain is long-term capital gain under section 112A, still indexation benefit is not available. So this is all about section 112A or 111A. So did you understand 112A or 111A? Shall I proceed further? Now we will discuss tax rates. Very, very, very important. Tax rates, very, very important, because before 23rd July 24, after 23rd July 24, variations are there. So please listen carefully. Long-term capital gain under section 112A, just now we have discussed. Whatever long-term capital gain under section 112A is there, it is exempt up to 1.25 lakhs. Above 1.25 lakhs, it is taxable. Sir, what is the tax rate? If listed equity shares, units of equity oriented mutual fund, units of business, If they are transferred before 23rd July 2024, then tax rate applicable is 10% flat rate. If they are transferred on or after 23rd July 24, then tax rate applicable is 12.5% flat rate. So very simple. Overall, for entire 24-25, exemption available is 1,25,000 rupees. Before 23rd July, if capital asset is transferred, tax rate is flat 10%. On or after 23rd July, if capital asset is transferred, tax rate applicable is 12.5%. Long term capital gain under section 112. Rate of tax long term capital. See, before 23rd July 2024, there is concept of indexation. But on or after 23rd July 2024, there is no concept of indexation. So before 23rd July 2024, if asset transferred is listed securities other than a unit or a zero coupon bond, then like long term capital gain under section 112. Before 23rd July 24, on or after 23rd July 2020. Okay, so before 23rd July 2024, if capital asset is listed securities other than units, zero coupon bonds. For these two options are available. What are two options? Claim indexation benefit, pay tax at the rate of 20%. That is option 1. Second option, don't claim indexation benefit, pay tax at the rate of 10%. That is option 2. For other assets, two options are not available, only one option, claim indexation benefit, pay tax at the rate of 20%. Okay, on or after 23rd July 2024, any capital asset, if it is long-term capital asset, then don't claim indexation benefit. Indexation benefit is not available on or after 23rd July 2024 and you are required to pay tax at the rate of 12.5%. You are required to pay tax at the rate of 12.5. But there is one exception. So we can conclude on or after 23rd July 24, if there is a transfer of any long-term capital asset, indexation benefit is not available on or after 23rd July 2024 and you are required to pay tax at the rate of 12.5%. Only in one situation, indexation benefit is. Shall I tell the exception? Everybody, shall I discuss the exception? Shall I tell the exception? Exception. Four conditions are there. First condition, SSC should be resident individual or HUF. Only for resident this benefit is available. Second condition, capital asset must be immovable property. Condition 3, it should be purchased before 23rd July 24. Condition 4, it should be transferred on or after 23rd July 24 or after 23rd July. If all these four conditions, what is the conjunction? Conjunction is and. All the four conditions are required to be satisfied. If all these four conditions are satisfied, then If all these four conditions are satisfied, while calculating long-term capital gain under section 112, okay, full value of consideration, you will not claim indexed cost of acquisition. Indexed cost of acquisition is not allowed. Only cost of acquisition will be allowed. Okay. And you will calculate long-term capital gain under section 112. This will be included in total income. Included in total income. Listen till the end, you will get complete clarity. I think you have already listened to this concept in amendments class or in booster lecture. Now, but while calculating tax, while calculation of tax on long-term capital gain under section 112, then two options are available. Option 1, claim indexation, tax at the rate of 20%, or option 2, don't claim indexation, tax at the rate of 12.5%. Out of these two, whichever is beneficial to the SSC, that will be whichever is. So I can conclude one point. On or after 23rd July 24, if resident individual or resident HUF, if they are transferring immovable property on or after 23rd July 24, they can still claim indexation benefit while calculating the tax. Able to understand? So generally, after 23rd July 2024, there is no concept of indexation, even though asset is long-term capital asset, except in case of resident individual, resident HUF. So even after 23rd July 2024 also, if capital asset is transferred by resident individual or resident HUF and that capital asset is immovable property, if it is purchased before 23rd July and transferred on or after 23rd July, if all these four conditions are satisfied, then exemption is available under section 54. Exemption is available, exemption, then indexation benefit is available even after 23rd July 2024 also while calculating the tax sum. Are you able to understand? See, when you are calculating total income, indexation benefit is not available. In total income, indexation benefit not available. But in calculation of tax liability, indexation benefit is available. Are you able to understand? That is the concept. So are you clear with regard to tax rates? Sharon, buyback, short-term capital gain. Short-term capital gain under section 111A. Before 23rd July 24, tax rate is 15%. On or after 23rd July 24, tax rate is flat 20%. Short-term capital gain other than 111A, normal tax rates are applicable. That means either default tax rates or optional tax rates are available. So that's it. We also had 1.5 hour session in the afternoon. Current buyback, this is small concept. You can watch booster lecture or you can watch revision lecture, hardly 10 to 15 minutes. Please watch that. So all important concepts in capital gains are completely covered in this revision. If you want to ask anything, you can ask. Because I have some client calls at 7 o'clock, I have final revision class also. I have to wind up. Preparation tips. Yes. First of all, minimum 3 revisions you should do. Without doing 3 revisions, you should not go to examination. If you go, high chances that you will feel examination as. Secondly, you should solve as many problems as possible. If it is CA inter exam, definitely he will test your conceptual knowledge. So you have to prepare very conceptually every concept. You cannot take light. If it is CMA exam, okay, fine. He will not go to very in depth, but CA exam definitely he will go. So let's do one thing. Actually, from tomorrow for next 3 days, I need to go out of my place because like funeral is there. Again, shall we conduct PGBP on Monday? Is it possible? From Monday onwards, I will give schedule. As per that schedule, every alternative day I will take class for CA Inter as well. Is it fine? Hello, are you there? Okay, thank you. Special thanks to Charan, Sinduri, Usha, and there is another guy, Gokul Sai. I don't know whether he is listening from morning. Special thanks to these three people. They are listening and in live chat also they are participating very effectively. Thank you so much for your cooperation. Okay, let's again meet on Monday. Thank you. Bye. Monday class I will take live from Hyderabad. Abhi to I am in Vijayawada, but from 4th, which is Monday onwards, I have a new batch. CA Inter, CMA Inter new batch at Lakshya, Hyderabad. Okay, bye. Thank you. If you have any doubts, you can ask in Telegram group. Not a problem at all. Okay. Now let us start discussing income from other sources. Last head of income. We finished our discussion with regard to house property, salaries, PGBP, capital gains. Now let us start discussion with regard to income from other sources. Section 56 to 59. These are the sections covered under the head income from other sources. What are the sections? 56 to 59. Charging section is section 56. So charging section in any head of income, charging section will specify certain conditions. If those conditions are satisfied, income is taxable under that particular head. Even under other sources also, section 56, charging section has specified some conditions. Only if those conditions are satisfied, income is taxable under the head other sources. Shall we see those conditions? There must be an income. Such income is not exempt, because if income is exempt, will it be taxable? It is not taxable. So there should be an income. Such income should not be exempt. Such income should not be chargeable under other heads of income. That means we call income from other sources as residuary head. Those incomes which are not taxable under earlier four heads of income will be taxable under the head income from other sources. Are you able to understand? So for an income to get taxed under other sources, three conditions are required to be satisfied. There should be an income, such income should not be exempt, and such income should not be taxable under other heads. If these three conditions are satisfied, income is taxable under the head other sources. Hello, Mr. Krishna. What is the method of accounting followed? Under the head PGBP as well as under the head other sources, method of accounting followed is same. Accrual or cash basis, whichever is beneficial to the SSE. That means whatever the method of accounting followed by the SSE is there, whether it is accrual basis or cash basis, that method of accounting is applicable for calculation of income under the head other sources. Is it clear? Except interest on compensations and dividends, because interest on compensation is always taxable under other sources. First important concept under other sources is gift concept. Okay, lot of weightage is there. Question can be asked in any way. The concept is a little bit complex, many conditions are there. So listen very carefully, it will be very easy only. First of all, gifts are taxable in the hands of all SSEs. That means what? Once upon a time, when I used to study CA IPCC, at that time gift is taxable only in the hands of individual or HUF. But nowadays gift is taxable in the hands of all SSEs. Are you able to understand? Next, gifts are taxable only if the value of benefit is exceeding 50,000 rupees. Let's say I received a gift. I received small gold coin. Value of gold coin is 11,000 rupees. That gift is not taxable because value of gift is less than 50,000. So gift is taxable for all SSEs and gift is taxable only if value of gift is more than 50,000. Value of benefit received is more than 50,000. Next, gift are taxable whether recipient is resident or non-resident. Gift are taxable whether donor is resident or non-resident. What do you mean by this? Let's say there is donor, there is recipient. Okay. The person who gave gift is resident. The person who received gift is resident. Whether that gift is taxable? Yes, it is taxable. The person who gave gift is resident. Recipient is non-resident. Whether that gift is taxable? Yes. The person who gave gift is non-resident, recipient is resident. Whether it is taxable? Yes, it is taxable. The person who gave gift is non-resident, the person who received gift is non-resident. That gift is not taxable. Are you able to understand? Now, did you understand the point? Though donor can be either resident or non-resident, recipient can be either resident or non-resident. But if donor and recipient both are non-residents, means that gift is not taxable. Think logically. Okay, person who is there in Australia gifted a gift to another person who is located in USA. That means one non-resident in one country is giving gift to another non-resident in another country. Why the hell will it get taxed in India? It will not be taxed in India. Are you able to understand? There is no nexus. Next, gift in kind are taxable only if such asset is covered under the definition of property. That if you have received gift in cash, if value of gift is more than 50,000, it is fully taxable. But you have received gift in the form of kind, then you have to check whether the gift that is received in the form of kind, is it falling under the definition of movable asset or not. Okay, only if it is considered as movable asset or only if it is covered under the definition of property, then only gift is taxable. Here property definition was given, you can see. Property means, in case of immovable property, property means land or building or both. In case of movable property, property means jewelry, drawing, painting, sculpture, archaeological collection, work of art, shares, securities, virtual digital assets. So whatever exceptions to definition of personal effect are there, all are given here. That means what? I received watch as a gift. Now, in that watch, no jewelry is there. It's a plain watch. Even the watch value, I received a Tissot watch worth 78,000 rupees. Even the value of watch is more than 50,000, still that gift is not taxable because watch is not covered under the definition of property. Is it clear? So whenever you are receiving gift in the form of kind, whenever you are receiving gift in the form of kind, that is taxable only if it is covered under the definition of property. You received iPhone as a gift, whether iPhone is jewelry, whether iPhone is drawing, whether iPhone is painting, sculpture, whether iPhone is shares and securities, whether iPhone is virtual digital asset. No, even if you receive iPhone, even iPhone value is more than 50,000, still it is not taxable. I will tell another example also. Your friend gifted Audi Q7 worth 70 lakh rupees. Even though Audi Q7 is gifted to you, even though its worth is more than 50,000 rupees, still it is not taxable because car is not covered under the definition of property. It's a loop. Okay. So, gift in kind is taxable only if it is covered under the definition of property. What is the definition of property? In case of immovable property, land, building or both are considered as property. In case of movable property, jewelry, drawing, painting, sculpture, archaeological collection, work of art, shares, securities, virtual digital assets. Only these are covered under definition of property. That means only if these assets are received as gift, then only gift taxation is applicable. Other than the assets covered under the definition of property, if any other asset is received as a gift, gift taxation is not applicable. Best example, watch, mobile, car, okay, refrigerator, someone gifted you air conditioner, someone gifted you washing machine, okay, those are not covered under the definition of property. Even though their value is more than 50,000, such benefit is not taxable. Let's say my friend recently went to Singapore. He told me he will bring me one camera. This camera does not belong to me. This camera belongs to KS Academy. Let's say worth of this camera is 90,000 rupees. Let's say, for example, of course I will pay him money. For example, I did not pay him any money. He gifted that camera to me. Now that camera is not taxable to me because camera is not covered under the definition of property. Is it clear? Are you able to understand? But if I use it in my profession, okay, I can claim depreciation. At that time, if it is first hand asset, actual cost I will take. If it is second hand asset, original cost minus notional depreciation. Do you remember? Bhul gaya? We have discussed very clearly depreciation. Next, gift in kind are taxable only if such asset is treated as capital asset in the hands of recipient. What do you mean by this? Let's say there is me, there is my friend. I gifted a building to my friend. In hands of my friend, building is capital asset, right? So this gift is taxable. That gift is taxable. This is case 1. Case 2. I gifted a building to my friend whose name is Satish. Satish's main business is real estate business. His main business is real estate business. As I wanted to encourage my friend, whatever the land that I am having, for example, I gifted that land to my friend Satish. On that land, he constructed flats and he sold all those flats. That means whatever the land that I gifted to my friend, he is not using as a capital asset, he is using it as a stock in trade. Okay, what I gifted building. What is the nature of building in the hands of Satish? Nature of building is stock in trade. Now whatever the gift that I have given, that gift is not taxable in the hands of Satish. Are you able to understand? That means in the hands of recipient, whatever the gift that is received, if such gift is stock in trade in the hands of recipient, such gift is not taxable in the hands of recipient. Are you able to understand? First, gift concept is applicable for all SSCs. Gift is taxable only if value of benefit is more than 50,000. Gift is taxable irrespective of whether donor is recipient or non-resident, irrespective of whether recipient is resident or non-resident. Gift is taxable only if such gift is covered under the definition of property. Next, gift is taxable only if such gift is treated as capital asset in the hands of recipient. Are you able to clear cut, like crystal clear with the concept? Next, gift is exempt in following cases. In certain cases, gift is not taxable, gift is exempt. When if gift is received from relative. Very important. In your families also, the moment your relatives come to know that you are studying chartered accountancy, they will immediately call you and ask, "Are I am gifting gift? I'm giving gift to so and so person. Who is my relative? Will it be taxed under income tax or will it be exempt?" So, in order to answer that question, you should be very clear with regard to definition of relative. Only if recipient is covered under the definition of relative, then only gift is exempt, otherwise gift is taxable. Is it clear? Sumit, in the first hour you are sleeping. Are you into dreams and listening income from other sources? Now, shall I explain who is considered as relative? In case of individual, always who is considered as relative first? Spouse. Else war will happen. So, in case of individual, first relative is spouse. Next, second relative is brother and sister of the individual. Okay, sisters, I mean individual's brother, individual sister. Next, third relative is brother and sister of spouse of the individual. That means spouse's brother, spouse's sister is also considered as relative. Next, fourth, brother and sister of parents of the individual. Individual will have mother or father, right? So mother's brother, mother's sister, father's brother, father's sister. They are also considered as relative. Under fourth point. Under fifth point, lineal ascendant. Lineal ascendant means what? Three generations upwards. Mother, father, grandmother, grandfather, great grandmother, great grandfather. What you call Jejamma, Mayamma. Oh. Next, under fifth point only, lineal descendant is also covered under definition of relative. Lineal descendant means son or daughter, grandson or granddaughter, great grandson or great granddaughter. Under sixth point, spouse's lineal ascendant and spouse's lineal descendant are covered under the definition of relative. That means spouse mother father, spouse grandmother grandfather, spouse great grandmother great grandfather. And spouse lineal descendant means this only, right? Next, under seventh point. Before I explain seventh point, let us revise 6 points. First, who is considered as a relative? Spouse is considered as relative. Second, not only spouse, brother and sister of the individual are considered as relative. Third, brother and sister of spouse of the individual are considered as relative. Next, brother and sister of parents of the individual are considered as relative. That means like maternal uncle, maternal aunt. Okay. Now, fifth point, lineal ascendant and lineal descendant of the individual. Individual's mother, father, individual's grandmother, grandfather, individual's great grandmother, great grandfather. Lineal descendant, individual's son or daughter, individual's grandson or granddaughter, individual's great grandson or great granddaughter. Okay. Under sixth point, spouse's mother or father, spouse's grandmother or grandfather, spouse's great grandmother or great grandfather. Lineal descendant is same. Under seventh point, those who are covered under second point to sixth point are there. Even their spouses are also considered as relative. So under second point, brother's spouse, sister's spouse is relative. Spouse, brother's spouse, spouse, sister's spouse is also considered as relative. Mother's brother's spouse, mother's sister's spouse, father's brother's spouse, father's sister's spouse. They are also considered as relative. Next, son or daughter and their spouse, grandson or granddaughter and their spouse, great grandson or great granddaughter and their spouse are also considered as relatives. You always have to check from receiver point of view. From receiver point of view, if donor is relative, then such gift is fully exempt. So first, from whose, whenever you see SSC in the question, assume yourself as the SSC. So if the donor is relative to you, then that gift is fully exempt. Are you able to understand? You have to check from recipient point of view. If the donor is relative, such gift is fully exempt. Now I will ask you one question. My sister's daughter, she is very cute. She gifted me one gold chain. Now, whether that gift is exempt to me or taxable to me. Here, who is receiver? I am the receiver. You should check from my point of view. Who is the donor? Sister's daughter. Sister is covered under the definition of relative, but sister's daughter is not covered under the definition of relative. Now reverse. As my sister's daughter is very cute, I gifted her gold chain. Whether that gold chain is taxable to her or not. Who is receiver? My sister's daughter. My niece is recipient. Who is donor? I am the donor. From whose point of view you should check? From donor point of view will you check? No. From this. So my niece point of view, mother's brother gifted to my niece. So mother's brother means obviously relative, right? So such gift is fully exempt. Are you able to understand? So, relative definition very crucial. I will once again summarize it. In case of individual, spouse is relative. Not only spouse, brother and sister of the spouse are relative. Brother and sister of spouse of the SSE is relative. Next, brother and sister of parents of the individual are relative. Lineal ascendant and lineal descendant of the individual. Lineal ascendant and lineal descendant of spouse of the individual. From second point to sixth point, whoever got covered, even their spouses are also considered as relative. Okay. So did you understand relative tree? Mind tree laga relative tree. Next. At the time of marriage of the individual, if any gift is received, at the time of marriage of individual, if any gift is received, such gift is fully exempt, irrespective of count of marriages. Even if he gets married for 10th time or 15th time, still whatever the gift that is received, it is fully exempt, full happy. So you can do tax planning. Whenever any person wants to gift you, you can hold on them. Sir, next month I'm going to get married, don't give now, give it on the date of my marriage. Next, under a will or by way of inheritance. So let's say father died, all properties of father got inherited by son. So by way of inheritance, if any capital asset is received, if any assets are received, it is not taxable. In contemplation of death of the payer or donor, applicable only for movable properties. Let's say there are old people, old grandmother and grandfather are there, they do not have any children. However, Mr. A and Mrs. A have done service to old grandmother and old grandfather during their last days. As a token of gratitude, that old grandmother and grandfather transferred all properties to Mr. A and Mrs. A. Whatever the movable property that is received by way of contemplation of death of the donor. Okay, movable properties received are exempt. However, immovable properties received will be taxable. From any local authority, if any gift is received, such gift is fully exempt. So you performed in one concert, conducted by GHMC, Greater Hyderabad Municipal Corporation. So GHMC paid you some 2000 rupees or 3000 rupees, whatever the amount that you have received. Of course it is less than 50,000, but whatever the gift that is received from local authority is there, such gift is fully exempt. Next, trust registered under section 12AA, university or education institution registered under section 1023C. Listen carefully. Listen. Trust registered under section 12AA, hospital registered under section 1023C, education institution registered under section 1023C. 12AA, 1023C, you are going to study in your final. Okay, don't think much, but please remember, any trust that is registered under section 12AA, any education institution or university or hospital registered under section 1023C. For these institutions, even if you give any gift, that is fully exempt to them. From them, even if you receive any gift, such gift is fully exempt. Is it clear? That means gift given to them, gift received from them, such gift is fully exempt. Okay, trust registered under section 12AA and education institution, university, hospital registered under section 1023C. So if even if you give any gift or if you receive any gift from them, such gift is fully exempt. Next, there are exceptions to definition of transfer, right? Transfer of capital assets at the time of partition of HUF from Indo-divided family to small family. Transfer of capital assets from amalgamating company to amalgamated company. Transfer of capital assets from demerged company to resulting company. Do you remember all those? So in all those cases, in the hands of transferor, capital gains are not required to be calculated because the transaction is excluded from definition of transfer. Even in the hands of recipient also, that is not taxable because that is excluded, like that is covered under exempted cases of gift. Is it clear? మనకి నిద్ర వస్తుందా హాయిగా క్లాస్ చెప్తుంటే జోల పడుతున్నట్లు ఉంది వాడికి అర్థమైందా If gift is received from an individual by a trust created or established solely for the benefit of relative of the individual. So let's say an individual loves his mother so much. Okay, in the name of his mother, he started the trust. Whatever the properties that he is having, land and building, he transferred those buildings, land and building in the name of the trust. And the trust was created solely for the benefit of the mother, solely for the benefit of the relative of the individual. So to that trust, even if any property is transferred in the hands of trust, such gift is not taxable, it is fully exempt. Next, any gift received by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family. What do you mean by this? Let's say SSC or family members, SSC or family members, they are suffering with COVID-19. They are suffering with COVID-19. Treatment of COVID-19. For treatment of COVID-19, medical bills are paid. Medical bills are paid by another person. Whatever the medical bills paid by another person, it is gift, right? For example, hospital bill is 4 lakh rupees. 4 lakh rupees is paid by friend. That 4 lakh rupees is also in the nature of gift, which is greater than 50,000 rupees. But that benefit is not taxable. That benefit which is in the nature of gift, it is fully exempt. Are you able to understand? So by way of reimbursement of COVID-19 medical bills, if any amount is received in the form of gift, even though such amount is more than 50,000, such benefit is not taxable, such benefit is fully exempt. Are you able to understand? Now read that point, you will get clarity. Gift received by an individual from any person, that means from any third party, in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness relating to COVID-19, subject to satisfaction of these conditions. Shall I explain the next point? Everyone, see the last point. If any gift is received by any member of the family of a deceased person from his employer or from any other person subject to some conditions, you can see from employer of the deceased person without any limit, or from other person or the persons to the extent that such sum or aggregate of sums should be less than or equal to 10 lakhs subject to following conditions. What do you mean by this? SSC hit the bucket, individual hit the bucket. Okay. After death of individual, family persons received compensation. Family persons received compensation. That means what? Let's say individual is there. He got COVID-19 and he died. His family has nothing. No one is there to take care of the family. In this situation, someone came forwarded to help such family. Compensation was given. If compensation is received from employee, if compensation is received from employer of deceased individual. Deceased individual means those who died. If compensation is received from deceased, if compensation is received from employer of the deceased individual, okay, total compensation is fully exempt. Total compensation is fully exempt. If compensation is received from any other person, if compensation is received from any other person, if compensation is received from any other person, in that case, such compensation, all compensations together, if it is less than or equal to 10 lakhs, then it is exempt. If all compensations together, if it is greater than 10 lakhs, then excess is taxable. Is it clear? So upon death of an individual, if any compensation is received, if such compensation is received by family members from the employer of the deceased person, then total compensation received is fully exempt. If compensation is received from any other persons, all compensations received together, aggregate compensations received, if it is less than or equal to 10 lakhs, fully exempt. If it is greater than 10 lakhs, then excess is taxable. Okay. But two conditions are required to be satisfied. The cause of death of such person should be because of COVID-19. Payment is received within 12 months from date of death of such person. What do you mean by this? The date on which individual died because of COVID-19. From that date onwards, within 1 year, compensation should be received. Then only exemption is available. Otherwise, exemption is not available. Okay. And in case of individual, family means who? Spouse and children of the individual, parents, brothers and sisters of the individual, wholly or mainly dependent on such individual. Okay, they are considered as family members. Now, shall we see valuation of gifts? Everybody, listen very, very carefully. Okay. Don't look at the material, just look at the screen. You will get complete clarity. Gift can be received either in the form of cash or in the form of kind. Correct? Do you agree with me? Gift in kind can be received either in the form of, please tell they are talking, ask them not to talk. Movable property. Gift in the kind can be either in the form of movable property or in the form of immovable property. Do you agree with me? Gift received in the form of movable property can be received either for without consideration or for inadequate consideration. What do you mean by this? For example, tomorrow Kaushik became so rich, I already told you, he became gold businessman. One fine day I went to his gold shop. He said, "Sir," I said, like I wanted to purchase one small bracelet for me. I said, "Sir, you already have me, sir. But I have, I have interest for bracelets." I said, "I wanted to purchase another one." So he personally took me to that bracelet section. He showed me all the bracelets. He showed me the latest one. He showed me the one with utmost purity and all. I said, I selected one bracelet. The cost of bracelet is 1,80,000 rupees. But Kaushik said, "Sir, because of you only, I finished DT." Okay, he did not, after qualifying, he said, okay, now he is not saying. If he says now means it's like mixing tiger rice. Yeah. So then he said, "Sir, for you, I will give it only for 80,000 rupees, sir." 1,80,000 worth of bracelet, he gave it only for 80,000 rupees. All these are dreams. Okay. Even though you do business, he will not give it to me. Correct? ఏంటి చాలు చాలు అది కూడా ట్యాక్స్ఫుల్ Now, 1,80,000 worth of bracelet is there. He gave it only for 80,000 rupees. I paid only 80,000 consideration. I did not pay 1 lakh rupees. So how much inadequate consideration is there? 1 lakh rupees. That is greater than 50,000. That is also taxable to me. So gift can be received either at free of cost, that we call as without consideration, or gift can be received for inadequate consideration. Is it clear? Next. In case of immovable property also, gift can be received either for without consideration or gift can be received for inadequate consideration. In total, how many cases are there? 1, 2, 3, 4, 5. So did you understand? I just gave you outline. I did not explain the tax treatment. But like in case of taxability of gifts, in case of valuation of gifts, there are 5 different cases. Case 1, gift that is received in the form of cash. Case 2, gift received in the form of movable property for without consideration. Case 3, gift received in the form of movable property for inadequate consideration. Case 4, gift received in the form of immovable property for without consideration. Case 5, gift received in the form of immovable property for inadequate consideration. Is it clear? Are you able to understand? Now, shall I explain the tax treatment? Is it simple with the example? Okay, I'll go ahead. First, cash gift received. Cash gift received. This is case 1, right? Remember, individual cash gift not. Aggregate of all cash gifts received in a financial year. So here, do you need to check for each individual cash gift or do you need to check for aggregate of all cash gifts? You need to check for aggregate of all cash gifts. Is it clear? So aggregate of all cash gifts in a financial year. Aggregate of all cash gifts in a financial year. If it is less than or equal to 50,000, then it is fully exempt. Aggregate of all cash gifts in a financial year, if it is greater than 50,000, not excess, fully taxable. Okay. If all cash gifts received during the previous year are greater than 50,000, then fully taxable. Okay, don't tax excess. If you cross the threshold limit, from first onwards he is going to tax. Whole gift is fully taxable. So did you understand case 1? Shall I explain case 2? Everybody, if gift is received in the form of kind, kind gift is classified into 2 types, right? Kind gift can be received either in the form of movable property or in the form of immovable property, correct? Either in the form of movable property or in the form of immovable property. If gift is received in the form of movable property, such gift can be received either for without consideration or for inadequate consideration, correct? So case 2, case 3. Shall I explain? Movable asset received for without consideration. Here also you should check aggregate. That means aggregation of all movable assets received for without consideration. If that aggregate fair market value, in case of movable asset we will consider fair market value. Aggregate fair market value of all movable assets received for without consideration in a financial year. If it is less than or equal to 50,000, fully exempt. If it is greater than 50,000, not excess, fully taxable. Is it clear? Now, write down. Aggregate fair market value of all movable assets received in a financial year. All movable assets received in a financial year. If it is less than or equal to 50,000, then it is fully exempt. If it is greater than 50,000, then it is fully taxable. So for this also you need to consider aggregate value. You should not consider individual value. Two checkpoints. You should consider aggregate value and you should not consider individual value. Shall I explain further third case? Now, inadequate consideration means what? Inadequate consideration means difference between fair market value and actual consideration. Do you agree with me? The bracelet worth is 1,80,000 rupees. How much I paid? 80,000 rupees I have paid. So difference between 1,80,000 and 80,000 is 1 lakh rupees. That is the benefit received by me. That 1 lakh rupees we call as inadequate consideration. Consideration which was not paid by the individual. Correct? So here also we need to consider aggregate value. Okay, so if aggregation of difference between fair market value and actual consideration for all movable assets received for inadequate consideration, all movable assets received for inadequate consideration, if that is less than or equal to 50,000, then it is fully exempt. If aggregate of fair market value minus actual consideration is greater than 50,000, then total value of the asset is not taxable. Only benefit is taxable. Aggregation of all benefits together will be taxable. Is it clear? Fully taxable. Because think logically, I paid 80,000 rupees. So to the extent of 80,000 it is not taxable. Whatever the 1 lakh rupees that I did not pay, only that benefit, only that inadequate consideration is taxable. So for all movable assets received for inadequate consideration, all inadequate considerations together, if aggregate of inadequate considerations is greater than 50,000, all inadequate considerations are fully taxable. Is it clear? So when you are reading, read like this, fully taxable. The moment you read the word fully means you will forget excess and you will tax it completely. Okay. Next, shall I explain further? Immovable property. Immovable property can be received either for without consideration or for inadequate consideration. Correct? Am I correct? Immovable property received for without consideration. Then for each immovable property, that means here am I considering aggregate value or individual value? Here I am considering individual value. For each immovable property, if stamp duty value is less than or equal to 50,000, then it is exempt. If stamp duty value is greater than 50,000, then it is fully taxable. Next, shall I explain last case, case 5? In case 5 also, we need to check for each immovable property. For each immovable property. Here it will be a bit different. Listen, you will understand. For each immovable property, if stamp duty value minus actual consideration is greater than 50,000 or 10% of actual consideration, whichever is higher, then taxable value is equal to stamp duty value minus actual consideration. B. If stamp duty value minus actual consideration is less than or equal to 50,000 or 10% of actual consideration, whichever is higher, then taxable value is equal to 0. Taxable value is equal to nil. Do you remember section 50C? In section 50C, for stamp duty value, up to 10% deviation was accepted, right? Stamp duty value is less than or equal to 110% of actual consideration, then actual consideration is to be taken as full value of consideration. Here also, in case of immovable property, what we are taking as base, stamp duty value we are taking as base. So stamp duty value cannot be exactly equal to value of the property. There will be deviations. That's why up to 10% deviation or general limit of 50,000, whichever is higher. Up to that limit, if there is difference, that is acceptable, not taxable. However, if difference is greater than 10% deviation or generally allowed 50,000, out of these two, whichever is higher. If difference is greater than the higher amount, then in such a case, inadequate consideration is taxable. Are you able to understand the logic? Why 10%? See, here if I have written 5,000 rupees, no doubt to you. Am I correct or not? Here also if I have written 50,000, no doubt is there because gift is exempt up to 50,000 rupees. But 10% deviation is also allowed by department. So 50,000 rupees or 10% deviation, whichever is higher. Okay. If the deviation is till that point, then gift is not taxable. Inadequate consideration is not taxable. If difference is more than that, then inadequate consideration will become taxable. Is it clear? So this is with regard to valuation of gifts. Another point, if gift is received from employer, it is not taxable under other sources, it is taxable under the head income from salaries. Are you able to understand? And if gift is received during the course of business or profession, it amounts to perquisite and it is taxable under the head PGBP. Is it clear? Everybody? Now, dividend. Once upon a time, there is a concept of dividend distribution tax (DDT), but nowadays there is no concept of DDT. Whatever the dividend that is received by individual is there, by SSE is there, whether it is from Indian company or foreign company, such dividend is fully taxable in the hands of the recipient. Okay, so whenever you see dividend, tax it under other sources. Okay, next. Not only dividend, even if any deemed dividend is received, such deemed dividend is also income that is taxable under other sources. So, what do you mean by deemed dividend? If accumulated profits of the company are distributed to shareholders, such distribution of accumulated profits to shareholders we call as deemed dividend. First, distribution of accumulated profits, whether capitalized or not, by a company to its shareholders is a dividend if it entails a release of all or any part of its assets. What do you mean by this? For example, if dividend is paid in cash, it is taxable, right? So dividend was not paid in cash. Dividend was paid in the form of assets. Then Act said even if dividend is paid in the form of assets, it is fully taxable in the hands of shareholders only to the extent of accumulated profits. What do you mean by this? For example, company P&L account is looking like this. Assets 80 lakhs, working capital 10 lakhs. Current liabilities, working capital means nothing but current assets, right? Current liabilities 25 lakhs, equity share capital 30 lakhs, reserves and surplus. How much are reserves and surplus? Calculate total 90, right? 90 minus 25 minus 30. How much? 30. Reserves and surplus are 35 lakhs. Let's say 40 lakhs worth of assets are given to shareholders. Now 40 lakhs is not considered as deemed dividend. Okay, out of 40 lakhs, how much are accumulated profits? Accumulated profits are only 35 lakhs. So out of 45 lakhs, only 35 lakhs will be considered as deemed dividend under section 2 subsection 2 clause A. Is it clear? So not only dividend given in the form of cash, if any dividend is given in the form of assets, such distribution of dividend to the extent of accumulated profits is considered as deemed dividend. So what is important here to remember is to the extent of accumulated profits. Total 40 lakhs is not taxed under other sources. Out of 40 lakhs, accumulated profits are only 35 lakhs. Now I am changing my example little bit. Listen carefully. Out of 35 lakhs, 10 lakhs bonus shares are issued. How much? 10 lakhs bonus shares are issued. Whenever bonus shares are issued, reserves and surplus will decrease by 10 lakhs and equity share capital will increase by 10 lakhs. Do you agree with me? Double entry system. Reserves and surplus. What is the entry that you will pass for bonus? Reserves and surplus account debit to equity share capital. So equity share capital increases by 10 lakhs. So whatever the amount capitalized to equity share capital is there, this we call as capitalization of profits. Is it clear? Even capitalization of profits is also considered as accumulated profits. To that extent, it is considered as deemed dividend. Is it clear? So, any amount distributed to shareholders in the any assets distributed to shareholders to the extent of accumulated profits, whether those accumulated profits are in reserves and surplus or whether those accumulated profits are capitalized to equity share capital. In this case, even though equity share capital is 40 lakhs and reserves and surplus is 25 lakhs, still 35 lakhs is only considered as deemed dividend, because how much are accumulated profits? Accumulated profits are only 25 lakhs and 10 lakhs. So total accumulated profits are 35 lakhs. To the extent of 35 lakhs only, it is considered as deemed dividend. Is it clear? Simple, right? Shall I explain the next one? Distribution to its shareholders by a company of debenture stock, deposit certificate in any form, whether with or without interest, and any distribution of bonus shares to preference shares to the extent to which company possesses accumulated profits. What do you mean by this? Company gave dividend in cash. It is taxable under other sources. Company gave dividend in the form of assets. It is also taxable under other sources. So company thought, if I give cash and if I give assets, it is getting taxed under other sources. So for existing equity shareholder, one debenture was given. That means what? Dividend is paid in the form of extra security. Dividend is paid in the form of additional asset. So for existing equity shareholders or preference shareholders, if any debentures or debenture stock, if any debenture or debenture stock or deposit certificate are given, to equity shareholders. For preference shareholders, if any debenture stock or deposit certificate or bonus shares. For preference shareholders, even issuance of bonus shares is also considered as deemed dividend. So these transactions are considered as deemed dividend in hands of shareholders to the extent of accumulated profits. Is it clear? Very, very, very important. When you are calculating deemed dividend, you should remember what is important is accumulated profits. Only to the extent of accumulated profits it is considered as deemed dividend. Are you able to understand the logic? Are you able to understand the concept? For equity shareholders, if any bonus shares are issued, that is not considered as deemed dividend. But in case of preference shareholders, if any bonus shares are issued, it is considered as deemed dividend. Is it clear? Next. Section 222C. Distribution made to shareholders of a company on its liquidation to the extent to which distribution is attributable to accumulated profits of company immediately before its liquidation, whether capitalized or not. What do you mean by this? Company got liquidated. Company got liquidated. On the date of liquidation. On the date of liquidation. Whatever the accumulated profits are there, if those accumulated profits are given to shareholders, that is considered as deemed dividend in the hands of shareholders. Is it clear? Listen carefully. On the date of liquidation, let's say accumulated profits are 47 lakhs. If these 47 lakhs are given to shareholders, that is considered as deemed dividend. What happened after liquidation? Existing assets in the business will be sold, right? Let's say 80 lakhs worth of building was sold for 120 lakhs. 80 lakhs worth of building was sold for 120 lakhs. How much capital gain is received? 40 lakhs capital gain is received. That means what? This 40 lakhs benefit is received after the date of liquidation. So 40 lakhs is not considered as deemed dividend. That means after the date of liquidation, if there is any profit, that profit will not be considered as accumulated profit and it will not be considered as deemed dividend in the hands of shareholders. Up to the date of liquidation, whatever the accumulated profits that are earned are there, if those are distributed to shareholders, it is considered as deemed dividend. Post liquidation, even if any profit is made, that is not considered as accumulated profits and that is not considered as deemed dividend in the hands of shareholders. Is it clear? Are you understanding the concept? Then appreciate the beauty of the subject, how well they have written. See, all these are loopholes found by us. For every loophole that was found by us, they started keeping counter, okay, through which we are studying deeper concepts. Next, section 222D, distribution to its shareholders by a company on reduction of its capital. Shareholder, like company thought, if I give cash, dividend. If I give assets, deemed dividend. If I give extra security, that is also deemed dividend. Okay, and if I, like at the time of liquidation, whatever the profit made, like up to the date of liquidation is there, that is also deemed dividend. So he decided equity share capital is there, right? Original equity share capital 30 lakhs. Company decided to give back the share capital. That means shareholders took a decision to reduce their capital because already accumulated profits are there. What income tax act says is, when there are accumulated profits, why are you taking back your own share capital? You can take back in the form of dividend, right? That means the reason for taking back share capital without touching accumulated profits is solely to avoid payment of tax on dividends, correct? So then it said that if you take accumulated profits, dividend. If you do not touch accumulated profits and if you reduce your share capital when there are enough accumulated profits, even reduction of such share capital is also considered as deemed dividend and it is taxable under other sources. Is it clear? Shall I explain case 5? Section 222E. 222F I will not teach. Don't ask me to teach. It was already discussed in buyback yesterday. At the time of buyback on or after 1st October 24, whatever the amount received by shareholder from company, it is taxable under other sources. भूल गया एक दिन नहीं. Now 222E. Any payment by a company in which public are not substantially interested of any sum by way of advance or loan to the following persons will be deemed to be dividend to the extent of accumulated profits. to equity shareholder who is holding greater than or equal to 10% voting power. What do you mean by this? First, if any individual is having beneficial ownership of 20% or more in the company, we call such individual is having substantial interest. So for substantial interest limit is 20%. If any individual is having 10% or more than 10% interest, beneficial interest in any company, we call such individual as beneficial owner. So for beneficial owner criteria is 10%, for substantial interest criteria is 20%. Is it clear? Shall I explain further? Now, there is a private limited company or company in which public are not substantially interested. Company in which public are not substantially interested. If this company gives any loan, to beneficial owner means what? Any individual who is having greater than or equal to 10% of equity shareholding in the company, we call them as beneficial owner. So if a private limited company gives any loan to beneficial owner, whatever the loan amount that is given is there, that is considered as deemed dividend in the hands of beneficial owner. Is it clear? Now, beneficial owner thought, if I directly get amount from company, it will be considered as deemed dividend. Even though I get in the form of loan, they are treating it as deemed dividend. So what beneficial owner did? He started a business. In this business, beneficial owner is having 50% stake, his friend is having 50% stake. Now, to this business also, if any loan is given, that loan is considered as deemed dividend. Is it clear? Not only to beneficial owner, if any loan is given to any business in which beneficial owner is having substantial interest. Here he is having like substantial interest, right? Greater than 20% stake. Now, even loan given to such business is also considered as deemed dividend and it is taxable in the hands of beneficial owner. Is it clear? Are you able to understand? Securities premium is not an accumulated profit, and this point I have already explained. Up to the date of liquidation, whatever the accumulated profit is there, only that is considered as deemed dividend. Profit after the date of liquidation will not be treated as deemed dividend. See, if any trade advance is received, that means beneficial owner, if he gets any loan from private limited company, it is deemed dividend. But if loan is in the form of trade advance, that means private limited company is in the business of manufacturing of chairs. Beneficial owner is in the business of selling of wood. So with regard to purchase of wood, advance is given by company to the beneficial owner. Why loan was taken? Loan was taken in the form of trade advance. Now it is not considered as deemed dividend. Is it clear? Next. Private limited company is engaged in the business of banking. So in the normal course of business, loan is received by beneficial owner. That is also not considered as deemed dividend. Is it clear? Next, shall we discuss casual incomes? Section 115 BB, winning from lottery, betting, gambling, horse races, crossword puzzles, all these incomes are taxable under section 115 BB. Big Boss, Kaun Banega Crorepati, Will Ever Kodishwarudu, all these incomes are taxable under the head income from other sources under section 115 BB. Whatever the income that is earned, on this income, straight away 30% tax is applicable, and along with that applicable surcharge and health and education cess is also there. Okay. 4 benefits are not available against section 115 BB income. First, you cannot claim any expenses. You cannot claim any any expenses per section 115 BB income. Like you won a lottery. For earning lottery, let's say you incurred 2000 rupees. You went to that place for playing lottery. That expenditure is not allowed as deduction. Okay, next. Any loss cannot be set off against 115 BB income. That means 115 BB income is fully taxable. Next, chapter 6A deductions cannot be reduced from 115 BB income. Next, basic exemption limit of 2,50,000 or 3 lakhs also you cannot set off against 115 BB income. Is it clear? So he can say directly 115 BB income is fully taxable without any benefit. Okay, but he did not say straight away. He said these benefits are not available. If someone asks where is your nose, you can show like this or you can also show like this. Correct? He showed in a reverse way. Next, owning and maintaining racehorses is different from winnings. For example, horse race is going on. I did betting on horse races. I said black color horse will win. Through this, if I earn any amount, this we call as winnings. Are you able to understand? Professional horse rider, he won any money. That is his professional income, taxable under the head PGBP. Professional horse rider, his horse is sick. So he wanted a new horse to participate in the race. Okay, there is a guy who owns a horse, who owns horse races. He is maintaining those horses. Okay, like he is keeping food, fodder, everything and all. Now, horse racer went to the person who is owning and maintaining race horses and took horse on rent only for the purpose of horse race, and he paid 50,000 rupees amount for taking rent. This 50,000 rupees income we call as income from owning and maintaining race horses. Are you able to clearly understand the difference? Winning from horse races is different, income from owning and maintaining race horses is different. Winning from horse races is purely contingent. We do not know which horse wins. Okay, so that income is taxable under section 115 BB, casual income. Owning and maintaining race horses, there is effort. Okay, like he started purchasing the horses, he started breeding the horses, he kept food for it, so there is some maintenance and all. So by way of giving horse on rent, or like by making horse participate in a horse race, if he gets any stake, that stake we call as income from owning and maintaining race horses. Many people will get confused if they do not have idea. Okay, they will just think winning from horse races everything is same, but it is not same. Both are different. Income from owning and maintaining race horses is taxable separately under the head other sources. For that 30% tax rate is applicable, not applicable. Normal tax rates are only applicable. Another important point, if you are owning and maintaining race horses, you can claim respective expenses, but when you are having income from 115 BB winnings, you cannot claim any expenses. I already told you it is taxable on gross basis. Are you able to understand? You should be clear conceptually. Okay, otherwise ICA will play with you. Next, where certain percentage has to be foregone by the winner to government. ఏంటి అరుస్తారు అక్కడ క్లాస్ చెప్పాలి వద్దా? Now, I won 80,000 rupees in betting. Out of 80,000 rupees won by me, voluntarily I gave 20,000 rupees to central government. If any amount is voluntarily surrendered to central government, that amount is not taxable. Okay, in this case only 60,000 is taxable under the head other sources. Is it clear? Next, interest. Actually, there is some editing mistake. This is not casual incomes. This is interest tax treatment. Please change it here also. Listen quickly. See, I deposited 10 lakh rupees in fixed deposit. From date of deposit up to date of withdrawal, he will pay me interest. That means other than on securities, interest is paid based on period of holding. Do you agree with me? Fixed deposit is not a security. Other than on securities, interest is paid based on period of holding. If SSE is following accrual basis of accounting, on accrual basis he will calculate interest for number of days and it is taxable to the SSE. If SSE is following cash basis, the date on his the date on which he got the interest amount credited to his bank account, on the date that income is taxable. In case of securities, interest is paid not based on period of holding, but interest is paid based on due date. So on due date, for example, due date for payment of interest is 16th March. Today I purchased the debenture. Even though I held the debenture for only one day, still I am entitled to receive 365 days interest. Are you able to understand? So in case of securities, interest is paid not based on period of holding, but interest is paid based on due date. Is it clear? So interest is calculated, interest is payable on due date irrespective of period of holding. Even though I held it for only one day, still total 365 days interest is taxable to me. Are you able to understand? Next, year of taxability. Accrual basis, taxable in the year in which such interest falls due. If a SSE is following accrual basis of accounting, on the due date, whether he gets interest or not, that interest is taxable to him. If he is following cash basis, irrespective of due date, when he got interest, then only it is taxable. Is it clear? Next, I told this point, in case of post office savings account, interest exemption is available up to 3,500 in case of individual account. If it is joint account, 7,000 rupees exemption is available. Next, write down here allowable expenses or deductions. Shall I explain? Family pension received is taxable under other sources. Why? There is no relationship of employer and employee in between employer and family members of the employee. That's why whatever the family pension received, it is taxable under other sources. But total family pension is not taxable. You can claim exemption. How much is exemption? Exemption is equal to 1/3 of pension or 25,000. Very important amendment as per Finance Act number 2 of 2024. 1/3 of pension or 25,000, whichever is lower, under default tax rates. Under optional tax rates, old provision will remain. Under optional tax rates, amount of exemption is equal to 1/3 of pension or 15,000, whichever is lower. Is it clear? 1/3 of pension or 15,000, whichever is lower. This benefit is available under optional tax rates. Major amendment, Finance Act number 2 of 2024. So the family person who is receiving the pension, if they are paying taxes under default tax rates, they can claim exemption up to 25,000 under other sources. If they are paying taxes under optional tax rates, they can claim exemption only up to 15,000 rupees. For example, like family member is receiving pension of 20,000 per month. Okay, let's suppose they are paying taxes under default tax rates. How much is family pension? 20,000 into 12, it will be 2,40,000, correct? From 2,40,000, exemption is allowed. How much exemption is allowed? 1/3 of pension or 25,000, whichever is lower, correct? 1/3 of pension means 80,000, right? Or 25,000, whichever is lower means 25,000 is allowed as, actually this is not exemption, this is deduction. Okay, how much will be taxable? 2,15,000 is taxable under other sources. Is it clear? Did you understand? If any dividend income is received, for example, I took loan of 1 lakh rupees from Kaushik to invest in Reliance Limited shares. Kaushik said, Sir, even though you are faculty to me, I am a businessman. I will not give loan to you at free of cost. Rate of interest is 9%. He said, Idi Yaparam. Okay. So he gave loan of 1 lakh rupees and rate of interest is 8%. I said, okay. I invested this 1 lakh amount in Reliance Limited shares. From Reliance Limited shares, I got a dividend of 25,000. If yours is business, mine is also business, and I earned a dividend of 25,000 rupees. From this dividend, like to earn 25,000 rupees, I paid interest of 8,000 rupees, right? Do you agree with me? So if any dividend income is earned, for that, if you pay any interest expenditure, such interest expenditure is allowed as deduction. Other expenses are not allowed as deduction, but total interest expenditure is also not allowed as deduction, subject to limit. Deduction is equal to 20% of dividend income or actual interest, whichever is lower. 20% of dividend income, 5,000, right? 20 sorry, 25,000 into 20%. అరే నాకు వచ్చింది కొంచెం మ్యాథ్స్. 25,000 into 20%, 5,000 or actual interest 8,000. Whichever is lower means 5,000 is allowed as deduction and balance 20,000 is taxable. Is it clear? Next, interest on compensation or enhanced compensation. We have seen if any enhanced compensation is received, on that if any interest is paid, interest on compensation or enhanced compensation is taxable under other sources, but total is not taxable. 50% deduction is allowed, balance 50% is only taxable. Against winnings, no expenses. I told you, right? Against winning from lottery, betting, gambling, you cannot claim any expenses. Against other income, let's say you are earning royalty income. For earning royalty income, if you pay any expenses, those expenses are allowed as deduction. You are earning income from subletting. Okay, for subletting, if you earn any, like for earning that subletting income, if you pay any expenditure, that expenditure is also allowed as deduction. Do you remember section 37? Section 37 under PGBP, general deduction. There are certain conditions. If all those conditions are satisfied, then all residuary expenses will be allowed as deduction. Expenditure should be revenue in nature. It should be for the purpose of business. It should not be covered under 30 to 37. It should not be a preliminary expenditure. It should not be a penalty. If all these conditions are satisfied, expenditure is allowed as deduction. Same section 37 provision is given here also. That means under the head other sources, to earn any income, if any expenditure is incurred, that expenditure should satisfy these conditions. That expenditure should be revenue in nature. Okay, that expenditure should not be capital in nature. That expenditure should be purpose of earning income under other sources. If all these conditions are satisfied, then only expenditure is allowed as deduction. I am earning royalty income. To type the book, I recruited one assistant. For that assistant, I am paying amount. So this expenditure is paid with regard to earning royalty. Now this expenditure is revenue expenditure. It is not capital expenditure. Okay, and it is solely incurred for earning royalty income. If all these conditions are satisfied, 10,000 rupees salary paid to assistant is allowed as deduction. Is it clear? Next, you know, right, personal expenditure is not allowed as deduction. So whatever, this is 40A1 provision. I think I have discussed very clearly 40A1. 40A1A also have discussed. Okay, next I have discussed 40A3. 40A3. Next I have discussed 40A2. So whatever 40A2, 40A3, 40A1, 40A1A, these provisions under PGBP are there, same provisions will also apply under other sources. Is it clear? So it's all about income from other sources. Yes, now let us start discussing about clubbing of income. Sometimes what happens, income of another person is also clubbed in the hands of the SSC. What many people are doing to avoid payment of taxes, they are diversifying the income, like to utilize the basic exemption limit. So to prevent such kind of transactions, clubbing of income provisions were being introduced. Let us start discussing one by one. Section 60, transfer of income without transfer of asset. What do you mean by this? Let's say there are two people, A, B. A is having shares. Even though A is owner of shares, on shares there will be dividend that is received, right? Dividend on these receives, dividend received on these shares is transferred to B. That means what? Whether A is transferring shares, A is not transferring shares. But whatever the income on shares is there, income on shares is transferred to B. For example, A is government employee. He is already getting 20 lakhs. He is required to pay 30% tax. If dividend on shares is received, on dividend also he is required to pay 30% tax, right? B is his security guard. His security guard income will be less than basic exemption limit. So intentionally he diversified his income on shares in the name of the security guard. He is not transferring shares, but he is transferring income on shares. So whenever income on asset is transferred without transferring the base asset, in such a case, even though income is received by B, such income is not taxable in the hands of B. Such income will be clubbed and taxable in the hands of this. That income will be clubbed and taxable in the hands of Mr. A. Are you able to understand? So transfer of income without a transfer of asset. In such a case, even though income is received by transferee, such income is not taxable in the hands of transferee. Such income will be clubbed and taxable in the hands of transferor. Are you able to understand? Good. Next, revocable transfer of asset. First, when we call a transfer as revocable transfer, a transfer is deemed to be revocable if it contains any provision for retransfer directly or indirectly of the income or assets to the transferor. What do you mean by this? Let's say A is transferring his building to B. Building to B. There will be transfer agreement, right? In that transfer agreement, if any one of the following two conditions are there. Condition 1, right to reacquire asset. Right to reacquire asset. Or right to reacquire income. Right to reacquire income. Such reacquisition of income can be either full income or part income. For example, I wanted to transfer building to Kaushik, but Kaushik cannot sell that building to third party. If he wants to sell that building, he should sell back to me. That is the condition that I have written in the agreement. That means I have right to reacquire the asset from Kaushik at any point of time. Another point also I have written, whenever I wanted asset, whenever I wanted building, I will reacquire the building from Kaushik. That means in the agreement clearly I have reserved my right to repurchase the asset, reacquire the asset. Now even though building is transferred to Kaushik, okay, the transfer agreement we call as revocable transfer agreement. In case of revocable transfer agreement, even though on building rental income is received by Kaushik, such rental income is not taxable in the hands of Kaushik, that will be clubbed and taxable in the hands of transferor. Are you able to understand? Because my intention is evil intention. I am already paying 30% tax. Okay, I don't like, if I get rental income, on rental income also I am required to pay 30% tax. So there is hidden agreement between Kaushik and me. I told Kaushik, currently you are not receiving any income. I will register my building in the name of you with the condition I will purchase back from you at any time I wanted. Okay, so like Kaushik is getting rental income, he is withdrawing it and giving it to me in the form of cash. Okay, so as my intention is evil intention, whenever in the agreement there is condition of right to reacquire the asset, that agreement we call as revocable transfer. In case of revocable transfer, even though income is received by transferee, such income is not taxable in the hands of transferee, but that is taxable in the hands of transferor. Or right to reacquire the income. Such reacquisition of income can be full income or part income. I transferred my building in the name of Manoj. In the agreement I have written, even though Manoj is the owner of the building, on rental income I have the right. Out of rental income received by Manoj, 70% rental income he should give to me. That means what? In transfer agreement I have written condition to reacquire the income. Such reacquisition of income can be full income or part income. Now this agreement we call as revocable transfer agreement. Okay, whenever any one of these two conditions are there, such a transfer we call as revocable transfer. In case of revocable transfer, even though income is received by transferee, such income is clubbed and taxable in the hands of transferor. Are you able to understand? So where an assessee transferred any asset and transfer is revocable. Whenever transfer is revocable transfer, all income arising to any person by virtue of revocable transfer of assets is to be included in the total income of the transferor. Are you able to understand? But there is one exception. If transfer is by way of trust which is not revocable during lifetime of beneficiary. In case of any other transfer, if it is not revocable during lifetime of the transferee. What? Let's say there is building with me. My building I transferred to Satish, my friend. I said until Satish is alive, that building belongs to Satish. After death of Satish, that building will again come back to me if I am alive, otherwise it will come back to my successors. This is the condition that I have written in the agreement. That means as long as the beneficiary transferee is alive, during the lifetime of the transferee, I will not take back the asset. The asset will be enjoyed by transferee only. Upon the death of the transferee, I will reacquire the asset. Either me or my successors will reacquire the asset. It is also revocable transfer, but it is not revocable during lifetime of transferee. In this case, clubbing provisions will not get attracted. Rental income is taxable in the hands of Satish only. Are you able to understand? Generally, in case of revocable transfer, clubbing provisions gets attracted. But if asset is not revocable during lifetime of transferee, during the lifetime of the beneficiary, in such a case, clubbing provisions will not get attracted. Is it clear? Next, remuneration of spouse. There is Mr. A. Mr. A has business. In this business, Mr. A is having 70% stake. So can we tell Mr. A is having substantial interest? Mr. A is having substantial interest in the business. This business is paying remuneration to Mrs. A, spouse of Mr. A. Whether Mrs. A is having enough qualification to receive the remuneration? No. Mrs. A is not having adequate technical or professional qualification. In this case, even though remuneration is received by spouse, such remuneration is not taxable in the hands of spouse. Such remuneration will be clubbed and taxable in the hands of the person who is having substantial interest. Is it clear? So, in case of any business, if SSC is having substantial interest, from the same business if remuneration is paid to spouse. Spouse is having enough qualification, no clubbing provisions. If spouse is not having enough qualification to receive the remuneration, even though remuneration is received by spouse, such remuneration is not taxable in the hands of spouse. Such remuneration will be clubbed and taxable in the hands of transferor. Is it clear? Now, there is business. In that business, A is having substantial interest. Mrs. A is also having substantial interest. Mrs. A is also having substantial interest. Now, Mrs. A is receiving remuneration. Even Mr. A is also receiving remuneration. Mrs. A is not having technical qualification. Even Mr. A is also not having technical qualification. Now, how clubbing provisions will get attracted? That means what? In one business, both husband and wife are having substantial interest, both husband and wife are receiving remuneration, both are not having technical or professional qualification. In this case, we will check other income of husband and wife. Let's say other income of A is 8 lakhs, other income of Mrs. A is 10 lakhs. Now, remuneration of husband and wife both are clubbed and taxable in the hands of Mrs. A. Is it clear? So, whenever both husband and wife are having substantial interest in the business, both are receiving remuneration without technical or professional qualification. In such a case, we will check other income of the both husband and wife. Whoever is having higher other income in their hands, both persons' remuneration will be clubbed and taxable. Is it clear? Good. You know substantial interest meaning, right? I need not explain, correct? But here important thing is substantial interest share is there, right? When you are calculating share, you need to consider Mr. A share plus Mr. A relative share. Who is considered as relative? For this purpose, relative means spouse, brother, sister, lineal ascendant, lineal descendant. 48 definition is there, right? So, individual SSE equity shares plus relatives equity shares combined together, if it is greater than 20%, then we can say SSE is having substantial interest. So when you are calculating substantial interest, not only consider SSE shareholding but also consider relative of SSE shareholding also. So combined shareholding, if it is greater than 20%, then like clubbing provisions will get attracted. Next, gift to spouse. Shall I explain? Mr. A is there, Mrs. A is there. Mr. A gifted 20 lakhs to Mrs. A. These 20 lakh rupees are done fixed deposit by Mrs. A. From this interest will be received. Let's say interest is 1.5 lakhs. Even though interest is received by Mrs. A, such interest is not taxable in the hands of Mrs. A. Such interest will be clubbed and taxable in the hands of Mr. A. Is it clear? So if husband gives any gift to spouse, or if any individual gives gift to spouse, income on such gift, even though it is received by spouse, it is not taxable in the hands of spouse. That will be clubbed and taxable in the hands of transferor. Are you able to understand? Now, I will discuss advanced points. This 1,50,000 is again done fixed deposit. On this, interest of 10,000 is received. Will it be clubbed in the hands of Mr. A? It will not be clubbed in the hands of Mr. A. This 10,000 is taxable in hands of Mrs. A. That means income on asset is eligible for clubbing. Income on income is not eligible for clubbing. Are you able to understand? Good. Now let's say another example. Mr. A gifted shares to Mrs. A. On Mrs. A sold shares, capital gains received. Whether capital gains are eligible for clubbing? Yes. Capital gains are also eligible for clubbing in the hands of transfer. Or that means not only revenue income, even if there is capital income, that is also eligible for clubbing. Now on sale of shares, there is no capital gains, but there are capital losses. Even capital losses are also eligible for clubbing. Is it clear? Not only revenue income, even capital gain is also eligible for clubbing. Not only incomes, even losses are also eligible for clubbing in the hands of transfer or in case of gift to spouse. Is it clear? Now I will ask you one question. Husband transferred agricultural land to wife. From agricultural land, agricultural income is received by wife. Now, whether this agricultural income is clubbed and taxable in the hands of H or not. Yes, exempted incomes are not eligible for clubbing. This is agricultural income. This is not taxable in the hands of wife only. Then why will it be clubbed and taxable in the hands of husband? Exempted incomes are not eligible for clubbing. Another case. Husband gave 40 lakhs to wife. Using 40 lakhs, wife purchased debentures. Wife purchased debentures. From these debentures, interest is there. Interest is received by wife. Now on these, like whether this interest is taxable in the hands of wife or is it taxable in the hands of husband? That means asset is changed from one form to another form. Gift is given in the form of cash. But using that cash, asset was changed. Cash got converted into debentures. Even though asset is converted from one form to another form, still clubbing provisions will get attracted. Are you able to understand? Still, whatever the interest on debentures is there, that will be clubbed and taxable in the hands of husband. Is it clear? Understand the depth of the concept. Yeah. I told you now, not only revenue income, even capital gains are also eligible for clubbing. On sale of debentures, there is capital loss. Even loss is also eligible for clubbing. But there are some exceptions. At the time of divorce, if any asset is transferred by husband to wife as per the instructions of the court, no clubbing provisions will get attracted. Transfer of asset for adequate consideration. Husband transferred land to wife, wife paid stamp duty value worth of money to husband. Transfer happened for adequate consideration. Clubbing provisions will not get attracted. Asset purchased out of pin money. Let's say every month husband is giving 10,000 rupees to wife for running the house. She, brilliant in finance, she somehow like managed the house for with 7,000 rupees only and she saved 3,000 rupees. So every month 3,000 rupees saved, in 1 year 36,000, in 2 years 72,000. This 72,000 rupees is deposited in fixed deposit. Interest is received. That interest is taxable in the hands of wife only. It is not taxable in the hands of husband. Pin money means what? To meet household expenses, if any amount is given, that we call as pin money. Okay, out of pin money, if any income is received, that is not eligible for clubbing. That is taxable in the hands of transferee only. Transfer before marriage. Come on, before marriage there is no relationship of husband and wife, right? Before marriage, boyfriend and girlfriend, correct? So at that time, clubbing provisions will not get attracted. Only if there is relationship of husband and wife, then only clubbing provisions will get attracted. Is it clear? And if house property is gifted, section 27 gets attracted. Other than house property, if any other asset is gifted, then clubbing provisions will get attracted, because for specifically for house property, separate section is written, section 27. Okay. Next, gift to son's wife. Shall we discuss? Simple only, 2-3 concepts. Gift to son's wife, gift to third party for benefit of spouse, gift to third party for benefit of son's wife, income of minor child. Now, mother-in-law or father-in-law. They transferred asset to gifted asset, not transferred. Or we can say like this, transferred asset to daughter-in-law. And such transfer of asset is either for without consideration or for inadequate consideration. Now from this asset, income will be there, right? Who will receive income? Income will be received by daughter-in-law. Even though income is received by daughter-in-law, such income will be clubbed and taxable in the hands of mother-in-law or father-in-law. Is it clear? Are you able to understand? But there are exceptions. If transfer is made for adequate consideration, then clubbing provisions will not get attracted. If transfer is made before marriage, then also clubbing provisions will not get attracted. Immediately one student asked me, sir, what if property is transferred after divorce? Why will after divorce mother-in-law will transfer property to daughter-in-law? Okay. Ati తెలివి. Gifted a third party for the benefit of spouse. Alimony. అది హస్బెండ్ ఇస్తాడమ్మా, మదర్ ఇన్ లా ఫాదర్ ఇన్ లా కూడా ఎవరు. Now, Mr. A gave land to trust on a condition that from that land, whatever the income that is received, out of total income received, 65% income should be given to his wife. Okay. Now, trust, from this land income will come, right? Out of this income, 65% of the income will be given to Mrs. A. That means gift is given to third party with the sole intention of benefit to be provided to spouse of the individual. In this case, whatever 65% is there, even though it is received by Mrs. A, it is not taxable in the hands of Mrs. A and it is clubbed and taxable in the hands of Mr. A. Is it clear? Gift to third party for the benefit of spouse. Same concept, gift to third party for the benefit of son's wife. Son's wife means daughter-in-law, right? Now, mother-in-law, father-in-law, transferred building, gifted building to trust with the condition that on this, not building, land, because if it is building, on this land rental income is there. Now, the condition is out of this rental income, 80% of the rental income should be given to daughter-in-law. That means the main intention behind gifting building to a trust is 80% of income will be received by daughter-in-law. So if any gift is given to third party solely for the purpose of benefit to daughter-in-law, even though the income is received by daughter-in-law, such income is not taxable in the hands of daughter-in-law, that will be clubbed and taxable in the hands of mother-in-law or father-in-law. Is it clear? Sorry. Income of minor child. Generally, income of minor child will be clubbed and taxable in the hands of parents. At the time of clubbing, if parents are paying taxes under optional tax rates, 1500 exemption is allowed. Let's say minor income is 40,000. If parents are paying taxes under optional tax rates, 40,000 minus 1500, 38,500 will be clubbed. However, if parents are paying tax under default tax rates, total minor income will be clubbed without any exemption under section 1032. 32, antena? 1032. Sir, you said clubbed in the hands of parents. Whether is it clubbed in the hands of mother or father? For the first year in which minor income is received, in that year we will check whether father income is higher or mother income is higher. Out of both the parents, whoever is having higher income in their hands, minor income will be clubbed. This is scenario in the first year. In first year, let's say mother is having higher income and minor income is clubbed in the hands of mother. From second year onwards, you need not check in the first year in whose parent hands that income is taxable. From second year onwards also in the same parent hands income will be taxable. You need not check higher income every year. Are you able to understand? In first year, if income is taxable in the hands of mother, in subsequent years also income is taxable in the hands of mother only, unless there is divorce between parents. If there is divorce between parents, income will be clubbed and taxable in the hands of such parent who is maintaining the minor child. Is it clear? Now one student asked me, sir, what if both the parents die? Then income is not eligible for clubbing, income is taxable in the hands of minor only. Are you able to understand? Sentimental. So generally income of minor will be clubbed except in three situations. In three situations, income of minor is taxable in the hands of minor only. First, income earned out of skill. Okay, minor child is very good at singing. Through singing he earned money. That income is taxable in the hands of minor only. Any income earned out of manual work. Okay, minor is daily going to work and manual work and he is earning wages. That income is taxable in the hands of minor only. Minor is suffering with disability, then also minor income is taxable in the hands of minor. Is it clear in these three situations? Next, if any minor child attained majority during the previous year, let's say there is previous year, right? His birthday is on 1st November. On 1st November 2024, he became major. So till this time, whatever the income is there, that income is clubbed in the hands of parents. Once he becomes major and if he earns any income, that is taxable in the hands of major only. Are you able to understand? Next, conversion of self-acquired property into joint family property. What do you mean by this? Mr. A, he is the elder son in HUF. Elder son in HUF. Now, elder son, he purchased one building. This building is transferred to HUF. This building is transferred to HUF. So, whenever any individual transfers his individual property to joint family property, that means whenever individual transfers his property to the HUF, from such property, okay, whatever the rental income is there, even the rental income is received by HUF, such rental income is not taxable in the hands of HUF, such rental income will be clubbed and taxable in the hands of transferor, individual who is transferring the property to HUF. Is it clear? Are you able to understand? So, if self-acquired property is transferred to Hindu undivided family, even though income on that asset is received by HUF, such income is not taxable in the hands of HUF, such income will be clubbed and taxable in the hands of transferor. Is it clear? Are you able to understand? Now, this is joint family property, right? HUF property. Mr. A have two brothers, B and C. There is partition of HUF. Partition of HUF. The building is 3 floors. 3 floors. Every floor there are two portions. At the time of division, it happened like that. This was given to Mr. A. This is given to Mrs. A. This is given to Mr. B. This second floor, Mrs. B. Ground floor is given to Mr. C. Second portion is given to Mrs. C. Even after partition of HUF, whatever the spouse share of rental income is there, that will be clubbed and taxable in hands of Mr. A. Is it clear? Before partition, entire income from house property will be clubbed and taxable in the hands of transferor. After partition, transferor income is anyhow taxable in the hands of transferor. Mr. A portion income is taxable in the hands of Mr. A. Not only transferor portion, spouse's portion rental income will also be clubbed and taxable in the hands of transferor. Is it clear? So before partition, entire income will be clubbed. After partition, spouse share of income will be clubbed and taxable in the hands of transferor. Is it clear? So you can read. Please read these 2 points quickly. Next, let us discuss cross transfers. Now, there is Mr. A. There is Mrs. A. If Mr. A directly gives gift to Mrs. A, clubbing provisions will get attracted, right? Am I correct or not? That's why Mr. A thought. Mr. A has one brother, Mr. B. Okay, Mr. A has brother, Mr. B. Now, listen. Mr. A gifted 8 lakh rupees to Mr. B's son. Mr. B gifted 10 lakh rupees to Mrs. A. Mr. A directly gave 8 lakhs to Mrs. A. In such a case, clubbing provisions will get attracted. So he did not give directly 8 lakhs. He gave 8 lakhs to Mr. B's son. Asked Mr. B to give back amount to Mr. A's wife. So Mr. B, okay, brother's wife, he transferred 10 lakh rupees to Mrs. A. Now what Mrs. A did, she invested 10 lakhs in shares and 8 lakh rupees are invested in fixed deposit. This transaction is purely designed with the sole intention to avoid clubbing. Am I correct or not? If amount is directly given to Mrs. A, clubbing provisions gets attracted. So to avoid clubbing, brother's son, to brother's son, amount is gifted, from brother amount is transferred to wife. So to avoid clubbing. So whenever cross transfers are done with the sole intention to avoid clubbing of income, in such cases clubbing will get attracted to the extent of common amount. How much is common amount here? Common amount is 8 lakhs, correct? To the extent of common amount, clubbing provisions gets attracted. See, out of 10 lakhs, 60,000 interest is received. 60,000 is for investing 10 lakhs, right? If 8 lakhs is invested, how much would have been received? Do cross calculation. 48,000. This 48,000 will be clubbed and taxable in the hands of Mr. A. Balance 12,000, right? That 12,000 is taxable in the hands of Mrs. A only. Is it clear? Now, 8 lakh rupees is done FD, interest is 50,000. Now, from this 50,000, if this 50,000 will be clubbed in the hands of Mr. B. However, if Mr. B is paying taxes under optional tax rates, 1500 exemption will be allowed and only 48,500 will be clubbed in the hands of Mr. B. Is it clear? Are you able to understand? This concept we call as cross transfers. Now, let us discuss marginal relief. Sometimes what happens, little bit increase in income will cause more increase in tax liability. In those cases, income tax department will give relief in the form of marginal relief. For example, I will give you one problem. Please do. SSC name is Santosh. His total income is 51 lakhs. He is paying taxes under default tax rates. Calculate the tax liability. Help me. Up to 3 lakhs tax amount is nil, correct? Greater than 3 lakhs up to 7 lakh tax rate is 5%, tax amount is 20,000. Greater than 7 lakh up to 10 lakh tax rate is 10%, tax amount is 30,000. Greater than 10 lakh up to 12 lakh tax rate is 15%, tax amount is greater than 12 lakh up to 15 lakh tax rate is 20%, tax amount is greater than 15 lakh tax rate is 30%. 10 lakh 80,000. So how much is tax? 12 lakh 20,000. Whether surcharge is applicable? Here total income is more than 50 lakhs, right? So surcharge is applicable. To this we will add surcharge at the rate of 5%. 10%. Claps. Surcharge at the rate of 10%. 1,22,000. How much is tax plus surcharge? 13,42,000. Yeah, don't calculate HCC out of anxiety. Okay, out of sugar. Tax plus surcharge is 13,42,000, right? Now let us casually let us calculate tax on 50 lakhs. Same SSC, same default tax rates. Let us calculate tax on 50 lakhs. Up to 3 lakhs tax amount is 3 to 7 lakhs. If you don't get updated, you will become outdated. Greater than 10 lakh up to 12 lakh, how much is tax rate? 15%. Tax amount is 30,000. Greater than 12 lakh up to 15 lakh, tax rate is 20%. Tax amount is greater than 15 lakh, tax rate is 30%. How much? 50 lakh minus 15 lakh into 30%. So how much is tax? 11 lakh? 90,000. Whether surcharge is applicable? No. How much is tax plus surcharge? 11 lakh 90,000. Let us compare. If total income is up to 50 lakhs, tax is 11 lakh 90,000. If total income is 51 lakh, tax is 13 lakh 42,000. That means increase in income is 1 lakh. How much is increase in tax? 1 lakh 52,000. Now SSC will tell, sir, my income increased by 1 lakh. You are asking me to pay 1 lakh 52,000 tax. I will close my eyes. Let us assume I earned only 50 lakhs. Whatever the extra 1 lakh that I earned, I will give it back to you. Then income tax department said, okay. Are you able to understand? So like sometimes what happens, increase in tax is more than increasing income. In those cases, whatever the extra income that you have earned, if you give that extra income to income tax department, means that itself will be sufficient. You need not pay extra tax. Is it clear? And that Marginal relief is allowed through 4 steps. What is step 1? Tax on total income. That means tax on total income including surcharge. So how much is tax on 51 lakh including surcharge? 13 lakh 42,000. Step 2, tax on 50 lakhs. Tax on nearest surcharge limit. For 51 lakhs, what is the nearest surcharge limit? Tax on 50 lakhs plus additional income over and above 50 lakhs. Additional income over and above 50 lakhs. How much is tax on 50 lakhs? 92. Okay, 11 lakh 90,000 plus additional income is 1 lakh. So step 2 is 12 lakh 90,000. Step 3 is marginal relief is equal to step 1 minus step 2. How much is step 1? 13 lakh 42,000. Step 2, 12 lakh 90,000. Marginal relief is 52,000. Step 4, tax liability is equal to step 1 minus step 3 plus HEC at the rate of 4%. How much is step 1? How much is step 3? 1342 minus 52, 12 lakh 90, right? 12 lakh 90,000 plus 4%. How much? 13 lakh. See, what is the extra income on 1 lakh, right? Tax on 50 lakhs is 11 lakh 90,000. To 11 lakh 90,000, if you add 1 lakh, 12 lakh 90,000 plus HEC. That means whatever the extra income that is earned, that is given back to income tax department along with HEC. He need not pay increase in tax. This marginal relief benefit is available for all categories of persons. Is it clear? Now shall I give second one? Will you do? Yes, sir. Everybody? Yes, sir. Total income of individual is 3 crore, not 3 crore, 2 crore 1 lakh 27,500. He is paying taxes under optional tax rates. He is resident individual, aged 65 years. I wanted final tax liability. Please tell quickly. Now, how much is the answer that you got? 17 lakh, 70 lakh, 81 360. Second answer? 77,600. Any alternative answer? Shall I do? Everybody. What is step 1? Tax on total income including surcharge, correct? So tax on 2 crore 1 lakh 27,500. He is 65 years old, right? Basic exemption limit available is 3 lakhs. Up to 3 lakhs tax amount is nil. Greater than 3 lakh up to 5 lakh tax amount is 10,000. Greater than 5 lakh up to 10 lakh tax amount is 1 lakh. Above 10 lakh tax rate applicable is 30%. You have to help me. 2 crore 12 like 1 lakh 27,500 minus 10 lakhs into 30%. So how much is tax? 48,000. 58 lakh 48,250. Whether surcharge is applicable? What is the rate of surcharge? 25% because total income is greater than 2 crores. Surcharge at the rate of 25%. How much? 60? So tax plus surcharge? 73. Step 2. Tax on nearest surcharge limit including surcharge. Including surcharge plus additional income over and above surcharge limit. That means additional income over and above 2 crores, right? Am I correct? So nearest surcharge limit is 2 crores. Tax on 2 crores. How much? Up to 3 lakhs tax amount is nil. Greater than 3 lakhs up to 5 lakh tax amount is 5%. Tax amount is tax rate is 20%. Tax amount is 1 lakh. So 1 crore 90 lakhs into 30%. 58 lakh. Whether surcharge is applicable? If total income is up to 2 crores, surcharge is 15%. Add surcharge at the rate of 15%. How much? 51. How much is tax plus surcharge? Tax on 2 crores, right? How much? To this, we will add additional income over and above 2 crores. How much? How much is total? This is step 2, right? Do you agree with me? Step 3, marginal relief is equal to step 1 minus step 2. How much is step 1? 73 lakh 10,330 minus 68 lakh 9,000. So how much is marginal relief? Let us compare. If total income is 2 crore 1 lakh 27,500, how much tax he needs to pay? 66,81,500. If total income is 2 crores, I'm sorry, if total income is 2 crores, he needs to pay 66,81,500. If total income is 2 crore 1 lakh 27,500, 73 lakh 10,330. That means increase in income is 1 lakh 27,500. Increase in tax is 5 lakh 1,000. It's unfair, right? For 1 lakh 27,500 increase in income, you are asking to pay 5 lakh 5 lakh odd tax, correct? 5 lakh 1,313. So that's why marginal relief is allowed. Step 4, final tax liability. How much is step 1? Okay. Step 3. How much is balance? 70 lakh 81,360. Step 1. Step 1 minus step 3, right? 68,000. To this we will add HEC at the rate of how much? 2,72,360. How much is final tax liability? 70 lakh. 81,360. Now did you understand how to calculate marginal relief? Now did you understand how to calculate marginal relief? Even in case of company also, if total income is more than 1 crore and up to 10 crore, surcharge rate is 2%. If total income is more than 10 crore, surcharge rate is 5%. Sorry, 7%. Domestic company, total income more than 1 crore and up to 10 crore, surcharge rate 7%. Total income more than 10 crore, surcharge rate 12%. Foreign company, total income more than 1 crore up to 10 crore, surcharge rate 2%. Total income more than 10 crore, surcharge rate 5%. Correct? There, even for company also, marginal relief benefit is available. Is it clear? Next, let us discuss AMT, alternate minimum tax. What many people are doing, they are claiming extra benefits. They are claiming deduction under section 35 AD, they are claiming deduction under section 10 AA. Thereby, in accounts, they are getting huge profits, but under income tax, they are avoiding payment of taxes. So, even though they are getting more profits, they are not paying taxes in a strategical way. In order to make those persons also pay tax, alternate minimum tax provisions are introduced. Alternate minimum tax provisions are applicable to all categories of persons except companies, because in case of company, MAT is applicable, minimum alternative tax. But other than for company, for remaining all categories of persons, A.M.T provisions are applicable. Immediate doubt is, sir, what if A.M.T is applicable? If A.M.T is applicable, then tax as per A.M.T provisions or tax as per normal provisions, tax as per normal provisions, whichever is higher are applicable. Are you able to understand? Tax as per AMT provisions or tax as per normal provisions, whichever is higher, that higher tax is required to be paid to the government. I will take examples. In previous year 22-23, like as per normal provisions, tax is 15 lakhs. As per AMT, alternate minimum tax is 18 lakhs. Whichever is higher means I need to pay 18 lakhs. I need to pay payable tax is 18 lakhs. Immediately SSC will feel bad. Sir, I am required to pay only 15 lakhs. You did some matlab and you are asking me to pay 18 lakhs. Why I need to pay extra tax of 3 lakhs? For that, income tax department said, whatever the tax that you have paid over and above normal tax is there, that I will give you as A.M.T credit. Okay, here how much extra tax is paid over and above 15 lakhs? 3 lakhs. So that 3 lakhs will be considered as A.M.T credit. This A.M.T credit can be carried forward to 15 assessment years, can be carried forward to subsequent 15 assessment years. Is it clear? Can be carried forward to subsequent 15 assessment years. In 23-24, scenario is like this. Normal tax is 14 lakhs. A.M.T is only 12 lakhs. How much is A.M.T? 12 lakhs. Whichever is higher means how much? 14 lakhs is required to be paid. But when you are paying normal tax, what, see, in any previous year, minimum AMT is required to be paid. How much is minimum AMT here? In 23-24, AMT is 12 lakhs. Every year you need to pay at least alternate minimum tax. Either you can pay more than alternate minimum tax, but you should not pay less than alternate minimum tax. So in 23-24 also minimum 12 lakhs is required to be paid. Whatever the extra tax over and above alternate minimum tax is there, how much is there extra tax? So minimum A.M.T is required to be paid. Minimum A.M.T is required to be paid. Minimum 12 lakhs is required to be paid. So how much excess is available? 2 lakhs. This excess 2 lakhs I can adjust with A.M.T credit. Is it clear? So balance A.M.T credit available is only 1 lakh. Balance A.M.T credit available is only 1 lakh. So every year you should minimum pay alternate minimum tax. You cannot escape. Either pay alternate minimum tax or pay more than alternate minimum tax. This is the rule. So in 23-24, whichever is higher means you need to pay 14 lakhs. Even though you need to pay 14 lakhs, every year minimum how much you require to pay? 12 lakhs. So difference between actual tax and A.M.T is only 2 lakhs. So you can skip payment of 2 lakhs and 2 lakhs can be adjusted towards alternate minimum tax credit. That means what? We can simply tell one thing. If actual tax is greater than A.M.T, if actual tax is greater than A.M.T, excess actual tax over and above A.M.T, excess actual tax over and above A.M.T can be set off against A.M.T credit, can be set off against A.M.T credit if available, can be set off against A.M.T credit if available. Okay. Second point, if A.M.T is greater than actual tax, then A.M.T is payable excess actual tax, excess A.M.T over and above actual tax, over and above actual tax is considered as A.M.T credit, is considered as A.M.T credit. And such A.M.T credit can be carried forwarded to how many years? A.M.T credit can be carried forwarded to subsequent 15 years. Is it clear? If actual tax is greater than A.M.T, okay, excess of actual tax over and above A.M.T, you can set off against A.M.T credit. If A.M.T is greater than actual tax, how much ever A.M.T is greater than actual tax is there, that excess A.M.T you can claim as A.M.T credit, not in current previous year, but you can set off in subsequent previous years, and it can be carried forward for 15 assessment years. No confusion, very simple. Every year calculate actual tax, calculate A.M.T, whichever is higher that needs to be paid. If A.M.T is higher, you need to mandatorily pay A.M.T. However, whatever the extra A.M.T that you have paid over and above normal tax, that is given as A.M.T credit. If actual tax is more than A.M.T, in such a case, excess actual tax over and above A.M.T. Even if actual tax is more than A.M.T, minimum you will pay A.M.T. But whatever the excess actual tax over and above A.M.T is there, that you can set off against A.M.T credit. Is it clear? Now, in 24-25, let's say scenario is like this. Normal tax is 22 lakhs. Normal tax is 22 lakhs. A.M.T alternate minimum tax is only 18 lakhs. That means minimum you will pay how much? Minimum you will pay 18 lakhs. 18 lakhs is required to be paid. Excess how much is there? 4 lakhs. From that 4 lakhs you can set off balance A.M.T credit. Okay. After setting off balance A.M.T credit, still you will pay 21 lakhs. Is it clear? Are you able to understand? That means A.M.T credit was exhausted in 24-25. After exhaustion of A.M.T credit, see, You have difference of only 4 lakhs. Out of 4 lakhs you can set off only 1 lakh A.M.T credit, balance 3 lakh anyhow you need to pay. Is it clear? Now did you understand the concept? So every year minimum A.M.T is required to be paid. If actual tax is more than A.M.T, then excess actual tax you can set off against A.M.T credit to the extent it is available. Okay, after setting off, still if there is balance, again it gets taxed. Are you able to understand? This is the provision. Now, sir, you are saying A.M.T, A.M.T, A.M.T. How to calculate A.M.T? Alternate minimum tax is equal to adjusted total income into 18.5% plus applicable surcharge plus HEC at the rate of 4%. Did you understand? Now, sir, how to calculate adjusted total income? This is next question. 18.5% generally, but in case of cooperative society, we will apply only 15%. Adjusted total income into 15%. Next, how to calculate adjusted total income? You have to take total income. To total income, you need to add back deduction under section 10AA. You need to add back deduction under section 35AD. You need to add back chapter 6A deductions. There are some chapter 6A deductions, 80JJAA and certain chapter 6 deductions. Not all. Then you need to reduce depreciation that is allowed if 35AD is not claimed. After doing these adjustments, whatever the amount that you get, that we call as adjusted total income. Is it clear? So why we are, see, in every problem we are calculating tax liability, but why we are not calculating alternate minimum tax? Because in every problem we do 35AD deduction was not claimed. In every problem we do 10AA deduction was not claimed. That means what? A.M.T provisions are applicable only if you claim deduction under section 35AD, or if you claim deduction under section 10AA, or if you claim certain chapter 6A deductions, then only A.M.T provisions are applicable. Next, A.M.T provisions are not applicable if SSE is paying taxes under 115 BAA, 115 BAB. Sorry, they are for company, right? A.M.T provisions are not applicable if SSE is paying taxes under 115 BAC, 115 BAD, 115 BAE. Is it clear? Next, A.M.T provisions are not applicable if adjusted total income is less than or equal to 20 lakhs in case of individual HUF, AOP, BOI. Is it clear? A.M.T provisions are not applicable if adjusted total income is less than or equal to 20 lakhs in case of individual HUF, AOP, BOI. In case of partnership firm, irrespective of adjusted total income, A.M.T provisions are applicable. So this is the concept relating to alternate minimum tax. Is it clear? Every year A.M.T or actual tax, whichever is higher, is required to be paid. If A.M.T is greater than actual tax, excess A.M.T is given as A.M.T credit. If actual tax is greater than A.M.T, then excess actual tax you can set off against A.M.T credit if it is available. If A.M.T credit is not available, then actual tax only you will pay. Or if A.M.T credit is available, to such extent you will set off balance actual tax you will pay to the government along with applicable surcharge and health and education cess. Is it clear? Now let us discuss deduction under section 10AA. those who started manufacturing business or service oriented business in special economic zone, and they should start their business in between previous year 56 to previous year 1920. Then only they are eligible for deduction under section 10AA. Deduction under section 10AA is not available if SSE is paying taxes under section 115 series. Okay, 115 BAB, BAA, BAC, BAD, BAE. Okay, under 115 series, if SSE is paying taxes, then deduction under section 10AA is not available. Next, whatever the amount of deduction under section 10AA is there, SSC should claim deduction correctly and he should obtain certificate from the chartered accountant. Deduction calculated under section 10AA is corrected. Such certificate should be furnished before tax audit due date. What is tax audit due date? 1 month prior to due date for filing ITR. So on or before 30th September of assessment year, like chartered accountant should give certificate calculation of deduction under section 10AA is correct. Is it clear? Next. Deduction under section 10AA is allowed only if ITR is filed within the due date. If you file belated ITR, you cannot claim deduction under section 10AA. Sir, how much reduction is allowed? For the first 5 years, 100% of export profits are allowed as deduction. Sir, what do you mean by export profits? Let's say export turnover is 160 lakhs. Domestic turnover is 40 lakhs. Total profits are 30 lakhs. 30 lakhs is not allowed as deduction under section 10AA. Out of 30 lakhs, proportion of export turnover. How much is export turnover? 160 lakhs divided by 200 lakhs. How much? 24 lakhs is allowed as deduction under section 10AA. That means what? Export profits. Export profit is equal to export profit is equal to total profit into export turnover divided by total turnover. How much is total profit? Total profit is 30 lakhs. How much is export turnover? 160 lakhs divided by 200 lakhs. 24 lakhs is allowed as deduction under section 10AA. So formula for export profit is equal to total profit into export profit divided by total profit into export turnover divided by total turnover. Correct? Well and good. For the first 5 years, 100% of export profits are allowed as deduction. For next 5 years, that means 6 to 10 years, 50% of export profits are allowed as deduction under section 10AA. For next 5 years, 11 to 15 years, amount credited to cess reinvestment allowance reserve account or 50% of export profits, whichever is lower, is eligible for deduction under section 10AA. Up to 5 years, you have clarity, right? 100% of export profits are allowed as deduction. 6 to 10 years, 50% of export profits. 11 to 15 years, 50% of export profits are amount deposited in cess reinvestment allowance reserve. Sir, what is this cess reinvestment allowance reserve? Whatever the amount deposited in cess reinvestment allowance reserve account is there, such amount should be utilized for purchase of new plant and machinery within 3 years from the end of the previous year in which reserve is created. Are you able to understand? So, if it is misutilized, that means what? Whatever the amount deposited in cess reinvestment reserve is there, it was used for purchase of furniture. That means it is misutilized, right? If it is misutilized, whatever the deduction allowed under section 10AA earlier is there, that will be reversed and it is taxable separately. Now, Amount deposited in treasury investment allowance reserve. It should be utilized within a period of 3 years, right? It was not utilized. Even after 3 years also, unutilized amount is there. Whatever the unutilized amount after 3 years is there, it is taxable after expiry of 3 years time limit. Is it clear? So, export profit is equal to total profit into export turnover divided by total turnover. See, when you are exporting goods, there will be transportation charges and insurance charges. Whatever the transportation charges, insurance charges, telecommunication expenses that are received from buyer is there, those are to be excluded. Are you able to understand? Those are to be excluded in calculation of export turnover and total turnover. For example, I sold 1 crore worth of goods to a buyer in Australia. I need to transport those goods, right? Transportation, insurance, telecommunication, all these expenses together, it costed 1 crore 5 lakhs. Buyer paid me 1 crore 5 lakhs. Out of 1 crore 5 lakhs, 1 crore is only considered as export turnover. Whatever the expenses amount received for insurance, transportation and telecommunication is there, that should not be added to export turnover, that should not be added to total turnover. Is it clear? Whenever you are into service oriented business and you are delivering services outside India, whatever the expenses that you have paid to provide your services outside India are there, those expenses are also to be not considered in calculation of export turnover and total turnover. Is it clear? This is all about deduction under section 10AA. I hope you got enough clarity. Thank you.